pretty lovely but highly chilly good evening from here in Chile, and hope as always that each one of you are keeping absolutely fine and you all are in happy state of mind, because we are today starting this particular course, Corporate Financial Reporting, of course English version. Particular fact that your entire course can be divided into three segments. One is practical part, another one is what we call your theoretical chapters, and besides that we have Ind AS. Of course, we are going to supply you 4 ebooks. The first volume one will deal with the practical chapter, volume 2 with theoretical chapter, volume 3 obviously is going to deal up with what we call Ind AS. Besides that, we are going to give you another book that will encompass the MCQ question bank. So 4 books will be supplied to you. Clear? I hope that things have become clearer to you. If it has, then kindly let me know that things have become clearer to you. Now, obviously, we are going to start with some formidable chapters, and prominent among them is your Ind AS 103 business combination. It's a pretty strong chapter. It's a formidable chapter, very lengthy chapter at the same time, and technically, it's a sort of chapter where lots of technicalities are there. So that is why you need to be a little bit more attentive when we are going to do this particular chapter. Correct? These are the notes of Ind AS 103, and we will upload these notes till the time when you are going to receive the books. Correct? So that you should not lose out on anything. These notes will be uploaded on our Telegram channel, and tomorrow by 11:30 you can download it. The link is given in the description box itself. Is it clear to you? So on such count, now we start this particular session. And in order to start this particular session, let me first of all create the space. Correct? So as I told you, we are going to start with business combination first of all. So business combination, this is the chapter which we are taking up first to start what we call these live sessions. Obviously, these live sessions for CMA final paper 18, that is corporate financial reporting. Is it clear to you or not? For working people, like leave the video till 12 o'clock, sir. See, actually, this is the problem which we are facing. You must try to understand our predicaments also. Correct? The first chapter, we will think of that, but this is Abhijit, I think. Abhijit, we will try to see to it, but at the same time, now let me start the session, because a lovely good evening to everyone whosoever is joining us, either through YouTube mode or through SAS mode. Correct? So now, Ind AS 103, we are going to start. Now, very important for you. See here, if you are going to take the things casually, then ultimately we may not be able to derive the sort of mileage which I would love you to. So best thing is that you presume as if you are sitting in a classroom, and please open down your register pen or pencil, whatever it is. And it is important for us to write the things which I am going to write right now, so that we can comprehend it in a manner which I wish you to. Correct? So in order to start this particular chapter, Ind AS 103, so those among you who have joined us late, I just talked earlier that it is a formidable chapter, important chapter, high strength chapter, and pretty long chapter. So let's start now. Ind AS 103. Lots of prefacing words I have already spoken, so some of you might have got bored. So now I am going to start Ind AS 103. It's a chilly cold out here today in Delhi, and it is very difficult to hold down the pen also. Ind AS 103, we are starting. Before we start, Ind AS 103, as you know, it deals with what we call business combinations and restructuring. Correct? We will do business combinations, then along with that, we are also going to do amalgamation and what we call internal reconstruction. Very lovely good evening once again to each and everyone. Those who are joining late, sometimes it becomes very difficult for me, because now I have already started the session. So kindly pay attention towards this particular point which I am trying to explain to you. Before we start what we call Ind AS 103, as a professional student, it is very important for you to understand some important facets regarding this particular chapter. So before we start, let me actually just explain 2-3 points. The first one is that, and kindly note down these points. These points will become very handy for you later on. Suppose there is an enterprise by the name of E1, and there is another enterprise by the name of E2. Correct? We further presume that E1 has invested in E2, and the investment of E1 in E2 is, let us say, in between 1 to 19.99%. Suppose if I have invested some amount in other entity and the range of my investment is from 1% to 19.99%, that means less than 20%. Suppose I have invested in another entity and my investment comprises of 7%, 8%, 9%, 10% till up to 19.99%. So in this case, before I move further, let me also explain it. First of all, although at this particular level, it doesn't look nice to say such things, but still, to make you understand better, first of all, you must understand that in this particular case, E1 will be termed as investor entity because it has invested in the other entity. So E1 will be considered as investor entity. Is it clear to you or not? Similarly, the entity in which we have invested will be considered as investee entity. It will be considered as investee entity. I-N-V-E-S-T-E-E. Investee entity. First of all, now I told you if my investment in other entity is in between 1 to 19.99%, then generally such investment are considered as normal investment. Such investments are generally considered as normal investment. Is it clear to you? Such investments are generally considered as normal investments. Normal investments. Normal investment. If my investment range is between 1 to 19.99%, such investments are considered as normal investment. Is it clear to you? In this case, as a professional student, you need to understand that the investor will account the investment which it has made in the other entity in its separate financial statement only. In this case, as I told you, the investor will do the accounting for such investment. Accounting will be done by the investor entity because investor has invested in the other entity, and the accounting will be done by the investor entity. The investor entity is E1. Investor entity in its separate financial statement. And investor will do the accounting as per what we call Ind AS 109. So important point which you need to understand is that if our investment range in the other entity is in between 1 to 19.99%, in that case, it is considered as normal investment, and the entity which has invested the amount will account such investment in separate financial statements only as per Ind AS 109. As per Ind AS 109. And when we say as per Ind AS 109, what does it mean? It means Ind AS 9 states that investments must be recorded at fair value. Is it clear to you or not? That means if you have invested in other entity and your investment range is in between 1 to 19.99%, so it will be considered as normal investment, and in this case the investor will do the accounting for such investment in separate financial statement, and he will do the accounting as per Ind AS 109. And under financial instrument chapter, you will learn about Ind AS 109. Ind AS 109 states that such investment must be recorded at fair value. In this case, no question of preparing any consolidated financial statement. In this case, no question of what we call preparing any consolidated financial statement. Is it clear to you or not? This is the first point which I wanted you to actually understand. Second point. Now we move over to the second point. As a professional student, you must be aware of all such things, correct? Now, under the second point, what I take, in this case, under the second case, I again presume there is an entity by the name of E1 and there is another entity by the name of E2. Now, in this case, our investment range is 20% to 49.99%. First of all, now you let me know who is the investor entity in this particular case. Lots of messages I have been receiving, Kaushik, and we are working upon it. I cannot commit at this particular time. You must also understand my predicament also. Please try to understand all these things, and we are not using a very high profile language, and you must not have any difficulty in comprehending actually all these things. Anyway, now we come over to the second case. E1 is the entity which has invested in E2. Those who are attending the class, please let me know who is the investor entity in this case and who is the investee entity in this particular case. E1 is the investor entity. E2 is the investing entity, investee entity. This time my range of investment is 20% or more, but it is up to 49.99%. So if I have invested in some other entity, try to understand, if we have invested in some other entity and the range of investment is in between 20% to 49.99%, 20%, 21%, 32%, 40%, correct? If range of investment is from 20% to 49.99%, in this particular case, the investee entity will become your associate entity. This is the point which you need to understand. Is it clear to you? So your investee entity E2 will be considered as your associate entity. As your associate entity. Is it clear to you or not? Of course, E1 will be considered as investor entity. Now, you are the investor entity and E2 will become your associate entity. In this particular case, investor entity E1, the E1 will have to prepare two types of financial statement. This time, E1 will prepare two types of financial statement. One, separate financial statement. If my investment range is 20% or more, but up to 49.99%, in that case, the investor entity will have to prepare two financial statement. One separate financial statement and another one is consolidated financial statement. CFS here stands for consolidated financial statement and not for cash flow statement. Is it clear to you or not? So in this particular case, as I just told you, we are supposed to, we means E1, the investor entity. The investor entity this time will have to prepare two types of financial statement. As I just told you, one is separate financial statement, another one is known as consolidated financial statement. Now, separate financial statement will be prepared as per Ind AS 27. As per Ind AS 27. As per Ind AS 27. Is it clear to you? What are the provisions of Ind AS 27? I will let you know later on. But at this moment, it is suffice to say that the investor entity will have to prepare, in this particular case, how many types of financial statement? Two types of financial statement. One, separate financial statement, and another one is consolidated financial statement. However, consolidated financial statement, you must understand, shall be prepared by the investor entity as per Ind AS 28. As per Ind AS 28. So if your investment range is 20% or more, but up to 49.99%, in that particular case, the other entity becomes your associate entity. And in this case, the investor entity will have to prepare two types of financial statement. As I told you, one separate financial statement, and separate financial statement shall be prepared as per Ind AS 27, while consolidated financial statement shall be prepared as per Ind AS 28. Is it clear to you or not, sir? Absolutely clear. Now, so these are the things which as a professional, which you need to understand, correct? And most of the time, we tend to actually ignore such things, and later on we review regarding the same. Now I take up case C. In case C, again I stretch a line. I stretch a line once again. In this case, we presume there is an entity E1 and it has invested in entity E2. When I say it has invested in E2, it means we have purchased what we call equity shares of, let us say, E2. So we have made some investment, but this time the range of investment is 50% or more. Range is 50% or more. It could be up to 100%. So if the range of my investment in other entity is 50% or more, or up to 100%, let us say 50%, 60%, 70%, 80%, it could be 100%. Obviously, in this case, first of all, you need to understand that investor entity will be considered as parent company. There are so many names actually which we use or which we can use. It is known as parent company. investor entity E1 will be known as parent entity, or it is known as holding company. However, under Ind AS, we hardly use the word holding company, but it is also known as holding company. Is it clear to you? And it can be also termed as acquirer company. It can be termed as acquirer company. You have to understand these things very carefully. Mind the words. If your investment is 50% or more, correct, in the other entity, in that case, you will be considered as parent company or holding company or acquirer company. While the investee entity is the entity in which you have made the investment. In this case, E2 is the investee entity, and the investee entity will be considered as your subsidiary company. It will be considered as your subsidiary company. Is it clear to you? Now, it is also important for you to understand that whenever we acquire 50% or more than that in the other entity, it means we have acquired the control of the other entity. Whenever our investment range is 50% or more in the other entity, it means we have acquired the control of the other entity. And that is why in this particular case, as I told you, this entity, because it is under our control, it is subordinate to us. Because we are controlling this particular enterprise, this enterprise is known as subsidiary company, while we means the investor entity will be considered either as parent company or holding company or acquirer company. Subsidiary company can also be termed as acquiree company, Is it clear to you or not? Acquiree company. Now you have to pay extra attention. In this case, parent company will again have to prepare two types of financial statement, correct? In this case also, parent company will have to prepare two types of financial statement. One is, as I just told a moment ago, one is separate financial statement, SFS, and another one is consolidated financial statement. If you have the control over the other enterprise, how can you acquire the control over the other enterprise when your investment is more than 50% or 50% or more? Is it clear to you? You can get the control of the other enterprise only when you have the investment in the other entity in the range of 50% to 100%. Number one. So if we have got the control over the other entity, in that particular case, you are the parent company or acquirer company, while the other entity will be considered as subsidiary entity or acquiree entity. In this case, we will have to prepare two types of financial statement, as I just told you a moment ago. And again, you have to understand that separate financial statement shall be prepared as per Ind AS 27. As per Ind AS 27. While consolidated financial statement also we will have to prepare. In the earlier case, see here, in the earlier case, when our investment range was between 20% to 49.99%, other entity was our associate entity, and even in that case, I told you that we are supposed to prepare, the investor entity will have to prepare two types of financial statements, separate financial statement and consolidated financial statement. Separate financial statement shall be prepared in the light of Ind AS 27, and consolidated financial statement shall be prepared in the light of Ind AS 28. Correct? In case of associate. However, in case of subsidiary or acquiree, parent company will prepare two types of financial statement. One, separate financial statement. Separate financial statement shall be prepared as per the what we call guidelines of Ind AS 27, while consolidated financial statement shall be prepared. Now, most of us are unaware of these finer points. It is very important. Is it coming up to your expectations or not? First of all, let me please give a quick reply so that I can proceed. Are you able to hear me well enough, and are you able to understand? First, please let me have a quick reply so that I can proceed further with further enthusiasm. Are you able to understand each and every word so far which I have spoken about? Please let me know of that. Pradeep Behra, soon we are going to announce it. We are working upon it. I have already told you. Till that time, please try to pay a little bit of attention over here rather than what we call squeezing me for Hindi version classes. The moment actually I announced these live versions, I'm flooded up with these messages. I'm working on it. Don't worry about it. Thank you, Abhijit, and thank you, Wasimuddin, and thank you even Pradeep Behra and Kaushik House and Abhijit all. Okay, now we move further. So we have already seen that if you have got the control of the other enterprise, you should not let it skip out of your memory that other entity will be considered as your subsidiary company or acquiring company, and you are having the control over the other enterprise. You will be considered either as parent or what we call, you will be considered either as what we call parent company. Lots of students are there now. I'm coming over to Yasasvi Varsani. Thank you so much. Balu S, thank you so much. And Sumera Sao. Keep on actually writing in between so that we can get how many students are over there who have joined us. In SAS, nearly 150 students have already joined. SAS is very clear to us to watch, but in YouTube, it keeps on flashing. So that is the problem. Anyway, now as far as consolidated financial statements are concerned, please, I was deviating a wee bit. Now let me actually recap the things. In the third case, you have to be extra attentive. You have got the control. In this case, you will have to prepare two types of financial statement. One separate financial statement, as usual, it will be prepared in the light of Ind AS 27. However, this time you will prepare consolidated financial statement. See here what I am writing, and this is of paramount importance for you to pay attention. Correct? This time, parent company will prepare consolidated financial statement on the date of acquisition. The date of acquisition means the date on which we got the control. Is it clear to you or not? The date on which we acquired the stakes of the other entity. That is known as date of acquisition. In simple words, date of acquisition means the date on which you got what we call control over the other enterprise. So, pay attention here. So this time parent company will prepare the consolidated financial statement. It will prepare the consolidated financial statement on the date of acquisition as per Ind AS 103. There are so many people who do not know these basic things, and they keep on what we call under a quagmire of confusion when to apply Ind AS 103 and when to apply Ind AS 110. You must understand Ind AS 103 will come into play in this manner. Ind AS 103. We are going to prepare the consolidated financial statement on the date of acquisition in the light of Ind AS 103. Is it clear to you or not? In this case, we are supposed to prepare consolidated financial statement on the date of acquisition, and whenever an entity will prepare the consolidated financial statement on the date of acquisition, it will have to prepare what we call consolidated financial statement in the light of Ind AS 103. Is it clear to you or not? Besides that, when we will reach the year end, correct, at the year end, not only at the end of this particular year end, but every year end which would follow after that. That means on the date of acquisition, we will apply Ind AS 103 to prepare the consolidated financial statement. But when we will reach the what we call year end, at the end of the year, again we will have to prepare the consolidated financial statement. But this time the consolidated financial statement will not be prepared as per Ind AS 103. It will be prepared as per Ind AS 110. Is it clear to you? Is it clear to you or not? It will be prepared as per Ind AS 110. Correct? So, on the date of acquisition, we will apply Ind AS 103 to prepare the consolidated financial statement. Remember one thing, both Ind AS 103 and Ind AS 110 deal with the consolidation. Is it clear to you or not? However, when the consolidation will be done on the date of acquisition, you will have to apply Ind AS 103, and after that, at every year end, not only the current year end, but the subsequent year end also, whensoever you are going to prepare after that consolidated financial statement, you will have to apply Ind AS 110. So that is the basic difference between these two. I hope it has become absolutely clearer to you. Please let me know of that also. So these are some significant points which I just wanted to share with each one of you. So now we move a little bit further. I hope you have written all this thing. If some of you intend to write, please write quickly. Correct? Earlier, I told you in the very first case, also I told you if my investment range in other entities is in between 1 to 19.99%, in that case, no consolidation is required. These are considered as normal investment, and in this case, investor entity will account these investment in the separate financial statement as per Ind AS 109. I also told you Ind AS 109 simply states that the investment should be what we call booked at fair value. Is it clear to you or not? Now, after that, I told you if my investment range is in between 20 to 49.99%, in that case also, we are supposed to prepare two types of financial statement. First of all, I told you other entity will be considered as our associate entity, and we will have to prepare two types of financial statement, separate financial statement and consolidated financial statement. However, consolidated financial statement with respect to associate will be prepared as per Ind AS 28, while the accounting for investment will be done in the separate financial statement as per Ind AS 27. Similarly, if we have got the control over the other enterprise, even in this case, two types of financial statements are required. One separate financial statement, another one consolidated financial statement. And accounting for investment in the investee entity will be recorded in separate financial statement, and it will be done as per Ind AS 27, while consolidated financial statement will be prepared on the date of acquisition and at the year end and subsequent year end. On the date of acquisition, we apply Ind AS 103, and at every subsequent year end, current year end and subsequent year end, we will apply Ind AS 110. Is it clear to you or not? Because we have talked a lot about Ind AS 27 in this particular case, you need to understand a little bit about what we call Ind AS 27 also, little bit, not not very high amount, but at least something so that things become more clearer to you. So in the next point, this is the fourth point of our discussion. AS 27. What are the provisions of AS 27? Because so many times we have used the word Ind AS 27, correct? The investment made by the investor entity in the investee entity, generally such investments are recorded as per AS 27 in the what we call separate financial statement. So what does AS 27 states? AS 27 states that accounting for investment, first of all, it deals with accounting for investments. Accounting for investments. Accounting for investments. It deals with accounting for investments, no doubt about that. It deals with accounting for investments in associate. First of all, you need to understand. Correct? It deals with accounting for investment in associates or subsidiary. Or subsidiary companies. And I do not want to confuse you, but you also write here, and also investment in joint ventures. Correct? Now try to understand. If I have made some investment in associate or in a subsidiary, if I have made the investment in an investee entity and investee entity is my associate, I will have to prepare the separate financial statement also. Or if I have got the control over the other enterprise will be my subsidiary. Even in that case, I will have to prepare the separate financial statement. And if I have made some investment in other entity and other entity is my joint venture, even in this case also, I will have to prepare the separate financial statement. We haven't talked about joint venture in this particular session because separately we are going to take the joint venture. Is it clear to you? That's the reason. Now, the provisions of AS 27 states that investments will be recorded at cost. Investments, that mean accounting for investment, whatever investment which you have made in the investee entity, you will record those investments at cost. At cost. AS 27, Ind AS, sorry, I have written here AS 27, Ind AS 27, you please write it, Ind AS 27. So Ind AS 27 simply states that you will record the investment either at cost or at fair value, or at fair value, as per Ind AS 109. I have already told you, because Ind AS 9 deals with financial instruments. We will learn when we will take the chapter financial instrument, you will learn over there regarding Ind AS 109, 107 and 32. So Ind AS 109 states that everything should be recorded at fair value. I mean to say investment will be recorded at fair value. So AS 27 states that entity can record the investment either at cost or it can record the investment at fair value as per Ind AS 109. as per Ind AS 109. Is it clear to you or not? So these are the important provision. Another important provision of Ind AS 27 is that quite obviously as an investor, when you are investing in other entity, if you have invested in other entity, quite obviously you are going to receive some income in the form of some dividend. So any dividend income due to such AS 27 states that any dividend income which you are going to earn through your investment, any dividend income shall be recorded, any dividend income shall be recorded in separate financial statement. So whatever dividend income which you might have earned, correct, due to your investment, even that income will be recorded in separate financial statement. These are the provisions of AS 27. Is it clear to you or not? So after having completed till up to this particular point, now I move over to the fifth portion. I hope till up to this particular point everything is clear. In between, we talked about control. Do you remember here? When I took the third case and I told you if my investment in the other entity is 50% or more, correct? We generally presume that we have acquired the control over the other enterprise. And most among us are under an impression that control can be acquired through majority stakes only. That means if my investment in the other entity is 50% or more, it is generally presumed that we have got the control over the other enterprise. So as a professional student, you need to also understand the meaning of control quite well. Correct? So that's the reason I'm picking up this particular topic now. Control. Try to understand. Control. No doubt about that. Generally, the control is acquired when you have investment in the other entity and generally we call it stakes. When I make some investment in the other entity, obviously I am going to get some shares of that particular company. So if I have got the majority stake means 50% or more, correct? So if I have got the 50% or more of the shares of the other entity, generally control lies in my hand, no doubt about that. But most of us sometime actually tend to skip some finer points which I just would like to share with you. No doubt about that, as far as control is concerned, you can get the control over the other enterprise, one, through majority stakes. When I say majority stakes, it means when you have 50% or more than correct shares of the other entity. Through majority stakes, we can get the control of the other enterprise when we have majority of the share. We call it majority stakes. Actually, we are under an impression that we can get the control over the other enterprise only by way of majority stakes. No, that is not the case. You can also get the control over the other enterprise by way of some agreement. What I mean by that? Sometimes we get the control over the other enterprise through agreement. I will explain these points. Correct? In order to explain these points, just pay attention here. For example, suppose entity E1 has 70% stakes of E2. That means entity E1 has invested some amount in E2, and out of total share capital of E2, 70% of the shares are in the hands of E1. So in this case, we may say that majority shares are in our hands, majority stakes is in our hands, so we have got the control. No problem, correct? However, sometimes we can get the control over the other enterprise by way of an agreement. Now pay attention here. For example, there is an enterprise E1, and this enterprise has made investment to the extent of only 30%. Now, if my investment in other entity is 30%, this time on account of voting rights or on account of stakes, I'm not getting the control because my investment is less than 50%, isn't it or not? If my investment in other entity is less than 50%, I cannot have the control. But in this case, what is happening? E1 has invested in E2, and they have got 30% of the total share capital in their hands, so 30% stakes they have. Further, there is an agreement between E1 and E2. There is an agreement between E1 and E2. The agreement says that as per the agreement, as per the agreement, as per the agreement, as per the agreement, E1 shall be responsible, E1 shall be responsible for constituting the board of directors. Correct? E1 shall be responsible, or E1 shall have the right to constitute or compose the board of directors of the what we call this entity. Now, quite obviously, if E1 has got the what we call right and the power to constitute the board of directors of E2, quite obviously, it means we can completely control E2. So even though in this case, we are not having the majority stakes, but because we have the power to constitute the board of directors of the other entity, we may say that E2 is in our control, and we will be regarded as parent entity and E2 will be regarded as what we call subsidiary entity. Is it clear to you or not? So control always never flows only due to majority stakes. It is important to understand that control can accrue to you on account of some agreements. If you have the right and the power to constitute or compose the board of directors of the other entity, so even though you are not having what we call 50% stakes or more than that, so even in that particular case, it will be construed, it will be presumed, it will be implied that you are having the control. Is it clear to you or not? Is it clear to, this point is clear to everyone? Please let me know of that. Please let me know of that. Is this point is clear to you or not? Please let me know of that. We are talking about the control. I told you control can be acquired, and generally control accrues due to majority stakes, no doubt about that. But on rare occasions, control can flow also on account of such agreement. As I gave you the example, if agreement provides power, to constitute or compose board of directors, so in that particular case, it will be implied that we are having the control, isn't it? Further, sometime agreement may take place in this manner. See here, let us say there is another entity by the name of E1 and it has made, let us say 25% of, it has got 25% of stakes or voting rights in E2. That means E2 is having what we call 25% of the share capital of E2. So we are having this much of stakes. Logically, this much of stake will not give us any control, isn't it or not? However, let us say there is an agreement between E1 and E2. When I say there is an agreement between E1 and E2, it means the shareholders of E1 and E2 have agreed that E1 shall have the right and power, to direct, all the relevant activities, of E2. So even though in this particular case, as you must have noticed, we are having stakes only to the extent of 25%. So on the basis of stakes, we cannot say we are exercising the control over E2. However, because there is an agreement, and very specific, very clear agreement, which states that E1 will be in the driver's seat, because E1 has been given the right and power to direct all the relevant activities of E2. So if we have the power or the right to direct, to control, to give direction to the relevant activities, quite obviously it means we are in the driver's seat and we are having the control. So even in this particular case, it will be presumed and construed that E1 is having the control over E2. However, as a professional student, you must be in the know of the meaning of relevant activities. When I said relevant activities, what does it mean? Relevant activities in simplest, in layman's language, you can say such activities upon which the existence and the operations of the investee entity depends. Correct? These are very special, important, significant activities. Correct? And such activities generally are responsible for generating the revenue. Is it clear to you? Generally, under the relevant activity, we include financial activities and operational activities. Financial activities and operational activities. Financial and operational activities. So these are important, significant activities. So now you must have noticed how you can get the control over the other enterprise. Generally, the control can accrue to an enterprise, no doubt. Generally, control accrues through majority stakes. However, control may actually accrue to an enterprise, as I told you, correct, on account of a specific agreement. An agreement could be with respect to the composition of board of director or could be with respect to the direction of the relevant activities. Is it clear to you or not? Sir, absolutely clear. If it is clear to you, first of all, let me listen from you. Let me see how many are still present. Correct? Please let me know quickly actually how you are feeling now about till up to this particular stage, when because we receive your answer, as I tell you, we get further recharged. So this is very important for you to keep on telling us how the things are coming up to your expectations so that we can give you the best possible thing. And you need not require to worry about the course. You can have complete faith and belief upon me. If I've committed that we are going to finish up the course in the widest possible manner, and we are going to give you the widest coverage, no doubt about that. Correct? And we will finish the course by 31st of April. So that is very important. CK Acharya, you are also there. Lovely good evening, and things are clearer to you. It is nice to see that. And what about others? Are the things are not clear to the others? Correct? Only CK Acharya has said that things are absolutely clearer to him. What about others? What about others? Well, now slowly and steadily I am getting the answer. It is nice to see that things are absolutely clearer to each and everyone. Now we move a bit further. Next point is very important point. Please pay attention, and this is the point which so many among us neglect, and that is why we fail to understand the gamut of this particular chapter, which is highly technical chapter. Correct? So that later on you do not confront and face any trouble in understanding or in comprehending the things, I just want to make you aware of a very important facet. See here. Control, please write also, control can be acquired. Control can be acquired. We have seen now that control can be acquired. We have already seen that control can be acquired either through majority stakes. We have already seen that. Correct? In the earlier point, in the preceding point, control can be acquired through majority stakes. If we have the majority stakes, we will have the control. Control can be also acquired through agreement. We have also seen that. Control can also be acquired in another manner, and I will let you know about that in a short while. But before that, let me explain one important point. Actually, what confusion I have seen among the student fraternity during the 3 decades of my experience. Whenever we say, because so often later on we will tell you that this entity has acquired control of this particular entities, and most of the students actually unnecessarily think that the existence of other entity has finished. That is the problem. Suppose I say if I have got 70% share of this particular entity, and when we say that we have got the control, many students think that this entity has ceased to exist. No, no, no. Please pay attention here. Whenever we are getting the control over the other entity, either through majority stakes or through agreement, both the entities are still in operation. First of all, don't let it actually move into your mind and allow things to unnecessarily move into your mind that the existence of other entity has finished. No, other entity is still operating. You are still operating. Only thing is that you are controlling this enterprise. Is it clear to you or not? So if we get the control over the other enterprise through majority stakes or by way of agreement, that doesn't mean the existence of the other entity has finished or other entity has ceased to exist. No, no, no. This is not the case. So don't allow this sort of what we call confusion to move into your mind. Is it clear to you? Whenever we get the control over the other enterprise, only thing is that other enterprise shall operate under our direction, under our complete control, but it will keep on operating. This is the point I just wanted to make you understand. So whenever we get the control through majority stakes or by way of agreement, generally the existence of other entity will never ever finish. Is it clear to you or not? However, control can also be acquired by purchasing or by acquiring all the assets and liabilities, This is the point I just wanted you to actually take care of. So control can be acquired simply by acquiring or taking over all the assets and liabilities of the other entity. Now in this case, kindly let me know, before I ask you the answer, let me actually rub it out. Let us say there is an entity by the name of E2 and we are E1 entity. In this case, what is happening? We have taken over all the assets and liabilities of this particular company. So when we have taken over all the assets and liability of this particular company, in accounting jargon, still it is known as that we are getting the control of this particular enterprise. Now you let me know in this case whether this particular company will still continue to operate or not. Please let me know of that so that I can get an idea whether you are paying any attention to the lecture or not. Now you let me know, if we get the control by acquiring all the assets and liability of the other entity, in this case, will the existence of the other entity come to an end or it will keep on operating? Now you let me know of this. Kindly let me know of this. In this case, whether the existence of this entity will come to an end or not, or whether it will keep on what we call operating. I have already told you, if we get the control through majority stakes and agreement, the existence of the other entity continues. In this case, what will happen? Will the other entity keep on operating, or whether its existence will come to an end or it will cease to exist? Right, give me the answers. No one has given so far. Wasimuddin gave the answer. He is the first one. He gave the answer, the existence of the other entity will come to an end. Mahesh Jadhav says no. Mahesh Jadhav, I'm sorry to say your answer is wrong this time. When you have acquired all the assets and the liability of the other entity, how other entity can function? You just think for a moment. It is not possible. So in this case, you must understand, when we get the control in this manner, when we get the control in this particular manner, then existence of other entity or other entity will cease to exist. Is it clear to you or not? Other entity shall cease to exist. Other entity shall cease to exist. Now, other entity in this particular case will come to an end. If other entity will come to an end, quite obviously, in this case, no question of preparing any consolidated financial statement. My dear friends, later on when you are going to move, problem nowadays with the student fraternity is that they are depending upon tuition classes only. And if faculty is not up to the mark, then sometime you are endangering your future prospects, to be very honest with you. Remember one thing, you are achieving a good course, you are achieving a professional course. Later on, you will have to move into the practical arena. And when you will face the interview, such question will be tossed before you. That is the reason I would love you to pay attention to all these things, correct? Now, in this case, because generally we say that when we get the control over the other enterprise, we have to prepare the consolidated financial statement. But in this case, because the other entity is no more, how can we consolidate? No question of consolidation. Only separate financial statement will be prepared in this particular case. Is it clear to you? So in this particular case, acquirer entity will prepare only. In this case, acquirer entity or parent entity, acquirer entity shall prepare only, shall prepare separate financial statement. Separate financial statement. In this case, no consolidation will be done because it cannot be done. So no consolidation will take place in this particular case. No consolidation or no consolidated financial statement. I hope now the things are absolutely clear to you. Is it clear? Absolutely clear, sir. Now it is so nice to hear that. Now, after point number 6, so often during the length and breadth of this particular chapter, we would be using a word group. And you know the meaning of group. I need not require to tell you. I know that each one of you are well aware of the meaning of group. Whenever we say group, what does it mean? Group means, nice to hear from you, Mahesh Jadhav. I hope things are absolutely clear and you have told it's clear. A group could be of parent and subsidiary, correct? A group could comprise of parent and associate, as we have already seen, correct? A group could also comprise of parent and a joint venture. Regarding joint venture, you will learn when we will move over to what we call this particular standard, where we are going to talk about joint arrangement, joint ventures, joint operations. At this moment, it is suffice to say, when we say group, it means we are referring to parent or subsidiary, or we are referring to parent or associate, or simply we are referring to investor or what we call joint venture. Is it clear to you or not? So group is very simple to understand. Now, under the next point, after taking care of these significant points, now we are moving a bit further. Of course, we are doing Ind AS 103, and under Ind AS 103, we have to learn about business combination. What we mean by business combination? First of all, you need to understand it. What we mean by business combination? Business combination. In simple words, business combination means when an entity acquires the control over the business of the other entity, then it is known as business combination, correct? So you simply write here, when an entity acquires control over business of the other entity, control over business when an entity acquires control over business of the other entity, then it is known as business combination. Clear? Try to understand this particular point. For example, let us say there is E1. I have a habit of taking E1. You can take any other. Let us say E1 has got control over E2. has got control over E2 because let us say it acquired 70% stakes in E2. So when we say E1 has control over E2, indirectly it means now we have got the control over E2. Indirectly it means we have got the control over the business of E2. Is it clear to you or not? It is very important to understand that when an entity gets the control over the business of the other entity, or whenever in this particular chapter we will say that this entity has got control over the other entity, it is of paramount importance that other entity must meet the definition of business as given by Ind AS 103. Is it clear to you? Then only Ind AS 103 will come into play. That means if I am saying I am getting the control over the other entity must meet the definition of a business. Correct? And so this is the next point. So we have to understand the meaning of business also before we move further. I told you the other entity must meet the definition of business. What we mean by business, first of all, you need to understand. Ind AS 103 simply states that business means, actually Ind AS 103 defines business through three elements. The first element is known as inputs. First element is known as inputs. Second element is known as processes. And third element is output. In order to constitute a business, it is important that entity must have these three elements. Correct? In order to constitute the business, it is important that entity must have these three elements. So what is business in the eyes of Ind AS 103? Business basically means inputs plus processes plus output. What does it mean? Now you will try to understand. When I say that I am taking control over the business of this particular entity, so this particular entity must meet the definition of a business. What we mean by definition of business, that means this entity, correct, must have some inputs. When we say inputs, it means resources. It means resources. It means resources. And what we mean by resources, resources basically means some fixed asset, intangible asset, manpower, etc. Is it clear to you? This entity must have some resources. Further, this entity must have some techniques or processes. Techniques, Techniques. It must have some techniques or know-how, KNOW, know-how. And these two things can be combined and integrated. These two things, inputs and process, can be combined and integrated. These two things, we should be in a position to combine them and integrate them. So inputs and process should be or could be actually integrated or combined. And by combining or integrating them, we should be in a position to generate some output. Output stands for revenue. Output stands for revenue. So if somebody asks you, what do you mean by basically business and why the definition of business is important? Because if I'm getting majority stakes in the other entity, I cannot blindly say that Ind AS 103 will apply, even though I am getting the control over this particular enterprise. This entity must meet the definition of the business. That means this entity must have some inputs, some resources, and by integrating the inputs and the resources, the revenue can be what we call generated. It might not be generating any revenue at this moment, but by combining the inputs and processes, we should be in a position or we should be capable now to actually generate the resources. Is it clear to you? So important point is that whenever in this particular chapter we would say that this entity has got the control over the other entity, we will always presume that other entity is meeting the definition of the business. And just for your knowledge sake, I told you what business in the eyes of Ind AS 103. Business basically means the other entity or the concern must comprise of some inputs, some processes, and by combining these resources and techniques, we should be in a position to generate some what we call revenue. Is it clear to you or not? This is the point actually which you need to understand. After having taken care of all these things, now we move over to the next part, and the next part is accounting part. Next part is the accounting part. Obviously, this is important part. Some of you are writing the messages through SAS, sir, please give us a break of at least 10 minutes. No, it is not possible to give you a break of 10 minutes, because if I will give you a break of 10 minutes, everything will be broken down. It is not possible. Correct? 5 minutes. Problem is that these students are our old students. Correct? They have studied from us in their earlier phases of education also, and they are quite dear to us, so we cannot say no to them. Okay, we are taking a 5 minutes of break. In the meantime, you also have a cup of coffee or tea, and I will also have a cup of tea. And after that, 30 more minutes I will require, because I told you I will take the class till up to 10. That doesn't mean that I have told that I am going to take the class till up to 10 p.m. So I should actually take the class for till up to 10 p.m. Correct? So we'll take a break and we are going to now recommence. Hope you have taken the break, and I have also now my cup of tea, and if you allow me to take a sip, I will take. It's pretty cold out here today in Delhi. Extremely cold. I've never seen such cold wave. Anyway, now we move over to the next part. The next part, of course, deals with accounting part. Correct? Accounting. I hope each one of you are still there, because sometime it happens when we take the break, student move out. Now we take into account the accounting part. In order to take the accounting part, first of all, you need to understand that this standard Ind AS 103 states that the acquirer company will do the accounting on the date of the acquisition. Correct? For example, E1 has acquired, let us say, control of E2 on this particular date. Correct? This is the date of acquisition. The date on which we get the control is known as date of acquisition, and we got control by acquiring 70% of the stakes of E2. So on this date, I will have to do the accounting. Is it clear to you or not? On this particular date, I will have to do the accounting. So what are the steps involved in doing the accounting? The first step is that the standard says the first step is to identify the acquirer. Identifying the acquirer. Now, what we mean by identifying the acquirer? For example, in this particular case, when I say that E1 has got what we call 70% of the stakes of E2, it is quite visible who is the acquirer. Who is the acquirer? You let me know. You let me know who is the acquirer in this particular case. Who is the acquirer in this particular case? If suppose I am going to ask you, obviously we have got the control, so we are the acquirer and E2 will be acquiring company. But in spite of that, the standard says that your first step should be to identify the acquirer. It means to identify the accounting acquirer. This step means to identify the accounting acquirer. Identify the accounting acquirer. This step basically means to identify the accounting acquirer. Accounting acquirer. This step says that we have to find out who is the accounting acquirer. Now, first of all, we need to just analyze this particular step. In order to analyze this particular step, pay attention here. When I say E1 has got control of E2 by acquiring 70% stakes, no doubt about that. No doubt about that. E1 is legal acquirer. Legal acquirer. That means in the eyes of the law, E1 is the legal acquirer. In the eyes of the law, E1 will be considered as legal acquirer. Legal acquirer means from the perspective of the law, E1 will be considered legally as the acquirer company, while E2 will be considered as legal acquiree. legal acquiry. No doubt about that. However, this particular step says that we have to identify the accounting acquirer. Try to understand, 99.99% legal acquirer itself will be the accounting acquirer. 99.99% legal acquirer will also be the accounting acquirer. First of all, you need not require to worry about this particular point. 99.99% legal acquirer itself will be the accounting acquirer, and legal acquiry will not be considered generally as the accounting acquirer, because accounting will be done in the books of the acquirer entity, and generally the legal acquirer is also the accounting acquirer. But under rare circumstances, it may happen. What may happen? See here. Under rare circumstances, such a sort of position could be unfolded. For example, E1 has taken 70% of the stakes of E2. And no doubt about that, E1 is the legal acquirer. Correct? E1 is the legal acquirer. From the perspective of the law, we may say that E1 is the legal acquirer, no doubt about that. And E2 will be considered as legal acquiry. Remember, in this particular chapter in our notes, we have kept nearly 24 sections. So you can gaze and visualize the length and breadth of this particular chapter. And each section comprises of a sort of what we call question, and we have kept a separate section for reverse acquisition. I will talk about reverse acquisition later on. Just pay attention here. E1 has got control of control over E2 by having 70% stake. So no doubt E1 is the legal acquirer and E2 is the legal acquiry. However, let us say an agreement has taken place between E1 and E2. An agreement takes place between the shareholders of E1 and E2. And as per the agreement, it was decided that E2 shall have the right to control relevant activities. RA means relevant activities. Now in this particular case, even though we are the legal acquirer because we are having the majority stakes, and E2 is the legal acquiry, but in this case, if I am going to ask you who is going to be the accounting acquirer, accounting acquirer will be E2. So in simple words, sometime under rare situation, it may happen that legal acquiry may not be the accounting acquirer. If such a situation takes place, we call it a case of reverse acquisition. And that is what exactly I was trying to tell you earlier. We have kept a separate section for the same, wherein we are going to do some case studies with respect to what we call such sort of what we call situations. Is it clear to you? Otherwise, you need to understand, because most of the time in the question, you will be given only this much, that E1 has acquired so much of stakes. So under such situations, you need not require to stretch your mind unnecessarily, and the legal acquirer itself will be the accounting acquirer. Only when question elaborates like this, so here you will have to exercise a bit of caution to know actually that legal acquirer may not be the accounting acquirer. In this case, accounting acquirer will be what we call E2. Correct? So in this case, accounting acquirer, that means for the purpose of the accounting, E2 will be considered as accounting acquirer. So accounting acquirer in this particular case will be E2. We will do the accounting in the books of acquirer, and E2 will be considered as accounting acquirer, because in this case, legal acquirer is not the accounting acquirer. Legal acquirer is not the accounting acquirer. That is why in this particular case, we may say case of reverse acquisition. So it will become a case of reverse acquisition, and we will do some lengthy questions on reverse acquisition later on. So that is why this particular standard stresses under point number 1, that first of all, on the date of acquisition, you will have to find out in whose books the accounting will be done. Accounting will always be done only in the books of accounting acquirer and not the legal acquirer. Is it clear to you? That's a different matter. I've already told you. More often than not, your legal acquirer will be the accounting acquirer also. But under rare circumstances, we may come across such a situation. Is it clear to you or not? Now, under the second step, what we are supposed to do. Now, the second step deals with identification, comma, recording, comma, and measurement, and measurement. I have already told you, because ultimately on the date of acquisition, you are supposed to prepare the consolidated financial statement. For the purpose of preparing the consolidated financial statement, because you are getting the control of the other entity. So when we do the consolidation, basically what we do, we combine the assets of the group entity. I already told you what we mean by group. Group means the parent entity, in this case acquirer entity. Acquirer entity is also known as parent entity, and acquiree entity. So we will combine their assets and liabilities and we will simply put them in a single statement. That statement is known as consolidated financial statement. So in simple words, your next step deals with how you are going to record the assets and liabilities, because you are getting the control over the other enterprise. So because you are having the control over the other enterprise, obviously all the assets and liabilities of that company, because in order to prepare consolidated financial statement, it will be presumed that as if you are taking over their assets and liabilities. So you will have to record their assets and liability in your books. So the general principle is that, please pay attention, it is very important to understand. The general principle is that all the assets and liabilities of the acquiree company, will be recorded by the acquirer entity at fair value. This is the general principle. Please pay attention here. For example, this is, for simplicity's sake, I am preparing the balance sheet in this manner. Let us say this is the balance sheet, correct? This is the balance sheet of acquiree entity. Acquiree entity is one which is being taken over by, or whose control is taken over by, the acquirer entity. Obviously, acquiree company will have some assets and will have some liabilities, no doubt about that. Now you have to record those assets and liability in your books. Is it clear to you? That is what we mean by identification, recording, and measurement. It is very important that all the assets and liabilities will be recorded and you will pass the entry. This is the acquirer entity. Now acquirer entity, how it will record? Whatever assets which are appearing over here, we are going to record them by debiting those assets, and whatever liabilities are appearing over here, we are going to record them. Asset account debit to liability account. Simple entry, no problem at all. But the point is that all the assets and liabilities you are going to record at fair value. This is very important. FV, when I am writing FV, it means it is fair value. This is the general principle, that all the assets and liabilities of the acquiree company will be recorded by the acquirer company at fair value. Correct? Whether they are appearing in the books of acquiree value, at book value, or at whatever value, irrespective of that, we have to see to it on the date of acquisition, what is the fair value, and on the basis of fair value, we are going to record all the assets and liability of the acquiree company. Is this particular point is clear to everyone? Let me know. Is this point is clear? Because it is very important to know from the student fraternity whether you are getting and comprehending the things or not. Is this point is clear to everyone when I said that at whatever value it might be appearing in the books of acquiring company, you have to record them at fair value. This is the general principle. Is it clear to you? This is the general principle. So under step, this is our second step of accounting. And here I am elaborating point number 1 or point number A. Now we come over to second point under the second step. Second step deals with, in simple words, identification, recording and measure 1. Correct? Now under the second case, point is that the general rule is that all the assets and liability will be recorded by the acquirer entity at fair value. Correct? This is the general principle, common principle. Correct? However, there may be some exceptions. There may be some exception, and you have to take care of those exceptions because so many among us tend to neglect this particular point at all. And then only the problem we face. The general principle is that we have to record assets and liability at fair value. However, now we are moving over to some exceptions. There are some exceptions to this general principle. Exceptions. What are those exceptions? Now we shall talk about some exceptions. Pay attention here. Let us say this is the balance sheet of acquiring entity. This is the balance sheet of acquiring entity, correct? Towards your right side, when I am preparing the, let us say this is the balance sheet of E2 and you know E2 is the acquiring entity, correct? I have already told you acquiring company will have some assets and some liability without any doubt, correct? Let us say this acquiring entity has got a contingent liability, CL. Please pay attention and you write in full form. It is not current liability, it is contingent liability. It is having a contingent liability. As you know, contingent liability are not recorded in the balance sheet because if contingent liability will be recorded in the balance sheet, it will become a liability. Is it clear to you? First of all, you need to understand what is contingent liability. Contingent liability, as a professional student, you need to give answer like a professional student and especially of a final level student. Contingent liability means, see here, suppose I am at the end of the accounting year. I am at the end of the accounting year and there is some obligation. There is some obligation. That obligation on the reporting date is known as present obligation. Any obligation on the reporting date is known as present obligation. Obligation means you have some sort of pressure, some sort of foundation because you have to oblige something. You are under some sort of pressure, correct? Foundation. There is a present obligation. Let us say a customer has filed a case on your entity. You are E2 entity, acquiring entity, and your customer has filed a case upon E2. Clear? And the case is still pending. So there is a present obligation because a case has been filed by the customer. But you have considered it as a contingent liability because in your opinion, chances of outflow of funds, chances. This pen actually slides so hard, it sometimes becomes difficult to control it. Chances of outflow of funds, chances of outflow of funds does not exist. You are of the opinion that even though case has been filed and case is still on, but E2 or directors of E2 might be under an impression that chances or probability of outflow of funds is remote, correct? So there is no probability of outflow of funds. So if there is an obligation and we feel that there will not be any outflow of funds and probability of outflow of funds is very slim, very less, we consider it as contingent liability. And contingent liability is always reflected as a footnote, correct? That means it is not recorded in the balance sheet. This is the balance sheet. This liability, this item is not appearing in the balance sheet. But now E1 is taking the control over E2. E1 is the acquirer entity. We will still record this contingent liability. Try to understand this particular point. Even though this liability, this contingent liability is not appearing in the balance sheet of E1, but still we are going to record it. Still we are going to record it. Try to understand this particular point. We are still going to record it. The standard says that the acquirer company will also record the contingent liability. Is it clear to you? Provided, see here, first of all, let me actually write here. First of all, let me also explain to you that it is an exception. The general principle is that all the assets and liabilities which are appearing in the books, this is the general principle, which are appearing in the balance sheet of acquiring company will be recorded and recorded at fair value. But now we are violating this. We are going against this principle because we are recording an item which is not appearing in the balance sheet. The general principle is, see the difference between, and mind the language here. What I'm saying actually, if an item appears in the balance sheet, the general principle is that whether asset or liability, if it is appearing in the balance sheet of acquiring company, we will have to record it at fair value. This is the general principle. But here we are recording an item which is not appearing in the balance sheet. That is why it is an exception. And we will see later on, it is known as an exception to recognition principle. We are recognizing this what we call as a liability. We have to record this item as a liability. Is it clear to you or not? We will have to record this item as a liability, and it is known as exception to recognition principle. Exception to recognition principle. Exception to recognition principle. So we will have to recognize it as a liability. As you know, contingent liabilities are never recognized as what we call liability. But still the acquired company will have to recognize this as a liability in its books. Is it clear to you or not? And why it is known as an exception to recognition principle, you should also understand that. Because generally contingent liability are not recorded as a liability. They are written generally under the footnote, but we will have to recognize it. So in simple words, if an item of acquiring company is not appearing in the balance sheet and still we are recording it, of course we are recording it as a liability or as an asset, then it is known as an exception to recognition principle. Exception to recognition principle. Is it clear to you or not? So in the light of Ind AS 37, we will have to recognize this item. Is it clear to you? Irrespective of outflow of funds. This is a very important point. Now, under step number 2, we have taken A, B, and now I am moving over to C. Point number C. Point number C. Pay attention. In this case also, let us say this is the balance sheet of E1. This is the balance sheet of E1, correct? This is the balance sheet of E1. Obviously, there are some items, assets, there are some liabilities also of the acquiring entity. Sorry, E2. I have written E1. Actually, it is E2. Now, in this particular case, I will write here first of all E1. Let us say there are some items in the books of what we call E2 like A1, A2, A3. Similarly, there are some liabilities L1, L2, L3. L1, L2, L3. Some liabilities are there in the books of acquiring company. Is it clear to you or not? In this case, what is the general principle? General principle is all the assets and liabilities which are appearing in the books of the acquiring company will be recorded over here. And generally, all these items are recorded at fair value. This is the general principle under point number 2A. We saw that, isn't it or not? This is the general principle. But sometime what happened, we record all the assets or some of the assets which are appearing what we call on the asset side and the liabilities which are appearing on the liability side. The general principle is that we have to record them at fair value. We are recording them, but we are not recording them at fair value. We are not recording them at fair value. We are recording that. These are the assets and liabilities of acquiring company. We will have to record them, but we are not recording them at fair value. The general principle is that we have to record them at fair value, but we are not recording at fair value. If some items which are appearing in the balance sheet of the acquiring company and you are recording them but not recording them at fair value, then it becomes exception to measurement. It becomes exception to measurement. It is a case of exception to measurement. Exception to measurement, because here we are differing the measurement rules, because generally all the assets and liability appearing in the books of the acquiring company will have to be recorded at fair value, but we are not measuring them at fair value. Then how we will measure them, and what are those items, what are those exceptions, I will let you know in a short while. Just pay attention. It is known as exception to measurement principle. It is known as exception to measurement principle. Measurement principle. It is known as exception to measurement principle. Is it clear to you or not? And generally, such items comprises of share-based payments. SBP, I am writing in short form, share-based payment. E2 Limited might have announced a scheme, share-based payment scheme. You will learn about that because you have already a chapter in the form of Ind AS 102, wherein we are going to learn a lot about share-based payment. So even at this particular moment, if I'm going to tell you something, you're not going to comprehend. So for the simplicity's sake, I'm simply telling that acquiring company might have announced a share-based payment scheme. So you are going to record that. You are going to record them, but you are not going to record them at fair value. Then at what value? You will record them in the light of Ind AS 102. That as per the provisions of Ind AS 102, because Ind AS 102 deals with what we call share-based payment. Similarly, second point, assets held for sale. Assets held for sale. Assets held for sale. In the balance sheet of acquiring company, there might be some assets appearing, and those assets are meant for sale, correct? Due to some or any other reason. So we will record those assets. Assets held for sale will be recorded, but not at fair value. Then at what value? First of all, we will record them in the light of Ind AS 105, because later on we will see that Ind AS 105 deals with assets held for sale. And Ind AS 5 states that assets held for sale shall be recorded at fair value, less cost of disposal, Some of you may say, sir, still we are recording them at fair value. We are not recording them at fair value. We are recording them at fair value, less cost of disposal, Is it clear to you or not? Then next point is reacquired rights. Reacquired rights. What we mean by reacquired rights? Let us say E1 is a very famous company, very reputed company. It has got a tremendous market, correct? Tremendous name. It's a tremendous brand name. And it has given its name or brand to be used by E2 before the business combination, correct? Earlier, E2 was functioning as a separate entity and we were functioning as a separate entity, and we have a good brand name. So let us say we have allowed E2 to use our brand name for a particular period. Quite obviously, because E2 Limited has acquired our brand name, that brand name must be appearing as an asset in the what we call books of E2 Limited. Now, what happens? Let us say after 4 or 5 years, E1 Limited acquires E2 Limited. If we are acquiring E2 Limited, then what will happen? It means the right which we had given to them earlier, 3-4 years ago, now we will take them back. That is known as reacquired rights, correct? So any reacquired right appearing on the asset side of the acquiring company will have to be recorded, but it will be recorded not at fair value. Then at what value? We have kept a separate section, correct, where we are going to discuss the reacquired right, correct? And there is a separate section by the name of pre-combination relationships. Over there, I will let you know exactly how the measurement is done, but here I will simply write, it will be measured as per the remaining terms of the contract. As per remaining terms. For example, we had given them this particular brand name or franchise or trademarks to be used for 10 years. And after 4 years, we took control of this particular entity. That means 6 years are still remaining. So as per remaining contractual terms, we will measure them. As per remaining contractual terms, 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 we are going to measure it. So these are known as exception to. Remember one thing, nowadays you are facing lots of MCQs also. In the MCQs, such question may be tossed up in the examination. So that is the reason why you have to pay extra attention towards this particular point. Is it clear to you or not? Clear? Anyway, so we are still, this particular point is on. We have to discuss a lot under this, and we will continue finishing. Correct? So first of all, quickly, I am going to recap what we did in the last session, just to actually make yourself sure that you should not lose out on any important point. Good evening, Vipul Singh also. So last time when we started off in this manner in order to understand the business combination. First of all, while starting the class, I told you it happens to be a pretty technical chapter, pretty important, formidable, and more than that, it's a pretty lengthy chapter. But anyway, when we started the chapter, I told you, for example, if you are an entity and your investment range in the other entity happens to be in between 1 to 19.99%, in that particular case, the investor E1 will be known as investor, E2 will be known as investee entity. And if your investment rate happens to be in between 1 to 19.99%, I told you in the last session that such sort of investment are treated as normal investment, and importantly, under this, the investor is going to account the investment in the separate financial statement only, and as per Ind AS 109. And Ind AS 109 states that investments must be recorded at fair value. Is it clear to you? Good evening to everyone. Now I cannot take the names of everyone. Sometimes it becomes very difficult. So pay attention. I'm quickly recapping the things. Then I took a second case wherein I spoke about this particular fact that there is an entity by the name of E1. It has investment in the range of 20% to 49.99% in the other entity. In such a situation, other entity will become your what we call associate entity. No doubt about that. Under such a situation, important point is that the investor entity will have to prepare two types of financial statement. One, separate financial statement, another one, consolidated financial statement. And separate financial statement, as a professional student, you need to keep in your mind, will be prepared under such circumstances as per Ind AS 27. While consolidated financial statement shall be prepared as per Ind AS 28 if other entity happens to be your associate entity. And the third point which we took was pretty important one, wherein I spoke about this particular fact that my investment range is either 50% or more than that, correct, in the other entity. Then other entity will become our subsidiary entity, and other entity is also known as acquiree entity, and you will be known as investor entity, will be known as parent entity, or what we call holding company or acquirer company, because this time now you have got the control over the other enterprise on account of majority stakes, correct? Under such situation, as we saw in the last session, we are supposed to prepare two types of financial statement. We means the investor entity, the parent entity. One, that is separate financial statement. Another one is consolidated financial statement. Separate financial statement shall be prepared as per what we call Ind AS 27. But consolidated financial statement, this is the important point. On the date of acquisition, parent company will prepare consolidated financial statement, and at the year end and subsequent year ends, it will have to prepare the consolidated financial statement. Correct? When it will prepare the consolidated financial statement on the date of acquisition, I told you Ind AS 103 will come into play. While at the year end and subsequent year end, whensoever we are going to prepare the consolidated financial statement, in that particular case, we will have to apply Ind AS 110. Is it clear to you? Then I also told you about what we call some facets of Ind AS 27. Ind AS 27 simply states that whenever the parent entity is going to do the accounting for investment in associate or subsidiary, then it will have to prepare the separate financial statement also, and such investment will be recorded either at cost or at fair value as per Ind AS 109. Further, if you happen to actually receive any dividend income, even that dividend income will also be credited to profit and loss account in the what we call separate financial statement. Is it clear to you? Then also we took the concept of contract control. I told you that control can be acquired either through majority stakes or by way of agreement, where an agreement could be with respect to composition of board of director or with respect to what we call control of relevant activities. Correct? Then after that, I told you one very important aspect, that we can get the control over the other enterprise either through majority stakes or by way of agreement. But sometimes we get the control over the other enterprise by simply taking over all their assets and liabilities. In such a situation, no question of preparing any consolidated financial statement would arise, simply because of the fact that the other entity now has lost its existence. Is it clear to you or not? Then we talked about business combination. Business combination simply means when an entity acquires the control over the business of the other entity. We saw what we mean by business. Business comprises of three elements: input, processes, and output. And we should be in a position to integrate the input and processes, and then we should also be in a position to generate some revenue. Then only it will be called as a business. Another entity must meet the definition of business. Then only Ind AS 103 will come into play. Importantly, in the last session, in the final stages, we were talking about what we call accounting. I told you that generally this particular standard states that on the date of acquisition, acquirer company will have to do the accounting. On the date of acquisition, when we do the accounting, the first step is to identify the acquirer, which means that in whose books the accounting will be done. That means for the purpose of accounting, who is going to be the acquirer. This is the first step. And I also told you, generally the legal acquirer remains the what we call accounting acquirer also, but under rare circumstances it could be a possibility wherein we will see that a legal acquirer is not the accounting acquirer. Then under the second step, we were discussing that how to record and measure the assets and liabilities of the acquiring company. In the first step, I told you the general principle is that whatever assets and liabilities which are appearing in the books of the acquiring company, you will have to record only those assets and liabilities. This is the general principle. Please don't lose sight of this particular word. This is the general principle. The general principle is that all the assets and liabilities which are appearing in the books of the acquiring company, you will have to record that. This is general principle, and the important point is that such assets and liability will be recorded at fair value in the books of the acquirer. Is it clear to you? However, we were talking about some exceptions. There are some exceptions also. And I gave you one example with respect to the fact that there may be some items which may not be appearing in the books of what we call acquiring company. For example, contingent liability. They might have not recognized this liability because of the fact that probability of outflow of funds is not there. But herein, we will have to recognize this as a liability. So it becomes an exception to recognition principle. Remember one thing, you will have to face and confront a lot of what we call MCQs also. So for that, such things you need to actually keep in your mind. Then second point, we talked about this particular fact that there may be some items which are appearing in the what we call balance sheet of acquiring company. Correct? Assets and liabilities. The general rule is that we have to record them, and we have to record them at what value we are supposed to record them. Please give me the answer now. And very lovely good evening to Ravi Bajaj, Ajay Satpati, Wasimuddin, Ashok Das, VP Singh, Vipul Singh, Krishna Gaur, and there might be many more, but I'm not able to actually see them on the screen right now. Anyway, good evening to everyone, those who are connected with us through YouTube and those who are connected with us through SAS system also. Correct? In the SAS system, actually, I'm not able to read the name, but there are 3 people right now from Jaipur, 2 from what we call Mumbai, Ghatkopar, and another one is from Chennai, from Andhra Pradesh, from Vishakhapatnam. So it is nice to see everyone attending these sessions. Anyway, Sam, fair value, I'm talking about, you gave the answer, I'm sorry, and very lovely good evening to you, Pravesh. Gadyanwar, very lovely good evening once again. Everyone is telling me the right answer. Yes, the general rule is that whatever assets and liabilities which are appearing in the balance sheet will have to be recorded at fair value. But now, what is the exception here? T. Srupati Senapati, lovely good evening. Now, the point here is that I told you in the last session, there are some items like share-based payment. They might be appearing in the balance sheet of the acquiring company correct? But we will have to record them not at fair value, rather in the light of Ind AS 102, correct? So these are known as exception to measurement principle, because we are not measuring them, at what we call fair value. Is it clear to you? Similarly, there might be some assets which are meant for sale. So such assets, known as assets held for sale, are recorded in the light of Ind AS 105, and Ind AS 5, you will study later on, states that such assets should be recorded at fair value less cost of disposal. And then regarding what we call reacquired right, we might have given them some rights now because we have taken over the control of that particular enterprise now. That means those rights have come back to us. So such rights will be measured as per the remaining contractual terms. Correct? Till up to this particular stage, I think we had finished in the last session. Now we will stress the discussion to some further limits. I would love you to, at the same time, please pull out your pen, pencil and be honest. If you are going to be honest to yourself, then surely I will see to it that you are going to come out with wonderful performance in the examination. I can give you this sort of guarantee, correct? Now, after having noted down all these points, remember one thing, still point number 2 is on. Under point number 2, we have talked about A, B, C, and now I am writing point number D, correct? What is point number D now? Under point number D, see here, this is the balance sheet of, let us say, acquiring entity. And we have taken acquiring entity as E2, correct? Right from the beginning of this particular chapter itself. E2. Obviously, there are some assets and some liabilities in the books of acquiring company. Correct? Sometime what happens, there might be some assets and liabilities which might not be what we call appearing over there, due to some or other reasons, correct? Due to some or other reasons, might not be appearing in the balance sheet of E2. And further important point is that in spite of the fact that those items are not appearing in the balance sheet of the acquiring company, we will record them, and we will not record them at fair value. For example, in the very first case, you remember, I told you about the contingent liability. Even this item was not appearing in the balance sheet of the acquiring company, but we are going to record it. But important thing is that we are going to record it at fair value. That means that is why it is an exception to recognition principle, and it is not an exception to what we call measurement principle. But sometimes there are some items which are not at all appearing in the books of what we call acquiring company. In spite of that, we are going to record such assets or liabilities, and we are not going to record them at fair value. That is why these items will become what we call exception to both recognition principle and also measurement principle. That is why they are known as an exception to recognition and measurement principle. I hope you got the particular point. You got the difference between the first one and this one. In the first one, contingent liability was also not appearing in the balance sheet, but we will have to record them. But we are going to record them at fair value. Because it was not recognized, but we are recognizing, that is why it becomes a case of what we call exception to recognition principle. While in this particular case, we are talking about exception to recognition and measurement principle. Because these items are not appearing over here, number one, we are recording them. That is why they become what we call exception to recognition principle, and we are not going to record them at fair value. That is why they also become what we call exception to the measurement principle. What are those items? For example, let me write the items also. For example, income taxes. Income taxes. Generally, at your level, you will not face this situation, but still, just to acquaint you. Now, you may say, sir, income tax may be appearing in the balance sheet of acquiring company. Don't worry about this thing. What I'm talking about here, income taxes, actually here I'm talking about deferred tax asset or deferred tax liability. Later on, you have Ind AS 12 in your course, and you are going to study at great length over there regarding these two concepts, deferred tax asset and deferred tax liability. What happens actually, as you know, when we are going to take over the assets and liabilities of the acquiring company, I have already told you we are going to record them at fair value. Now, because of the changes in the value, sometime what happens, because of changes in the fair value, now what happens? it gives rise to what we call deferred tax asset or deferred tax liability. Obviously, these assets are not recognized by acquiring company, no doubt about that. But we will have to recognize them because we are taking over all the assets and liability at fair value. Because of change in values, it gives rise either to deferred tax asset or deferred tax liability. So we will have to recognize income taxes, number one, and it will be recognized not at fair value. It will not be recognized at fair value. First of all, they haven't recognized it, but we will have to recognize it. That is why it is an exception to recognition principle. Further, we are not recognizing them at fair value. That is why it is also an exception to the measurement principle. Correct? We are going to recognize it as per Ind AS 12. As per Ind AS 12. Is it clear to you or not? Is this point is clear to everyone? Is it clear? Fine then. There might be some employee benefits. Employee benefits. Ind AS 19. Ind AS 19. What happens when we take over the control of the other enterprise? As I told you, because we record the assets and liabilities at fair value, it sometimes gives rise to what we call employee benefit liabilities. So we will have to recognize such employee benefits liabilities, and at what value we are going to recognize them, that value will be decided by Ind AS 19. Is it clear to you or not? So these are the things which you need to keep track of. One more item, actually I am getting recapped, so I will also write like intangible assets. Intangible assets. Intangible assets. Intangible assets. You may say, sir, intangible assets generally appears in the books of every entity. No doubt about that. What I'm trying to say, please listen to my point. Sometimes what happens when we take over the business of the other entity, suddenly we find actually that there is an item which is meeting the guidelines of Ind AS 38. Whatever guidelines have been provided by Ind AS 38, it is meeting those guidelines. And this entity hasn't recognized that intangible asset. Perhaps this entity might not be what we call following the Ind AS. It could be a possibility. It is another entity. That entity might not be following Ind AS. So it could be a possibility that they might have not recognized what we call that intangible asset. But if there is something which meets the definition or the guidelines of the Ind AS 38, Ind AS 38, as we know, deals with intangible assets. So under the situation of business combination, you will have to be careful when you are taking over the assets and liability, and suddenly you come across over a particular fact, this particular item or this particular expenditure actually meets the definition or the criteria of the intangible assets. Is it clear to you? Then you will have to recognize that. That is the point which you need to understand. So intangible asset, provided they meet the criteria, separability criteria of Ind AS 38, then you will have to recognize that. These three items becomes what we call, exception to recognition and measurement. Could you now tell me quickly, what is an exception to the recognition principle? Give me an example. Recognition principle, contingent liability. What are the what we call exceptions to measurement principles? Share-based payment, asset held for sale, and reacquired rights. And what are the exception to recognition and measurement principles? Income tax liability, employee benefit expenses, and as I told you, what we call intangible assets. So these are the things which we have to take into account. Is it clear to you? This is your second step. So second step is pretty vital. Now under the third step, the standard says that when you do the accounting, you will have to compute the NCI also. What we mean by NCI and how we are going to compute the value of the NCI, this is the another question. Isn't it or not? So we have to compute the value of the NCI also. Standard says so. What we mean by this particular point, pay attention here. In order to make you understand this particular point, please also write along with me and be honest, as I have already told you. So, in this particular case, we presume that there is an entity by the name of E1. Correct? Another entity, of course, I always take E1 and E2. Further, I presume that on this particular date, we got hold of 70% stakes in this particular entity. we are not going to get hold of what we call other entity. 70% shares we are purchasing. Obviously, we will have to churn out some money. Let us say in order to what we call purchase 70% share capital of E2, we have paid purchase consideration of 140 lakhs. 140 lakhs worth of purchase consideration we have paid. How much? 148 lakhs. I hope that each one of you are right. And let me also tell you, I have already uploaded the notes of business combination in my YouTube channel. You can download it till the time you receive the books. We now already have the books also. So soon we are going to supply all the books to each one of you, those among you who have already paid for the same. There are 4 sets of books now we are going to supply. I will show you the 4 sets of books also. These are the sets. This is set number 1, correct? This is set number 1, deals with practical chapters. This is set number 3, in fact. It deals with Ind AS. I hope you are able to say it. And this is your set number 2, volume 2. It deals with theoretical chapters. Correct? 3 sets already. And 4th set we have prepared. This is for MCQ. These are the 4 sets which you are going to receive. I would love you to, those among you who haven't applied for the payment, please go for it as soon as possible so that later on, you should not be in any sort of trouble in comprehending the things, correct? So, till the time you receive the books, you have the now this luxury of downloading the notes. I have already uploaded the notes of business combination in Telegram channel. That is the point. Anyway, so E1 has acquired 70% stakes in E2 and our purchase consideration is 140. Further, we presume on this date, where is the scale actually? Let me pick up my scale. Scale is lying here. On this particular date, on the date of acquisition, because on this particular date we got the control. Let us say on this particular date, acquiring company is having net assets and book value of net assets. Book value of net asset is 110 lakh and their fair value is 112 lakh. Their fair value is 112 lakh. Correct? This is the information I delivered. Actually, we are trying to find out, as per step number 3, because Ind AS states that we have to do calculations with respect to NCI. What we mean by this, actually the point is this is what we are trying to diagnose. Is it clear to you? So in order to understand this particular point, pay attention here. First of all, you need to understand that non-controlling interest. We will see standard says that non-controlling interest can be measured either at proportionate share of net assets basis. Proportionate share of net assets basis. In short form, I have written PSNA. Correct? Proportionate share of net assets basis, or what we call you can value NCI at fair value. Correct? Entity has this option. This option is given to the acquirer entity whether they want to compute the value of the NCI either what we call through proportionate share of net assets basis or fair value. Generally, in practical life, the priority is given to fair value. In practical life, I'm talking about, and then it is given the what we call weightage. Generally, the priority is given to the fair value. If possible, you must compute NCI at fair value. In practical life, I am talking about, correct? At your level, how we are going to proceed, I will let you know in a short while. So in this question, let me compute the value of the NCI and what we mean by the value of NCI. Correct? Let us have a look over there. Suppose if I am going to ask you in this particular, I have a habit of asking, especially when I take the live classes, correct? I have a habit of asking lots of questions. Now you let me know, what is the amount of NIFA? Sir, what is this NIFA? First of all, please explain. NIFA means net identifiable assets of acquiring company. Who is the acquiring company? E2 is the acquiring company. What is the book value of net assets? That is 110. We are not concerned at all with this. Correct? So we are not concerned with this. What we are concerned of with? We are concerned of with the fair value of the net assets on the date of acquisition, because on this date we have got the control, and on this date I have already told you net assets of subsidiary company or acquiring company is 110. and their fair value is 112. So the fair value of net assets is known as NIFA, that is net identifiable assets of what we call acquiring company on the date of acquisition. Correct? Net identifiable asset of acquiring company, that is E2, on the date of acquisition. So whenever I would say what is the amount of NIFA, correct, you must understand I'm asking you the amount of net identifiable assets of the acquiring company on the date of acquisition and their fair value. And we have seen that net identifiable assets were 112. Actually, I took 112. So 112 were net identifiable asset. 112. So 112 is the net identifiable asset. Is it clear to you or not? Fine, sir. Now suppose I am going to ask you, please compute the value of the NCI as per proportionate share of net assets basis. Suppose if I am going to compute, then how I am going to compute? On the date of acquisition, net assets of subsidiary company is equal to 112, and out of that, NCI share will be how much? First of all, you let me know. If suppose you have got the control, how much control you have? 70% control. 70% of the share capital is in your hands. So quite obviously that means non-controlling interest holders are 30%, other shareholders. See here, when we say NCI, what we mean by that? Out of total share capital of E2, we have got 70% share. Quite obviously, it means 30% of the shares are in the hands of the other shareholders. Correct? And those other shareholders are known as non-controlling interest holders. Why they are known as non-controlling interest holder? Have you paid any attention to it ever? No. They are known as, the other shareholders are known as non-controlling interest holders because they are the shareholders of this entity. Quite obviously, they have got some interest in it, but they do not have the control in it. They have the interest, but they do not have the control. That is why they are known as, other shareholders are known as non-controlling interest holder. Is it clear to you? So now, when we say, or the standard says, on the date of acquisition, you have to determine NCI. What does it mean? It means standard is asking you to compute the amount of net assets of the subsidiary company appearing on the date of acquisition at fair value. Out of that, how much actually net assets or how many net assets worth of belong to NCI. This is what we mean by NCI. Is it clear to you? So on the date of acquisition, we have seen that NIFA, as far as NIFA is concerned, I'm talking about NIFA. So net identifiable assets of the subsidiary company or the acquiring company on the date of acquisition is 112 and NCI share is 30%. So I will simply take 30% of 112. Now, for that, I will have to take the help of the calculator. Correct? So 112 into 30%, that comes to 33.6. Anyway, 33.60. So out of 112 worth of assets, 33.60 worth of asset belong to NCI. On the date of acquisition, when I say NCI is 33.60, what does it mean? Now, as a professional student, you must understand, it means that out of the total net identifiable assets of the acquiring company, 33.60 worth of net assets belong to actually NCI. Is it clear to you or not? If it is clear to you, it also means, just pay attention, it also means I'm not only explaining the concept of NCI, I am doing something else also. Out of 112 worth of assets appearing on the date of acquisition of acquiring company, if 33.60 belong to NCI, what about the remaining asset? Let me subtract 112. So remaining asset is equal to 78.4. Remaining asset is equal to 78.40. What does it mean? It means actually that this is acquirer's share. Acquirer means E1's share. Acquirer's share. Acquirer's share of net assets. Acquirer's share of net assets in NIFA, net identifiable asset of E2, that is acquiring company. Acquirer's share of net assets, correct, in NIFA of what? Of what we call acquiring company on the date of acquisition. You need not require to write so many words. You can simply write acquired share. This is just to make you understand and comprehend better. I hope you got a bit of idea actually. When we say NCI, the next step is NCI. What does it mean? It means on the date of acquisition, we have to find out what worth of net assets belong to actually other shareholders. And for that, you have two options. One, you can use PSNA method. When I will compute the NCI, in this manner, it is known as proportionate share of net assets. It is known as proportionate share of net assets. Is it clear to you? Because here we are simply taking the proportion of the net assets, 30% of 112. So it is known as proportionate share of net assets method. However, we can compute the NCI, as I told you, as per fair value also. As per fair value also. Suppose if I would have computed NCI as per fair value, how I would have computed? In this case, when you will compute the NCI as per fair value, in this case, you will have to look towards the consideration which you have paid to acquire the control. For example, in this particular case, in order to get 70% control, you have given 140 lakhs rupees. Is it clear to you? So, first of all, you will write here 70%, for 70%, amount paid is 140 lakhs. Suppose, just imagine for a while, as an investor, you are investing in some other entity, correct? As an investor, you are investing in some other entity and you are going to buy 70% of the stakes of the other entity. Now, other entity is not going to sell you simply at what we call carrying value of their share capital. They will take into account the fair value of their shares. So generally, when we say that we are paying 140 lakhs, 100 lakh, 120 lakh to acquire the control, it always means that you are paying this amount on the basis of the fair value of the shares. Is it clear to you or not? Is this point is clear to everyone? Please let me know of that. When I say that as an investor, I am going to invest in some other entity, obviously the other entity will also insist upon this particular fact that we should consider the market value, fair values, and accordingly you will have to churn out the money. Is it clear to you? So that means 140 lakhs worth of consideration which we have paid to acquire the control. It is based upon the fair value. Is it clear to you? So for 70%, if the fair value is 140, so now you can construe this one as follows. For 70%, you are paying what we call 140 lakhs. If you would have acquired 30%, 30% is the what we call NCI interest, correct? So for 30%, what value you would have churned out? That is 140 into 30 divided by 70. Now, 140 into 30 divided by 70. That comes to, according to my calculation, it's a pretty high figure. No problem at all. This time NCI is 60 lakhs. Now suppose I am going to ask you on the date of acquisition, what is the NIFA? Net identifiable asset. The net identifiable asset of acquiring company on the date of acquisition we have already seen is equal to 112. And out of 112, this time, because we have computed NCI on the basis of the fair value, so that means 60 lakhs worth of assets, 60 lakhs worth of asset out of 112, it will be presumed belong to NCI, correct? Only the remaining amount. Now, what is the remaining amount in this particular case? Remaining amount, I think, will be equal to 62. So, in this case, acquirer share will be equal to 62. However, we will see later on, and I will prove to you that ultimately whether you are going to value NCI either at proportionate share of net assets basis or what we call at fair value, ultimately it is not going to have any what we call effect or impact. At this moment, you might be wondering, sir, in this case NCI value is quite high in comparison to the value of this one. You might be wondering in this manner, isn't it or not? I'm very sure about that. But as I will prove it after some time, that ultimately it is not going to have any effect. So there are two options available with respect to calculation of the NCI. Now, the last step, under the last step, standard says that when you do the accounting, as somebody told me it is 52. Thank you, Sam. It is 52. Okay, whatever figure it is. So I hope now you got this conceptuality absolutely clear with respect to NCI. Now we come across over the next point. The next point deals with computation of. Standard says that on the date of acquisition, acquirer company must compute goodwill or gain on bargain purchase. Computation of goodwill or gain on bargain purchase. Gain on bargain purchase. Some small question definitely are going to strike in the examination out of this particular topic. Computation of goodwill or gain on bargain purchase. Gain on bargain purchase, it is a pretty long term. Gain on bargain purchase. So I will use the short form GOBP. Gain on bargain purchase. Correct? Henceforth, I will use this abbreviation for gain on bargain purchase. Well, in order to compute the gain on bargain purchase, it is very simple. In fact, you have already learned that. Now I will tell you. In order to compute the gain on bargain purchase, all what you have to do is simply, first of all, you will take into account the NIFA. And you know the meaning of NIFA now. Whenever I am going to use the word NIFA, what does it mean? It means net identifiable assets of acquiring company, on the date of acquisition. On the date of acquisition. Of course, NIFA will always be considered at fair value. Is it clear to you? First of all, you will have to find out the NIFA, and it will always be available in the question. Out of that, all you have to do is to pluck out the share of NCI. Correct? As I did earlier. In order to do the computation with respect to what we call goodwill or gain on bargain purchase, what you have to do is simply take into account the NIFA on the date of acquisition, and then you find out the NCI. You can find out the NCI as per the directions given in the question, or as per your own will or discretion. You can compute NCI either through what we call PSNA basis or through fair value basis, but generally the direction is given in the question. Anyway, whatever methodology you apply, you will compute the NCI value. Once you have the NCI value, remember one thing, never ever commit this mistake of computing directly acquirer share. Otherwise it could land you in trouble. Is it clear to you? Once you have the NCI value, then you deduct this value from the NIFA. And then you find the remaining net asset as acquirer share. Now, whatever remaining assets will be there will be known as acquirer's share of net assets. Acquirer's share of net assets in acquiring company on the date of acquisition. Is it clear to you? So whatever remaining assets will be there, that means this much of asset actually belong to acquirer company. Now you are going to compare this value with the consideration which you have paid. Consideration. Now you are going to compare this value with the consideration. You might have paid some consideration. So, you must have paid some consideration, not might have. You must have paid some considerations. It means that by paying this much of consideration on the date of acquisition, you are getting hold of this much of asset. So, you are going to compare this. If the consideration amount is higher, then the difference will be, if consideration amount is higher, remember one thing, then it will be equal to goodwill. If consideration is more, then the share of net assets, then it will be goodwill. In the reverse situation, there could be gain on bargain purchase. Is it clear to you or not? Very easy to compute it. Now, after having taken care of all these things, now we are in a position to take a step towards something else, and pay attention here. Here I have kept the notes with me, and if you have the notes, the problem is that I'm not very sure whether you are having the books or notes right now or not. But anyway, I would insist upon you kindly, when we meet in the next session, at least you should have the notes so that you should not have any difficulty otherwise without that. Anyway, now we start with first section. I've already told you we have divided the entire section, entire chapter into 24, 23 or 24 sections. And this is the first section. In this particular section, as you can see, we have kept questions related to computation of goodwill or non-controlling interest or gain on bargain purchase. Correct? Now we are picking up question number 1 to start the proceeding. Here it states that FX Limited acquires 100% of MX Limited. Kindly tell me who is the acquirer company. The acquirer company is FX Limited. And in this case, which company is acquiring company MX Limited? How many shares you are getting? 100% of the share capital. So what is the NCI, sir? NCI is 0. So in this case, NCI is 0. Correct? So because entire share capital is in our hand. And in order to get 100% share, how much we paid? We paid 9,60,000. Further, it is given fair value of acquiring company MX at the time of acquisition is 8 lakh. The day on which we acquired the control, on that particular date, the net assets of subsidiary company, were appearing at a fair value of rupees 8 lakh. In this case, as I told you, you are supposed to calculate the goodwill and you are supposed to pass the entries. You can do it very easily of your own, but just because I do not want to take the risk, I have a habit of what we call, where is the space? Well, I will solve it for you. Don't worry about it. All this question is given in a solved manner, but I would love you to still keep on writing with me. Correct? Now, in this particular case, first of all, we are supposed to compute the amount of goodwill. Now, please quickly tell me how I am going to compute the amount of goodwill. First of all, what I am supposed to do, I am take into account NIFA. When I say NIFA, it means net identifiable assets of acquiring company on the date of acquisition at fair value. I'm not writing completely, but I'm simply writing NIFA. Now, we have already seen that 8 lakh is the value. So I'm going to write here 8 lakhs. Correct? Out of 8 lakh worth of NIFA, all I want to know now, what is NCI share? Correct? Sir, in this question, there is no need for NCI. Right, you are absolutely right. In this case, there is no NCI, but still, just to make the point a little bit clear, NCI is 0 in this case. Why? Because NCI is not having what we call any percentage of shares. Entire share capital is in our hand. So whatever remaining assets are there, quite obviously remaining assets are 8 lakh now. So that means acquirer share will be how much? Acquirer share of NIFA will be equal to 8 lakhs. Entire what we call amount of NIFA will belong to, in this particular case, acquirer. So that means on the date of acquisition, when we got hold of what we call other entity, we got 8 lakh worth of net assets. But how much amount we paid for the same? We paid 9,60,000. So I just told you a moment ago. Now all I have to do is to now simply compare it with the consideration. So consideration amount, as we can see, is 9,60,000. Now you tell me the consideration amount is more or less. So consideration amount is actually higher. So now you tell me, should I write here gain on bargain purchase or goodwill? Sir, you must write goodwill. So goodwill is equal to how much? That is equal to 1,60,000. In this case, amount of goodwill will be equal to 160. Very simple. Is it clear to you? Question has also asked us to pass an entry. Suppose if I am going to ask you in the books of acquirer, what entry you are going to pass? What entry you are going to pass? First of all, you have to think very coolly what you are getting. I mean to say, in this particular case, it is given that net assets of acquiring company appearing on the date of acquisition is 8 lakh. Quite obviously, first of all, you are going to record those assets because net assets are given. So I will simply write NIFA, net identifiable asset, account debit, 8 lakh. This is the fair value because we have to record the things at fair value, 8 lakh. Generally, when we have written here net, it means we have included assets and liability both. Generally, after writing this, generally from next time, you must write here 2 NCI. In this question, there is no NCI, but had it been there, I would have written 2 NCI. Is it clear to you or not? By writing the NCI on the credit side, it means I am subtracting the NCI share from this particular amount. Is it clear to you? But in this question, there is no NCI. Now we are going to write here regarding the consideration. Now, as a professional student, you should not give any chance to the examiner to deduct your single mark. For example, once again, I would take you to the question. Just pay attention why I am stressing upon even for such a low intensity question. Here it is written FX Limited acquired 100% of MX Limited for rupees 9,60,000. Whenever the wordings will be like this, for rupees 9,60,000, always presume that you have delivered the consideration in cash. Is it clear to you? That means from next time you will have to keep an eye whether the purchase consideration is delivered by the acquirer entity, what we call through cash or by way of share capital. That is the point actually. These are the minor things which I would love you to pay attention to, and that is the reason actually why I'm doing this particular question. So now we will have to write here. What should I write? Should I write to share capital or to cash? And in case if you get confused, you can simply write consideration at least. Is it clear to you? In bracket, I am writing consideration. So this is the amount of consideration which we are paying, 9,60,000. 9,60,000. Even through this particular entry, we can derive this figure. By taking the difference, we will again get what we call goodwill, that is equal to 1,60,000. Is it clear to you? Now we pick up second question. In question number 1.2, what is given to us? In 1.2, it is given that on 31st of March 2023, K9 Limited, this time K9 Limited is the acquirer entity, it acquired L5 Limited. L5 Limited happens to be your acquiree entity. K Limited issued 60,000 shares. How many shares we have issued? 60,000 shares. It means this time you are delivering the purchase consideration by way of shares. Correct? So K Limited issued 60,000 shares of rupees 10 each at par value. The par value of 60,000 shares, 60,000 into 10 is 6 lakh. But that were trading in the market at 240. That means you are issuing 60,000 shares. We are, in this particular case, we are issuing 60,000 shares at the rate of 240 indirectly, it means. Is it clear to you? Because it is given the par value is 10, quite obviously it means 230 is the premium. Very high premium. Anyway, so point you need to note is that your consideration amount will be equal to 60,000 into 240. Is it clear to you or not? Now further it is given book value, pay attention, book value of acquiring company's net assets was 72 lakh. This line is irrelevant for us because we are concerned with the fair value. It is given that the fair value of the net assets was assessed at 135 lakh. In this case, fair value is 135 lakh. Now quickly, without looking at this solution, quickly within a flick of second, let me see who gives me the answer. Now please tell me, what is the stake of acquirer company in the acquiring company in this question? In the last question, it was given that we acquired 100% control. Now I would love you to actually give me the answer. What is the proportion of our what we call interest in the acquiring entity? 80%, 90%, 70%. Question looks very innocuous, no doubt about that. Very innocuous question. Very innocuous means actually very simple sort of question. Correct? Very innocent question. Let me have the answer. First answer came from Ashok Das, 100%. So Well, correct answer, absolutely. If in the question, pay attention. Actually, these are the things student fraternity never pays any attention to. And in the examination, they unnecessarily waste their time. Whenever in the question, percentage will not be given without an iota of doubt and without any hitch and hish, you have to come to the conclusion that you have got 100% stakes. So even in this question, 100% of the stakes are in the hands of what we call, correct? Right. Absolutely. You are right. Absolutely. So in this question, suppose if I am going to ask you again the same question, how you are going to compute the amount of goodwill, because question is simply telling pass the entry under Ind AS 103, but just to practice a way bit, NIFA, first of all, and I have given you very simple steps of computing goodwill. NIFA, it means net identifiable asset at fair value of acquiring company, on the date of acquisition. On the date of acquisition, it is equal to 135 lakh. So first of all, you will write this value, 135 lakh in this case. Is it clear? Now, all you have to do is to divide it NCI. It is not necessary, but just to keep the approach intact. Obviously, because no question of NCI in this question, so nothing will belong to NCI. Everything will belong to parent, 135 lakhs. 135 lakhs. Everything will belong to parent company. This is acquirer share. Acquirer share. Now you will have to compare it with the amount of consideration. What is the amount of consideration in this particular case? In order to know the amount of consideration, you will have to multiply it 60,000 with what was the amount given to us, 240. So 60,000 into 240 will be equal to 144 lakhs. Will be equal to 144 lakhs. Again, your consideration amount is exceeding the what we call your share. So quite obviously, again this time you are going to have goodwill, and goodwill will be worth rupees 9 lakh. Goodwill will be worth rupees 9 lakh. Is it clear to you? Suppose if I am going to ask you, what will be the entry? You can pass the entry in this manner. Here it is written. First of all, you will have to write the net identifiable asset, 135 lakhs. Then see here what I have written, to capital. If you ever get confused that should you write cash or capital, at least for God's sake, write consideration payable. Is it clear to you? Otherwise, if you can write it in this manner, that's fine. So capital, what will be the amount of capital? 60,000 share into 10, 6 lakh. And what will be the amount of premium? Instead of writing premium, you can also write additional capital account. Many among us actually do not know this. Premium is also known as additional capital. Correct? So this is the point. What will be the amount of premium? 60,000 into 230, that is equal to 138 lakh. If there would have been NCI, I would have written 2 NCI also. NCI is not there, so 9 lakh will be your goodwill. Goodwill can be extracted even through this particular entry. 1.3, let's have a look over it. In 1.3, it is stated that A Limited acquires 80% of B Limited for rupees 9,60,000. Now, in this question, A Limited acquired 80% stakes in B Limited and they paid a consideration of 9,60,000. Correct? And this consideration was paid by equity. However, equity share capital was issued at par. Now it is given that fair value of B's net assets at the time of acquisition amounted to 8 lakh. Question is not very tough, but at the same time, let's have a look. Calculate non-controlling interest and goodwill. Question states first, and then journal entries in the books of A Limited. To this particular question, actually, I just want to explain 2-3 points. And that is the reason actually I am picking up this question. Just let me create a bit of a space for me so that it becomes easier for me and for you too also. Now I will rub it out. What happens? Sometimes this pen creates problem. Okay. Little bit of space I have created. Now, my first point to you, what is the amount of NIFA? Whenever we say NIFA, it means net identifiable assets of acquiring company on the date of acquisition at fair value. It is clearly given in the question 8 lakhs. Some of you might be wondering actually why I am doing this question. You can manage it of your own. No doubt about that. You can manage it of your own very easily, but if I am doing, there must be a reason behind that. Now, pay attention. Now I would love you to compute the amount of NCI. How will you compute? We are supposed to compute NCI. Because in this question it is not clearly mentioned, should we go for PSNA method? That means there is no direction in the question. Is there any direction in the question? There is no direction in the question that NCI need to be computed either at PSNA basis or what we call on the basis of fair value. Now, in that case, you have the option, correct? Whether you want to use PSNA method or you want to use PSNA fair value method and append a note, whatever methodology you have adopted. Let us say I adopt PSNA approach. PSNA approach. Under proportionate share of net assets method, we simply take the percentage of NCI, which must be 20%. Because 80% shares are in our hand, isn't it or not? 20%. And we will take 20% of 8 lakh. 20% of 8 lakh, it means out of net identifiable assets of 8 lakh, 1,60,000 worth of net identifiable asset belong to NCI as per this particular approach. Now, acquirer share. What will be the acquirer share? A's share. A is the acquirer company. A's share of net assets. So A's share of net asset will be equal to how much? If I am going to deduct the same, that will be equal to 6,40,000. In order to compute the goodwill, pay attention actually, I am going to explain something else in this question also. Ultimately, I will have to compare this amount with the amount of consideration. I have told you now on several occasions. Consideration. What is the amount of consideration in this particular case? In this particular case, we acquired 80% control by paying 9,60,000 rupees. Isn't it or not? So I am going to here write 9,60,000. Now you tell me whether there is goodwill or gain on bargain purchase. Because consideration is more, so we are still having goodwill. We are still having goodwill. Correct? Suppose if I would have had used what we call, instead of PSNA method, let us say if I would have had used fair value methodology. In that case, what would have been the scenario? That means whenever we are going to compute NCI at PSNA basis, in that case, obviously there will be some amount of goodwill. And when we are going to compute NCI on fair value basis, again there will be some amount of goodwill, but obviously the amount of goodwill will not match. But now I will try to prove you, as I told you earlier, even though NCI can be measured either at PSNA or what we call on fair value basis, but ultimate effect will remain same. I will prove that in a short while, but just pay attention. Let us say same question I am solving now, taking what we call NCI at fair value. So in order to consider NCI, again I write NIFA. Amount of NIFA was, net identifiable asset was 8 lakh. 8 lakh. So I will write here 8 lakh. Then I am going to write NCI. And I will have to compute NCI at fair value in this case because I want to compute NCI at fair value. In order to compute the NCI at fair value, what I am supposed to do? For 80%, we are paying 9,60,000. Isn't it or not? For 80%, we are making a payment of 9,60,000. Correct? So now I will take 20%. So what will be the value of 20%? That is equal to 20 into 9,60,000 divided by 80. So how much it will be? I think it will be equal to 240. 960 divided by 4. Yes, it comes to 2,40,000. So in this case, out of total assets, total net assets on the date of acquisition at fair value 8 lakh. Out of total assets of 8 lakh, 2,40,000 worth of asset belong to NCI. Is it clear to you? Now in this case, whatever remaining assets are there, so I will subtract 240 from 8 lakh. If I am going to subtract 240 from 8 lakh, so what will be the value? From 8 lakh, I think it is equal to 5,60,000 if I am not wrong. Please see to it, please check it. So this will be acquirer share. Acquirer share in this particular case will be equal to this much. Let me also check. 800 minus 240, that is 560. Okay, now consideration. Consideration is 9,60,000. In this case, you can see the amount of goodwill is actually 4 lakh. In this case, amount of goodwill is 4 lakh. Correct? Till up to this particular stage, things should be clear. That being, standard actually allows an option to the entities that it is entirely, purely the discretion of the directors of the acquirer entity whether they intend to value the NCI on PSNA basis or at fair value basis. Obviously, if they are going to adopt PSNA basis, amount of goodwill will be there, but it will differ if we would have computed the amount of goodwill by considering NCI at what we call fair value, as is happening in this particular case. We can see in this particular case, amount of goodwill, when we compute it on PSNA basis, NCI share is 320, while in this case, it is 4 lakh. But I also told you it is not going to have any impact later on. How and why I am saying so? Please pay attention. See here, what will happen later on, ultimately, why we are doing all these things on the date of acquisition. The ultimate aim is that we have to prepare the consolidated financial statement. So later on the date of acquisition, when I am going to prepare the consolidated financial statement, pay attention here. When I am going to prepare the consolidated financial statement, now you tell me what amount of goodwill I will write here if I have computed NCI on PSNA basis. If I have computed NCI on PSNA basis, obviously the amount of goodwill is 3,20,000 and I am going to reflect this goodwill over here, 3,20,000, correct? And NCI share is 160 and NCI is reflected towards the liability side, 1,60,000. However, it is written under what we call other equity item, but as a separate line item. Anyway, I do not want to confuse you at this moment. At this moment, you simply focus over here that whatever goodwill we got, we are ultimately going to reflect it in the consolidated financial statement, and NCI share will also be reflected over here. Now pay attention. Whenever goodwill, which we arrived at by taking PSNA, by taking NCI at PSNA, in such a situation, this goodwill is also known as proportionate goodwill. This goodwill which is appearing in the balance sheet is also known as proportionate goodwill. What does it mean, proportionate goodwill or partial goodwill? It is also known as partial goodwill, partial or proportionate goodwill. And what does it mean? What does it mean? It means this goodwill belongs to acquirer only. This goodwill belongs to acquirer only. That means this amount of goodwill belongs to acquirer only. In this goodwill, there is no share of NCI. Is it clear to you? Whenever NCI is computed at PSNA basis, amount of goodwill which gets reflected in the consolidated financial statement, it reflects the partial or proportionate share. Indirectly, it means it shows the share of acquirer only, share of parent only. Is it clear to you or not? Please quickly tell me. If it is clear to you, please quickly tell me then. Is it clear to you or not? First of all, please let me know, and let me know honestly. Then only I will proceed. Right. Wasim says clear. What about else? I hope you got this particular point. I'm trying to prove that even though whatever approach we adopt to compute NCI, ultimately it is not going to have any impact. I will tell you now. Thanks Mahesh also and Ashok also. Now everyone has given me the reply. Shruti Senapati. I hope I have pronounced correctly, and Yuvashri Varshani. Fine. Now just have a look over here. In this case, in case number B, when we computed NCI at fair value. In this case, later on when I am going to prepare my consolidated financial statement, now you let me know what amount of goodwill I am going to reflect. I am going to reflect amount of goodwill. Obviously, the amount of goodwill was 4 lakh, so I will have to reflect the goodwill amount at 4 lakh only. No doubt about that. I am going to reflect it at 4 lakh. correct? And then I'm going to write NCI also. Now, in this case, NCI share is 2,40,000. So 2,40,000. In this case, in this particular case, goodwill which is appearing in the balance sheet is known as full value of goodwill. It is known as full value of goodwill. This is full cost method of goodwill also. Suppose if a particular question says to you, compute the amount of goodwill on full cost basis. Immediately it must strike to you that in this case you will have to compute the NCI at fair value. Because goodwill you cannot get at full cost unless you are going to compute the NCI at fair value. Is it clear to you or not? So that is why these terms you must be aware of. For example, a particular question may ask you to compute the amount of goodwill on proportionate basis. Compute the partial amount of goodwill. Indirectly, it means you have to take NCI at PSNA basis. That is why you need to be very well acquainted with all these particular terms. Anyway, this is known as full cost of goodwill or full value of goodwill. And when we say full value of goodwill, indirectly what we are trying to say that in this goodwill, both the parties are having some stakes. Both the parties. Who are the parties? One, acquirer having 80% stakes and NCI having 20% stakes. Now suppose if I take 80% of 4 lakh, you can see in this case, still the share of acquirer is 3,20,000. Still the share of acquirer is 3,20,000. Are you getting my point or not? So try to understand, even though standard says that entity has the option to compute NCI either at what we call PSNA or on fair value basis, but ultimately it is not going to actually impact the financial statement, provided you have the knowledge to diagnose the what we call financial statement. Is it clear to you or not? Did you like all these things or not? Fine. It is nice to see you. Now we have 1.4. 1.4. In this particular question, it is given Jet Limited acquired 60% interest in P Limited on 1st of January 2023. How much interest? 60% interest. Jet Limited paid 700 lakh in cash for their interest in P Limited. The fair value of P Limited asset is 1,800 lakhs. This time fair value of assets and liabilities are given separately. Although it is not going to have any effect, that means 1,800 minus 900, that is total net assets will be equal to 900, correct? Question says that provide the journal entry for the acquisition using Ind AS, assuming that P Limited does not wish to report the NCI at fair value. Now in this question is absolutely clear that entity is not interested in computing the NCI at fair value. So indirectly it means you will have to compute the NCI at PSNA basis. Is it clear to you? Now I am not solving this question. You can easily do this question. All you have to do is, if you want to have a good presentation, you can move in this manner. Say here, first of all, you will write NIFA. And if you can write in this manner, 100% of fair value of net identifiable asset. 100% of fair value of net identifiable asset. Fair value of asset is 1,800. Fair value of liability is 900. So quite obviously, assets minus liability will deliver you net assets, that is net identifiable asset. So on the date of acquisition, net identifiable asset is 900 lakhs. Correct? Further, in this case, we have to compute NCI on proportionate share of net assets basis. Because 60% stakes have been held by the parent entity, quite obviously, NCI share will be 40%. You take 40% of 900. So out of 900, we may say 360 worth of net asset belong to NCI. This is also the value of NCI on the date of acquisition. Is it clear to you? And then I am going to subtract. By subtracting 360 from 900, we get 540. This 540 simply reflects share of acquirer in net identifiable asset on the date of acquisition. Then we have to compare it with the amount of consideration. The consideration amount is 700 lakh. And again, in this case, you can see the consideration is exceeding what we call your net assets. So quite obviously that when you have paid more and you received less, that is why it is goodwill. So goodwill will be equal to 160. Now suppose in this question, just to understand you a little bit better, even though question is not asking, suppose I say, if you would have computed the value of NCI on fair value basis, let us say, if you would have computed NCI on fair value basis, how you would have computed? You would have computed in this manner. For 60% we are paying 700 rupees for consideration. So how much we would have paid for 40%? 40% is NCI share, correct? So that is 40 into 700 divided by 60%. And that will be equal to 467. So in this case, NCI value would have been 467. Now in this case, what would have been the amount of goodwill? Let's have a look over here. 100% of net identifiable asset is 900, as we know. Out of that, we are going to subtract the NCI because we have taken NCI now at fair value. I will subtract 467. So 433 worth of assets are now remaining. So share of acquirer in the net identifiable asset will be equal to 433. And obviously the consideration which we have paid is equal to 700 and amount of goodwill will be equal to 267. Suppose in this case, if I ask you to pass the entry, see, there is a way to pass the entry also. Always, first of all, if assets and liabilities are given, in this question, assets and liabilities are given in a segregated manner. It is better to first of all write identifiable asset. Don't directly write net assets because in this case, fair value of asset and fair value of liabilities are given separately. So you are going to first of all write identifiable asset 1800 and then you are going to write identifiable liability 900. That means when I will write 1800 and 900, indirectly it means I have so far recorded net identifiable asset to the extent of 1800 minus 900, 900. Correct? After writing these two things, then you must write NCI. It is always better to write NCI first. Is it clear? To NCI 467. That means when I am writing 467 here, correct? Suppose so far I have written these three items, assets, liability and NCI. Indirectly, it means I have written only this much of amount 433. Indirectly, it means I have written this amount. And what is this amount? It shows the parent share of net assets. Isn't it or not? And then you write consideration because you are delivering the consideration by way of shares. You better write to capital 700. So now when we are writing to capital, indirectly it means I am comparing what we call these two items. And so that is why the balancing figure will be goodwill or gain on bargain purchase. Is it clear to you or not? Absolutely clear. If it is clear to you, now we will take 1.5 also. What does 1.5 states? On 1st of January 2023, pay attention here. On 1st of January 2023, M Limited acquires 80% of equity interest in P Limited in exchange of rupees 250. What does it mean? It means you have got 80% interest. You have got 80% interest. And how much amount did you pay for the same? 250. Correct? And you paid that in cash. Net identifiable assets are measured at 350 and liabilities are measured at 50. That means net assets on the date of acquisition 350 minus 50 will be equal to 400. But further it is given the fair value of 20% non-controlling interest is 43. What happens? I have seen on many occasions. During my 3 decades of experience that sometimes student in the heat and anxiety of the examination never go through the entire length and breadth of the question, and in the harakari they commit some mistake. What I mean to say here, for example, in this particular question we know that we have got 80% interest and NCI interest is also 20%, and here it is written the fair value of 20%. What the student actually presumes that they have to actually find the NCI at fair value. Without going further, actually the value is already given to you. It is given that fair value of 20% non-controlling interest is 43. So you need not require to do anything in this particular case because fair value of NCI is already available. There is no point in actually unnecessarily computing the fair value of NCI in this case. So you can easily manage this question of your own. Amount of net identifiable asset 350 minus 50 will be equal to 300. NCI value on the basis of fair value is given to you already 43. So whatever balance is there that belongs to acquirer, compare it with the what we call consideration in this case. And this is the first question. In this case, we come across here that consideration amount is 250, while net assets which we are getting is equal to 257. So it is a gain to us. It is known as gain on bargain purchase. And just for your knowledge sake, actually in practical life, to be very, very honest with you, gain on bargain purchase can never ever arise. What I said, in practical life, correct, in reality, in substance, gain on bargain purchase can never ever arise. I will just prove it within a flick of second. Suppose you have a business, correct? And net assets, that is assets minus liability, net assets of your business is equal to 1000 lakhs. And we presume you are a very prudent business, correct? That means whatever you do, you always think before that, before leaping into the conclusion. Suppose today I want to buy your business. Would you be ready to actually accept any figure less than 1000? Because in that case, you will incur a loss. The value of your business, net assets, is equal to 1000. Quite obviously, being a prudent businessman and of high amount of wisdom, you are not going to actually accept anything less than 1000. You will insist upon definitely a figure more than 1000, but definitely you are not going to sell your business at a figure below than this. That is why I am telling in practical life, generally we do not have concept of gain on bargain purchase. Now you may say actually, sir, if there is no concept of gain on bargain purchase, why Ind AS 103 is talking about gain on purchase? This is the most relevant and pertinent question. I tell you. I told you first that in reality, under normal circumstances, gain on bargain purchase can never arise. However, under rare circumstances, it could arise. Now I am redefining my words. Under rare circumstances, gain on bargain purchase arise. As a professional student, you need to know what are those circumstances. For example, let us say there is an Indian company. This Indian company is operating in UK. This Indian company is operating in UK. Are you getting my point or not? Let us say because of some political situation or political turmoil in UK, correct? What happened? Their competition commission has decided. Competition commission basically means is a commission actually which governs the affairs of the corporate sector. In almost every country there is a competition, so that competition can be made fairly, correct? Anyway, let us say the competition commission of UK has decided that all the foreign companies must leave the UK within next 1 year. Suddenly they came out with this diktat that you will have to leave the UK territories within 1 year. Now it's a big Indian company operating in UK, but because of this particular diktat, they will have to now leave the UK shores. Now you tell me, quite obviously in this particular case, this particular entity will be under a sort of force, will be under a sort of foundation, under some pressure. So they will have to sell their business. And in this particular case, they might agree to sell their business at a value lesser than the what we call fair value of their net assets. So in that case, gain on bargain purchase could arise. Standard not only stops here, standard also says that in case if an entity gets gain on bargain purchase in practical life, they must do a thorough rechecking whether there is gain on bargain purchase or not. This is just for knowledge sake. But point is that this knowledge will hold you in a very good state. You remember me and you will remember me. No doubt about that. I'm very sure that whatever I'm telling you, something extra, definitely out of that 80%. I'm not telling 50%, 10%, 80 or 90% you will face in your interviews. Correct? That is the reason actually I keep on telling to you. Anyway, I think I have solved this question. Okay. 1.6, just have a look over here. In 1.6, what we are getting. On 1st of January 2023, Hansa Limited acquired 70% of the equity interest in Nainital Orchards Limited. in exchange of consideration of 700 lakhs. Again, it is given identifiable assets are measured at 1,500 and liabilities are 600. So you can manage this question. In this question, we have to compute NCI at fair value and goodwill, and we have to compute NCI on proportionate share of net assets basis and also the goodwill. So in simple words, question is asking you to compute. First of all, you have acquired 70% stakes in this particular case, number one. Number two, you have paid 700 lakh rupees. And number three, the net assets on the date of acquisition is equal to 500 minus 1,500, that is 900. So suppose, now first point here, NCI on fair value basis. Let us say we are computing NCI on fair value basis. In that case, what will be our amount of goodwill? First of all, here I write net assets. 1,500 minus 600. Now I will compute the fair value of the NCI. You know now how to compute, correct? NCI, because we have paid a consideration of rupees for 70%. For 70%, we have paid, just wait. For 70%, we have paid 700 rupees and NCI share is 30%. So what will be NCI at fair value? Obviously, in this case, it will be equal to 300, correct? 300. So you can easily find out fair value of NCI, that is 300 rupees. By subtracting this figure, you will get acquired share 600 and you will compare it with the amount of consideration which you have paid. So you have paid 700 and acquired share of net asset is equal to 600. In this case, there will be goodwill. So in this case, when NCI is measured at fair value, we are getting a goodwill of 100. And you can pass the entry. I told you best way of passing the entry, first write the asset, then write the liability. That means you have now so far written net assets, compare it with the NCI, and then write the consideration, then better write the amount of goodwill. In second case, if you would have adopted proportionate share of net assets basis, in that particular case, NCI share would have been 270. Because total net assets 1,500 minus 600, 900 into 30%, 270 would have been the share of NCI under PSNA basis. Then you can easily find out the amount of goodwill. See, net asset is 900, NCI share is 270. So remaining asset means share of acquirer in the net assets of acquiree will be 630. And you will compare it with the amount of consideration 700 lakhs. So in this case, your goodwill would have been 70. Now quickly tell me, this goodwill ultimately I am going to reflect in the consolidated financial statement. By what name it is known as? Of course, I will write goodwill, but what else actually it is known as? I told you earlier, this 70 lakh now which will appear in the consolidated financial statement, what will you call it? Will you call it full value of the goodwill or partial value of the goodwill? It will be partial value of the goodwill, correct? Just with respect to common control. And when we say common control, directly, indirectly, it also means we are going to have a bit of discussion with respect to terms like demerger, spin-offs, or sale of division. In fact, we will see later on that all these terms are used actually synonymously. But before we proceed further, let me also caution you that it's a pretty important, formidable topic. And in case if the question would strike from this particular topic, then surely you are bound to get a very long question, and definitely it would comprise near about what we call 16 marks, correct? It's a pretty strong topic, but not very tough. Don't be under a phobia that this topic is very tough. And T. Shruti Sinapati, good evening also. So now we start today's this particular session. As usual, kindly you all are requested to please pull out your pen, pencil, register, whatever it is. It is always better. I keep on telling and keep on insisting that it is always better to actually write the things, correct? Now, in order to understand the topic of common control, correct, what we have to do, just pay attention first of all here. First, let me write the topic. The topic which we are going to discuss today, as I told you, is common control. Don't think that you have the notes, and surely you all are going to receive books also. Correct? We have already dispatched the books. Common control, those who have purchased. Common control. This is the topic which we are discussing today. As I told you, In this particular topic, we are also going to talk about demerger, spin-off, sale of division. And this is a very strong topic. So I would love you to not only pay extra attention, but also, if possible, try to note down the things, correct? In order to comprehend this particular topic, please pay attention over here. We presume that there is a very big organization, correct? This is a very big organization. In order to make you understand, I have to do the things and things I have a habit of doing quite neatly as far as possible, although it is very difficult to write with this electronic pens, correct? We presume that this is a very big organization, correct? Very big organization. Number one, we have presumed that this organization is a very big organization, and we further presume that this particular organization has got two divisions, two separate divisions, because it's a very big organization and it has got two separate divisions. We further presume that there is division A and there is division B also, correct? There is division A and there is division B. This is a big organization, and this organization has got two divisions. When I say two divisions, let us say this particular division, division A, deals with computers. That means it is engaged in what we call manufacturing computers. Further presume that division B is engaged in manufacturing of mobiles, correct? So this organization, as I told you, is a very, very big organization, correct? Why I am insisting upon this particular fact, big organization, you will come to know about this particular fact very soon. And further, we have presumed that this particular organization has got two segments, two separate segments, correct? Segment A, segment B, or division A or division B. Presume that division A is dealing in mobile phones, and division B, let us say, is what we call dealing in computers. Since last 4-5 years, what we are noticing from the perspective of this organization, that this division, division B, is not functioning up to our mark or up to our expectations. What I intend to say is that suppose I happen to be one of the what we call key management personnel of this particular organization. Since last 2-3 years, actually, I'm noticing that this particular organization is not fetching us the sort of return which we are expecting, or perhaps this particular division is not at all fetching any returns. So we have taken a decision now that we are going to dispose of this particular division. So organization has decided now that we are going to actually simply sell out this particular division. Is it clear to you? So we entered into an agreement, let us say, with a company. For simplicity's sake, I will call it a new company or new entity, correct? For simplicity's sake, I will call it new entity. You can also say entity C. So we entered into an agreement with entity C, and we decided to sell off this particular division to this particular entity. Is it clear to you? So we have decided to sell off this particular division to this particular entity. Why this decision was taken? I have already told you the reason, because since last 4-5 years, this particular division is not functioning up to our mark. So up to our expectations. So entity has decided to sell off this particular division. Sell off this particular division to this particular entity. Try to understand this particular point. First of all, this is the big organization, correct? Very big organization. It has got two divisions, as you can see. Now one division has been sold to some other division. So you can say one part of this organization has moved out of this particular organization. Now this particular organization is left up with only division A, correct? So that is why when this particular organization will sell off one of its division to the other entity, in that particular case, the moment it is going to sell off the division, this organization will be termed as demerged entity. Many among us fail to understand properly the meaning of the demerged entity. Now this organization will be known as demerged entity. Is it clear to you or not? If it is clear to you, please keep on letting me know also. This will be known as demerged entity. This organization will be known as demerged entity. Demerged entity. Merger basically means combine. And demerged entity means we are getting separated from one of the divisions. So that is why the size of this organization has reduced, we can say in a common layman's language. So this entity will be known as, this organization will be known as demerged entity, because so often in the books, it will be later on, so many times later on in the questions, we will face that we have to pass the entries in the demerged entity. First of all, we know actually who is the demerged entity. So this organization has become the demerged entity. Is it clear to you or not? And this process, please pay attention. Please pay attention and don't let your focus to waver even for a while. Because if you fail to comprehend a single thing, then you won't be able to actually do the question the way actually I would love you to do. Is it clear to you? When this entity, as I told you, sold this particular division to a new entity, then this process will be known as, what? This process is known as sale of division. This process shall be known as sale of division. Sale of division. It is known as sale of division, or this process is known as demerger. This process shall be known as sale of division or demerger or simply split off. I already told you earlier in the beginning of the session that all these three terms we are going to use concurrently, and not only concurrently but also synonymously. I hope this particular point everything is clear. Please give me a very quick reply. Is it clear to you up to this particular point? Is it clear to everyone up to this particular point? Last time actually on Saturday when I did not take the class, I received some messages that today there was no class. It was already known to you, and I have already actually told in the last session itself that next class will be on Monday, because your classes time are Monday to Friday. Is it clear to you? But from next time on Saturday and Sunday, I will not be on live, but I will start Ind AS. Is it clear to you? So please keep this. I will remind you later on after the session. Is it clear to everyone? Fine. This process is known as sale of division or demerger or split off. Fine then. If up to this particular point it is very clear, then what next is? Now you know that we have sold one of our division to a new entity. We sold this particular decision due to some compelling factors. For example, that we were not having the expected sort of profit, or perhaps this particular division might be what we call incurring heavy losses. So due to whatever may be the reason, actually, we sold out to this particular entity. Number one. Now, many scenarios could unfold before us, and we should be absolutely well acquainted with all those scenarios, so that we can do the accounting in a proper manner. What exactly common control is, I haven't actually described it. Remember, one thing I will describe it later on. Now, when we are going to sell this division to a new entity, obviously, each one of you are absolutely in the know that we are not going to transfer the division free of cost. Obviously, the new entity will going to give us some consideration. Is it clear to you? Now, new entity can give the consideration. New entity may decide that it will give the consideration directly to the demerged entity. That means when you are going to solve the question, you will have to pay attention to this particular point, because this is going to be the one of the hell of a major point before, so that you can actually do the questions in a correct manner. So you have to see very closely and very what we call minutely who is receiving the consideration, because there are many scenarios, as I've already told you. The first one is that the new company may give the consideration to the demerged entity, and you know the meaning of demerged entity. Is it clear to you or not? So if in the question it is given that new company has given the consideration to the demerged entity, in this case, first of all, let me write here, purchase consideration, PC I am writing, and I'm marking it in this manner. That means in this case, new company is delivering the purchase consideration to the demerged entity. It means if the purchase consideration is being received by the demerged entity from the new entity without any hitch, and without an iota of doubt, you immediately come to the conclusion that this is a case of common control. I will explain the meaning of common control, but for a while just you simply write, then it will become a case of common control, because in this case Ind AS 103 proper will not apply. Correct? There are two methods prescribed under Ind AS 103 to do the accounting in the books of basically the acquired company. One is known as we have already seen earlier, correct? That is known as acquisition method. Whatever we have done so far in this particular chapter, that is what we call related to acquisition method, where we saw that on the date of acquisition, we have to record the assets and liability of fair value. With some exceptions also, we have to compute NCI, Goodwill, etc. So this is nothing but this is acquisition method. 99.99% in practical life under business combination, we come across only situations of what we call business acquisitions. Sorry, acquisition method only. 99% we have to adopt acquisition method of accounting only. Under rare situations, we may have to adopt common control. Remember one thing, many people actually think that common control is not a part of Ind AS 3. No, that is not the case. Common control is part of Ind AS 103, but it is a part of Appendix C. In Ind AS 103, there is an appendix that is known as Appendix C. Under Appendix C, you have been given common control. Is it clear to you? We will explain the methodology of what we call accounting of common control later on. But first of all, you need to understand in this case that if new entity will deliver the purchase consideration to the demerged entity directly, in this particular case, it will be known as common control. In this case, common control. This will be known as common control case. In this case, we will see later on that in the books of the acquirer, we are going to record all the assets and liability taken over at carrying amount only, not at fair value. Under common control, we will take over all the assets and liability at fair value only. That is the major difference. Is it clear to you? Otherwise, rest of the things are same. So, it will be treated as a case of common control, and as per Appendix C of Ind AS 103, when an entity does the accounting by adopting common control methodology, in that particular case, it is known as pooling interest method. P-O-O-L-I-N-G, pooling interest method. I will also explain you later on why it is also known as pooling interest method. I will try to give you as much as knowledge, but first, at this particular point of time, your focus should be only up to this particular point, whether it is a case of common control or not. Now, what we mean by common control, now I am going to explain. See here, earlier this entity, this division was quite obviously because part of our organization, it was in our control, no doubt about that. Now, this division has been transferred to a new entity. Is it clear to you? This division has been transferred to a new entity. And I told you that new entity has given the consideration to the what we call demerged entity. When new entity is giving the share capital, because generally purchase consideration is given in what we call shares only, and especially we will see that under demergers, etc. Generally, the consideration actually flows by way of share capital only. So that means whatever share capital of the new company is there, it has transferred that share capital to the demerged entity. Point to be noted is that even though this division has been transferred to a new entity, now this new entity is still in the control of the organization because share capital is held by the organization. When I say purchasing company new entity is delivering purchase consideration to the demerged entity, that means control of this entity is still in our hands. That means situation is exactly what it was prior to the sale of division. Even after the sale of division, the situation is similar with respect to control. Are you getting my point or not? Earlier, this entity was under our control, and this entity has been now transferred to new entity, and new entity is still in our control. So when such a scenario persists, that situation with respect to control reflects the same similar situation which existed prior to the transfer, then it is known as common control case. Is it clear to you or not why it is known as a case of common control? Because in this case, even after the sale of the division, the control of the new entity is in the hand of the organization. And if it is a case of common control, Ind AS 103 proper will not apply. Ind AS 103 Appendix C will apply. That means common control methodology we will have to apply, wherein we will have to apply pooling interest method to do the accounting. And under pooling interest method, as I told you, all the assets and liability will be recorded, not at fair value, rather at book value. There are some other what we call facets, which I will explain when I will do the question. Is it clear to you or not? I hope till up to this particular point things are clear. Now, this is the first scenario. This is the first scenario. Now, second scenario can be like this, that new entity may decide not to give the consideration, not to provide the purchase consideration to the demerged entity. Under the second situation, new entity may decide to give, under the second situation, new entity may decide to give the purchase consideration not to the demerged entity, rather to the members of the demerged entity. Rather to the members of the demerged entity. When I say members of the demerged entity, indirectly it means shareholders of the demerged entity. Under the second scenario, we will see that purchasing company has given the purchase consideration to the members of demerged entity, to the members of demerged entity, to the members of demerged entity, to the members of demerged entity. This is the second scenario. Now in the question, if it is given that the division has been transferred and new entity has decided to give the consideration to the members of the demerged entity, in this situation, there may be two more sub-situation may arise. Two more sub-situation may arise. What are those two sub-situations? Pay attention. If new entity provides purchase consideration, if new entity provides purchase consideration to the members of the demerged entity, then in that particular case, we will have to see what? A. It might be given in the question that new entity has given the purchase consideration to the members of the demerged entity, and further it may be given in the question that one of the member means one of the shareholder, one of the member has holds more than 50% of the share capital in new company. So if question states that new company has delivered the purchase consideration to the members of the demerged entity, and one of the members, it is further given that one of the members, because such sort of information will be given in the question, one of the members holds more than 50% of the stakes in the new entity, indirectly it means this entity is still in the hands of this organization. Why? Because this member is a shareholder of this organization, demerged entity, and he is having more than 50% of the share capital of this entity. Indirectly, it means this entity is still in the control of the organization. That is why, even in this case, it will be treated as a case of common control. Is it clear to you that even in this case, it will be treated as a case of common control? Even in this case, it will be treated as a case of common control. It will be treated as a case of common control. Is it clear to you or not? Right, sir, it is clear to you. Just wait. Let me create a bit of space. Okay. There could be situation like this, that new entity is providing purchase consideration to the members of the new entity, and now it is written in this manner. Suppose if it is written in this manner, that none of the shareholder or none of the members, are you writing or not? Please let me know, be honest. None of the members holds more than 50% stakes in new company. Suppose if question says, this is scenario A, this is scenario B. When new entity delivers purchase consideration to the members of the new entity, there are three sub-situations in fact. One we have already seen, and second one, none of the members holds more than 50% of the shares in the new company. In this case, it is not treated as a case of common control. In this case, it will not be treated as a, shall not be treated as a case of common control. Shall not be treated as, shall not be treated as, shall not be treated as case of common control. In this case, it will not be treated as a case of common control. Correct? Then, sir, what should we treat it? Obviously, if you are not going to treat it as a case of common control, it means it will be treated as, it will be treated as per Ind AS 103. It will be treated as per Ind AS 103, that is acquisition method. That means Ind AS 103 proper will apply, because in this case we are going to do the accounting as we normally do under Ind AS 103. Is it clear to you? This time it will not be treated as a case of common control, because in this case, new entity is not in the control of the demerged entity. Is it clear to you or not? Now there could be third situation also. Third situation is like this. Third situation. Where should I write? Third situation. Okay, I will write it in this manner. The third situation is that it is given in the question, this is A, this is B, and now this is C. New company has given the consideration to the members of the demerged entity, correct? And now it is given in the question that, in fact, in this case, nothing is given in the question. In this case, no information. When I say no information, what does it mean? There is no information with respect to the fact that whether any shareholder is having more than 50% of share capital or not. No such information is given. That means question is absolutely silent. Question is simply saying that new entity is delivering the consideration to the members of the new entity. Only this much information is available in the question. Now you tell me, in this case, what should I treat? Should I treat it as a case of common control, or should I treat it as what we call case of acquisition method of accounting, that is Ind AS 103 proper? You let me know. Suppose if the question is silent and no further information is given. Now some of you may give us what we call a diplomatic answer. Sir, we can treat it as a case of common control also, or we can treat it as a what we call acquisition method also, and we will write a note. So in this case, honestly speaking, in this case, because every time I should not say that I am correct. If some of you would say, sir, we have the liberty in this case to treat it as a case of common control, and we will put up a note regarding that. Or if some of you may say, sir, we may treat it as what we call a case of acquisition method, and we can simply put up a note. Definitely you can go by this rule. If question is silent, you can write a proper note and do the accounting accordingly. But my advice to you is that always treat it as a case of common control. Correct? My advice is this: it is always take the presumption that it is a case of common control. In this case, it is always better to treat it as a case of common control. Because generally when a new company transfers its business to a new entity, correct? Generally, somewhere intention always is there to hold the control of the new entity. However, if informations are given in a specific manner, then it is fine. But if question is silent, in that case, it is better, always better to treat it as a case of common control. Is it clear to you or not? Now, as I told you, common control is given under Appendix C of Ind AS 103. That is why we never say that it is Ind AS 103 proper, because Appendix C is entirely different thing. Appendix is entirely different thing. Under Appendix C, we are given that under common control, In the books of the acquirer, assets and liabilities will be taken over and taken over at book value, number one. And secondly, it is also given whatever differences will arise, as I will talk about, correct, that we will adjust through capital reserve, but that I am going to explain in a short while. Now we come over to the next point. So I hope after going through this particular point, things are absolutely clear to you. Never allow to skip it that who is the demerged entity. Number one, because I have seen a student often confuses with respect to demerged entity. This organization, when one of its part will move out of its fold, then quite obviously it will be known as demerged entity. Now the next thing is, as I have already told you, whenever question is tossed off from common control, it is going to contain very high marks, and obviously many things would be asked of you. So now we come over to the accounting procedure. Generally, when question is asked from this particular topic, but good thing is that there is hardly any variety in such sort of questions. So in case if you are going to pay attention towards this particular point, because it is going to consume a way bit of time, but still you can actually do the questions of your own. I will let you know in a short while. Now the next topic is accounting under common control. Accounting under common control. I'm insisting upon this particular fact that kindly, for God's sake, make a habit of writing. Accounting under common control. Now we are going to do the accounting and think logically. There is no point in doing what we call ratification, isn't it or not? Because that has become our virtues nowadays. So avoid this. Accounting under common control. Generally, when such question will be asked in the examination, you will be asked to first of all pass entries in the books of the demerged entity. Correct? Generally, you will be asked this particular point. So under step number A, let me write in the books of demerged entity. In the books of demerged entity. In the books of demerged entity. And now you know the meaning of demerged entity, isn't it or not? In the books of demerged entity. There is no hard and fast rule to cram the entries, as I told a moment ago. Think logically and you will see how easy it is. It is not tough. It may appear tough, but it is not tough. Let me assure you this. But how you have to think logically, now pay attention. In order to understand this topic comprehensively, please pay attention. Now you think that you are the accountant of the demerged entity. You had two divisions, A and B, but now one division is moving out of you. Is it clear to you? When we say that you are selling one of your division, what does indirectly it means? It means you are disposing of all the assets and liabilities of that particular division to a third party or to what we call another entity. The important point is that you were earlier having a division. You were having two divisions, A and B, and presuming that this division is being transferred. So whatever assets this division contained and whatever liability this division contained, obviously now you are going to actually transfer those assets and liability to the party to whom actually you are selling off this particular division. So quite obviously, as the accountant of this entity, you have to think on such what we call lines. Now you let me know, suppose you are the accountant of the demerged entity and you are selling off one of the division. Indirectly, it means you are selling off the assets and liabilities. So that means assets are moving out. If assets will move out, that means assets of the entire organization, this is the entire organization, assets of the entire organization will reduce, isn't it or not? So that means you are going to write here two assets account. First of all, you write in, and intentionally I have left these three lines. First of all, you need to write two assets account. Whatever assets you have transferred or sold, correct, you are going to credit all those assets. I hope you got this particular point. There is no need to cram anything. Think logically. You are the accountant of the demerged entity and you are losing out some assets because assets will move out of your business. Likewise, liability will also move out your business. If liability will move out of your business, that means the liability of the organizations are reducing. So quite obviously, you are going to debit the liability which have been taken over by the new entity. So liability account debits. So you are going to debit the liabilities. So that means all the assets and liability of this division have been given now to the new entity. But obviously you are not going to give all those assets and liability free of cost. You are going to receive something. There will be some agreement between what we call demerged entity and the new entity that what amount you are going to deliver. Correct? That amount of course is known as purchase consideration. You are going to debit the new entity for the same because you are supposed to receive some amount from the new entity against the sale of this particular division. So I will write here new entity or new company account. So why we are debiting new company? Because new company is supposed to pay us some consideration for assets and liabilities taken over. Is it clear to you or not? New entity has taken over assets and liability, and against the same it will have to give us some consideration. It is the new company is almost like a debtor company for us. Is it clear to you or not? Perfect. Any problem this up to this particular stage? No problem, sir. So quite obviously in this particular process, because you are giving assets and liability, let us say 100 net assets worth rupees 100 you have given to the new entity. So you might receive purchase consideration more than that or lesser than that, and accordingly there will be some loss or what we call gain. Is it clear to you or not? If there is loss, obviously you are going to debit it. We call it loss on sale or simply loss on reconstruction, because all these processes are known as reconstructioning schemes also. Anyway, loss on sale you will write here in case if there is any loss. Correct? In case if there is any profit, obviously you are going to write to profit on sale. Very simple. There is no need to cram anything. Profit on sale. If you are going to think logically, your concepts are absolutely strong. I'm telling you, it should appear to you almost like a cup of coffee. Now let me explain further. If there is a loss, obviously you are going to write it off. Obviously loss will have to be set off against something. Logically, if I have written this entry, and if there is a loss, then logically this loss will have to be debited. Now here the test of a professional will come into the foray. Your knowledge will be tested, because generally we are crammed by the books that this loss will be settled off against so and so. Nothing. Pay attention. There are always some rules. If there is a loss, then first of all you will settle it against capital reserve if it is there. If you have a capital reserve, better to set off this particular loss against the capital reserve. However, if you are not having the capital reserve, then you can set it off against your revenue nature reserves, like profit or loss account general reserve. That means after passing down this particular entry, logically you should pass another entry. Logically, you should pass another entry to write off this particular loss. But in examination, generally you do not have that much of time to unnecessarily stretch the what we call solution. Is it clear to you? It is expected of you as a professional how deft you are in condensing the things and still keeping the context intact. That is the art. So instead of going for this entry separately, what you do, write in bracket always. Suppose if you have the capital reserve, write in bracket capital reserve. Suppose that means you are setting off this loss against the capital reserve. If you are not having the capital reserve, I have already told you, you can set it off against revenue reserve. When you are going to write in bracket in this manner, examiner will understand that you know that this particular loss will be set off against these reserves. Correct? So you need not require to write then separately this particular entry. You need not require to write off then, show separately this particular entry. That is my point is it clear to you? So if there is a loss, and just think for a while, if you have the capital reserve, simply write capital reserve in bracket. And if you know that capital reserve is not there, but we have to write off this loss, then you will have to take into account revenue reserves. Is it clear to you? Now regarding profit, if there is a profit, the rule is that profit will always be credited to capital reserve. So instead of passing another entry, profit on sale account debit to capital reserve, you simply write in bracket capital reserve. So you will avoid what we call writing unnecessary entries. Is it clear to you or not? Is it clear to you? Till up to this stage things are clear, it is fine. So under it your first entry will be like this. Very simple. In the books of demerged entity there is no problem at all. Now see here. Next point, you just think of for a while. Because if you are going to cram the things will never be clearer to you. But if you are going to think logically, you will have to study only once. Let me assure you. Even though we are consuming a bit of time, later on you will see how quickly we are actually doing this question, as you must have noticed under what we call a gain on bargain purchase NCI question. We did them very what we call quickly because we are quite well acquainted with the concept. Similar is the case here. First, let me take the time. And don't think we will finish the course much before the stipulated time. This is my assurance. Now, please pay attention. After this entry, when you have transferred the asset, when you have transferred the liabilities and you have passed the entry, what else could be possible? What else could be possible? Think of this. Only thing remaining is that with respect to consideration, isn't it or not? So next step in the books of demerged entities with respect to consideration. With respect to consideration. With respect to consideration. But I have already told you that consideration, there are many situations with respect to consideration. If consideration is received by the demerged entity, this is one situation. So let me write here, as far as entries with respect to consideration is concerned, that depends upon the fact whether the consideration is received by the demerged entity or by the members of the demerged entity. Is it clear to you? Consideration received. Consideration received by. Consideration, where is the scale? Consideration received by. Suppose consideration has been received by demerged entity. If consideration has been received by demerged entity, what will be the entry? Pay attention here. Received by demerged entity. Suppose if consideration is received by demerged entity, what will be the entry? You are doing the accounting in the books of demerged entity and you are actually receiving the what we call consideration this time from the new entity directly. You are receiving the consideration. Ultimately, see here, the point is that, please pay attention. Here I wrote, if consideration is received by the demerged entity, in this particular case, because you are going to receive the consideration and in the first entry, you have debited the new company account and new company has now given the purchase consideration. Obviously, one thing is clear that you are going to credit the new company because new company has discharged the consideration. So new company account will be credited, number one. And consideration, whatever consideration you have received from the new company, because I told you, although consideration can be received in any form, but generally under merger demergers, we receive the consideration in shares. So I am writing shares in new company account, shares in new company account, shares in new company account debit to new company account. So if consideration has been received by demerged entity, this entry you will have to pass provided you are receiving the entire consideration in shares. If you are receiving some portion in cash, you will also debit the cash account. But generally, as I told you, under merger demergers, the consideration gets transferred in the form of share capital. I'm not telling, at no point of time did I tell that cash cannot be received or given. Now, with respect to consideration, the second situation could be when consideration is not received, or should I write received by demerged entity, received by, members of demerged entity. If consideration has been received by members of demerged entity, what entry you are going to pass? See here in this particular case, you have to be very careful in this case. Because in your entry, you have debited the new company. Whenever new company will discharge the consideration, and whether it is received by the demerged entity or whether it is received by the members of the demerged entity, irrespective of that, you are going to credit the new company account. It is very important because when new company has discharged its liability of paying the consideration, you cannot let it stay on the debit. So you will have to credit the new company account because new company has discharged the consideration. Whether consideration is being received by demerged entity or whether it is received by members. So if consideration has been received by members, that mean you are not receiving the consideration. It is being received by other shareholders. Paresh Gadyanwar says no entry. Yes, you can say that in this case we are not going to pass any entry, but we are going to pass the entry. See here what I have written here. Why we are passing an entry? You are right. Perhaps you might have studied from somewhere else. There is another method of dealing with that where entries are passed and not passed. But what I have written here in the first entry, we have debited the new company. Correct? So new company account must be credited whether the purchase consideration has been received by demerged entity or not. Because now new company has discharged its obligations. So new company will be credited. But the point is that in your books, you have already debited new company. That means you were expecting to receive something and now you are not going to receive anything from the new company because new company has already delivered the consideration to your members. You are not receiving the consideration. So it is almost like debtors what we call turning off bad debts. Because in my books, I have shown some debtors and I'm not receiving anything from them. Are you getting my point or not? So it will be treated as a sort of loss to the demerged entity. It will be treated as a loss to the demerged entity. It is treated as a loss and you will debit either capital reserve if you have the capital reserve. Whenever there will be losses, always better to write capital reserve for the same or what we call revenue reserves if there is no capital reserve. That means whatever loss is taking place, we are setting it off against capital reserve or revenue reserve. It is a sort of loss actually for you. I hope you got this particular point and why it is a loss to you, because you have debited new company in the very first entry. So that means you are reflecting new company as your debtor, but you are not receiving this time from the new company, but at the same time, new company has discharged the obligations. So your debtors are reducing and you are not receiving anything. So it will be treated as a sort of loss, and loss first of all will be debited to capital nature reserve. And if capital nature reserves are not there, then only you will set them off against what we call revenue reserves. So these two entries you will have to take care of in the books of demerged entity. Correct? In the books of demerged entity, first of all, they will ask you one entries and they may ask you to prepare a balance sheet. Under the second step, you may have to prepare a balance sheet as far as accounting in the books of demerged entity is concerned. Preparation of the balance sheet, and preparation of balance sheet is so easy. Preparation of balance sheet. Preparation of demerged entity. Correct? So that means after the sale of division, we will have to prepare the balance sheet, and it is not a tough nut to prepare the balance sheet. It is very easy. Why it is so easy? Let me explain this particular point. Let us say there are two divisions A and B, and division B is being sold out. For simplicity's sake, let me say property, plant and equipment were 10 lakh and 5 lakh. So total property, plant and equipment of the organization is equal to 15 lakh. Because we have sold out this division, we are left off with only property, plant and equipment 10 lakh. So in the balance sheet, we will simply show what we call 10 lakh worth of property, plant and equipment. It is as simple as that. That means we will pluck out all the assets of what we call that division which we have sold out. We will pluck out all the liabilities of the division which we have sold out. And whatever we are left off with, we will simply let it stay in the balance sheet, and our new balance sheet will be prepared within a flick of a second. So it is not a very tough nut to what we call prepare the new balance sheet. We will see later on how easy it is. It is not tough, provided you have done the entry portion quite well. Correct? Now we move over to this was step number A in the books of demerged entity. Now question, as I've already told you, question will be pretty strong and question will be a little bit tough also. So under the second major point, they may ask you accounting in the books of new company. In the books of new entity or in the books of new company. In the books of new company. Accounting in the books of new company. Now you will have to do the accounting in the books of new company. Whenever you have to do any accounting, always think of from the perspective of the entity for which you are supposed to do the accounting. So now you are being asked to do the accounting in the books of the new company. You presume for a while that now you are accountant of the new entity. Is it clear to you? Now suppose if you happen to be new entity, when you are going to take one of the division of the other entity, obviously that means you are taking over some assets, you are taking over some liability. You have to think on such lines. As I've already told you, it is not possible to cram the things. Only thing is that you have to think logically. So under it, first of all, one, entries. Question looks pretty long, but actually it is not the case. Correct? You will notice very soon. Now, as far as entries is concerned, the first entry will be for taking over assets and liabilities. For taking over assets and liability. For taking over assets and liabilities. For taking over assets and liabilities. So you will take over all the assets and liability. You are the new entity. If you are going to take over the asset will come to you. So that means asset from your perspective will increase. So I will write here assets account. Because we are following common control, all the assets which we are going to take over, we are going to take them over at book value. It is important to note. I will write later on the characteristic of common control also. Don't worry about that. Assets account debit. Then obviously you are taking over some liabilities. So you are going to write here two liabilities. Two liabilities. All the liabilities will be recorded at book value or carrying value as we call them. Is it clear to you? Obviously for taking over this assets and liability, you are under an agreement to pay some consideration. So you will write here two consideration payable account or simply consideration account. Because you are supposed to pay considerations. It is a liability for you. Now, from the perspective of the new company, if there is any loss, pay attention what I am saying. First of all, if there is any profit, you are going to write here two capital reserve. Two capital reserve. If there is any profit. If there is any loss, please pay attention what I am saying. Many authors, they commit this mistake actually. They say that you simply write goodwill. Because what we have learned that if balancing figure comes over here, we have to write goodwill. If balancing figure comes here, we have to write capital reserve in the books of acquirer company. We have already seen this, isn't it or not? But try to understand. Logically, we will not write goodwill. Even though in your module also in some question it is written goodwill. Goodwill should not be written over here. Why I am saying so, I will tell you, but let me first of all write. Whether the balancing figure arises here, of course it is a capital nature profit, so I will write two capital reserve. And even if there is a loss, I will still write capital reserve. In case of acquirer company, I am not going to write the word goodwill. However, under Ind AS 103, if we would have been doing accounting as per acquisition method, of course here I would have written goodwill and here I would have written capital reserve. But if I am doing the accounting as per common control, I should not write the word goodwill, even though this difference is arising towards the debit side. Why? Because one of the characteristic of the common control is that I told you one characteristic is that one feature is that all the assets and liability will be taken over at book value, that is carrying amount. And second, no new asset should be recognized. No new asset should be recognized. That is the reason we should avoid writing goodwill account, although it is not going to have any implication as far as solution is concerned, but it is better to write capital reserve. Is it clear to you or not? It is better to write capital reserve. Capital reserve debit balance also means goodwill itself because this is negative of goodwill. Is it clear to you? Capital reserve debit balance means it is nothing but goodwill. But you should avoid writing goodwill because it is clearly stated that not a new asset will be recognized. Is it clear? I have mentioned two characteristics. As far as common control is concerned, all the assets and liability will be taken over at book value. Number one. Number two, no new asset should be recognized. That means you should avoid what we call using the word goodwill. And there is third characteristic also, but which I'm not going to tell you at this particular moment. I will tell you at a particular point of time. After having written this particular entry, quite obviously, now the second entry will be with respect to discharge of consideration. Because new company is under an obligation to discharge the consideration, it will discharge, and irrespective of the fact whether it is paying the consideration to the demerged entity or to the members of the demerged entity, irrespective of that, it will simply pass the entry for discharging the consideration. Isn't it or not? So entry will be consideration account debit. Consideration account debit. Consideration account debit. Consideration account debit to share capital account, presuming that consideration is being paid by way of shares, by way of share capital. In case of some cash is also being paid, we will write simply to cash also. Now, after this, question may also ask to prepare balance sheet. This is step number one as far as books of new company is concerned, one entries. Then second, you will have to prepare the balance sheet also, and very easy to prepare the balance sheet. As far as balance sheet preparation is concerned, it is very easy. You will have to look only towards these two entries. As far as balance sheet of purchasing company is concerned, you will have to focus only on these two entries, because whatever assets they have taken over, they will now appear in the what we call balance sheet of the new company, of course, towards the asset side. Similarly, let us say there is a loss and there is a debit balance of capital reserve, you will write it under other equity item as a negative item. Liability will be put towards the liability side. Consideration, here it is credited, here it is debited, so consideration is cancelled out. Suppose if there is a profit, that means capital reserve, so it will be reflected under what we call other equity. On the contrary, then share capital, whatever share capital you have issued, you simply will show it as an item of equity, that is share capital, and your balance sheet is done. It is as simple as that. So preparation of balance sheet is not a tough nut to crack as far as this particular thing is concerned. But before we proceed, it is always better to actually take care of, supplement the discussion with the help of one example. Correct? I hope the thing still up to this particular point is clear to you. Is it clear to you or not? Please let me know of that. All these things are clear to everyone or not, whatever we have discussed today. Then only we will proceed to do the question. Yes, please let me know. Things are clear or not? Please let me know of that. All clear, Krishna God says, and then Paresh Gadyanwar, yes, T. Shruti Senapati says, yes, Ravi Bajaj says, yes, almost it seems everyone is present today. MGA Gadishwar Rao Archery. I hope I have pronounced correctly. Yes, thank you to hear of you, and those among all those who else are also present, please let me know of their viewpoints so that we also come to know. I hope now each one of you are having the notes, and soon we have already dispatched the books. Remember one thing, it consumes a bit of time, as you know, before the book reaches your hand. And Sam says, yes, so okay, now we presume that everyone is comprehending the things and things are coming up to your expectations, and definitely you are liking, I should say, the quality of the class also. Correct? Jagadish, okay, Jagadish. Right. M. Jagdishwar. Thank you so much, because it is written in smaller words. No, sometimes it becomes very difficult to actually comprehend the things. Okay, be honest. Don't look at the solution. Try to do this question of your own. Even though I haven't solved a single question, let me see actually how well you are able to understand. First, let me explain the question. AB Limited has two divisions, A and B. There is an organization. It has got two divisions, A and B, and division A has been making constant profit, while division B has been making constant losses, that is suffering from losses. The division-wise balance sheet on 31st of March 2023 is given to you. Correct? Right. Once you will go through the sums, it will be absolutely clear. Let's have a look over here now. So these are the two divisions, Division A and Division B. And Division B is suffering the losses. Obviously, this division will later on we will see will be sold out to a new entity. Note down their assets and their liabilities carefully. See here, and there is an art to actually note down the things. For example, here you are given fixed asset or property, plant and equipment at cost. In bracket, it is written tangible. 500, 1000 is the gross amount. Their depreciated amount is 450 and 800. And their written down value is given 50 and 200. And total is 250. That means till up to this point would come across one asset, that is property, plant, one item, sorry, property, plant and equipment, and the written down value is 50, 200 and 250. Correct? Further, we are given in this particular question that current asset. Now we are given current asset also. Now, as far as current assets are concerned, we see that current assets are given to us as 400, 1000, and total is 1400. Correct? 400, 1000, 1400. And just to zigzag the things, they have written current liability, less current liability, less current liability. Important point is that one property, plant and equipment is given in the question. You note it down carefully. And then you are given current asset also. This is the second item which you have recorded, which you have to see to it. Correct? And then there is third item in the form of liability, current liability. Correct? And then just to confuse you, they have written net current asset. We are not concerned with the net current asset. You simply go over to the items. Now the next item is loan. Next item is loan. Now as far as loan is concerned, this is another liability. So as far as liability is concerned, one is current liability, second is in the form of loan. One is current liability, second is in the form of loan, and loan amount is nil and 600 and total loan is 600. Correct? Then we have been given share capital and items of other equity. As far as items of other equity is concerned, Division A is having positive other equity, say retained earnings, and it is having negative. So net amount is 150 given in the outer question. When you have gone through the question, you have to shorten it in this sense. For example, when you went through the question, you came across that property, plant and equipment is given in the balance sheet like this. It is given in this manner. Property, plant and equipment at written down value is 50. You mark it out somewhere in your rough in this manner and 200. Is it clear to you? Another item was current asset. You also simply mark it out. That is equal to 400 and 1000. Besides these two items, you have been given current liability as we saw 50 and what we call 800. Is it clear to you? 50 and 800. Correct? And then you mark out another liability in the form of loan also. So you have seen the loan amount is given to you as dash and 600. Loan amount is given to you as dash and 600. Total is 600. Is it clear to you? And then you are being given capital and other equity. We have to take care of only assets and liability. So if you will look closely, actually this balance sheet contains these items. Of course, it is at written down value. Now, further the question says that this is an art. That is what I meant by it. Now, Division B along with its assets and liabilities was sold off for 50 lakhs to X Limited. So, Division B is moving out. So, you mark out that Division B is moving out. And what is the amount of purchase consideration? It is clearly mentioned in the question that you are selling out this division for 50 lakhs to X Limited. Correct? To another entity, you are selling it out. The name of the new company is X Limited and purchase consideration is 50 lakhs. Is it clear to you? Right, sir. A new company. Further, it is given which issued 2 lakh equity shares of 10 each at a premium of 25 per share. First of all, it is given that in order to settle 50 lakhs rupees, the new company is going to issue 2 lakh shares. 2 lakh shares. It is going to issue 2 lakh shares and the face value of the share is 10. Face value of the share is 10. But this entity will issue the share at a premium of 15 per share. 15 per share. That means new company is delivering 2 lakh share at an issue price of 25. It comes to 50 lakhs. Is it clear to you? Is it clear to you or not? Right. Further, it is given that new company will deliver the consideration to the members of B division in full settlement of the consideration in proportion to their shareholding in the company. The new company is going to settle, correct? The new company is going to settle the consideration. To whom the new company is giving the consideration? Kindly please let me know. New company is going to give the consideration to the members of demerged entity. Members, is it clear to you? Per share to members. Is it clear or not? So this is very important point. As I told you earlier, when you start what we call solving the question, you have to keep an eye whether the consideration has been received by demerged entity or whether it has been received by the members. Now in this question, it has been received by members. So quite obviously, if it is received, because if it would have been received by the demerged entity without an iota of doubt, I would have treated it as a case of common control. Now, if it is a case of members, I have to see is any further information is given in the question or not. Now, in this question, it is not given that one of the shareholder is having more than 50% share. It is not given. If it would have been given, I still would have treated it as a case of common control. Neither it is given that none of the member is having 50%. So that means question is silent. And just a moment ago, I told you if the question remains silent, it is always better to treat it as a case of common control on the assumption that demerged entity is still having the control of the new entity. Is it clear to you or not? So on this basis, now we can start solving this particular question. That means you can see the question looks pretty long. Actually, it is not pretty long. It has got only this much of assets, correct? 2 assets, 2 liabilities. Besides that, actually, there are some items of other equity, share capital and other equity. Is it clear to you or not? Fine, sir. If it is fine, I will solve one question for you. And in the question, this question has been straightway taken from your module also. Let me also tell you, but you need not require to touch your module. In case if you want to touch your module, you do it once we will finish off with the chapter. You will see that all the questions have already been done, correct? Moreover, there are some misprints also. That's the reason actually I caution you better to concentrate and have complete faith upon me, correct? Assuming that there are no other transactions, you are required to show journal entries in the books of AB Limited. AB Limited is the demerged entity, number 1. Number 2, prepare the balance sheet of AB Limited. This is what exactly I told you that it will be asked in the question in the books of demerged entity. You will have to pass the entry. You will have to prepare the what we call balance sheet. Further, it is given that we have to pass the entries in the books of X Limited new company. And of course, we are supposed to prepare the balance sheet in the books of the new entity. The problem is that students become very happy when they see that entire thing is given in a solved manner. Correct? I have seen actually. I can see the gleanness. You know the meaning of gleanness? Right, sir. Gleanness means I can see how joyful you becomes when you see the entire solution is done. So you are escaped of what we call writing of anything. Isn't it or not? This is the feeling you people actually derive. Don't commit this mistake. Problem is that I will come to know who is writing and who is not writing. Remember one thing, correct? Otherwise, you people will not get the sort of marks. Please pay attention and promise to yourself that you are supposed to actually do this question as I am doing in front of you. First of all, write step number 1. Question has asked journal entries in the books of AB Limited. So journal of AB Limited. AB Limited is your demerged entity, isn't it or not? Demerged entity. Demerged entity, one part of it is moving out. So if one part of this entity is moving out, we will see to it which part is moving out. Division B is moving out. We will have to focus over the assets and liability. There are 2 assets, 2 liability. So first entry will be 1. In fact, A, you write transfer of assets and liability. Transfer of, at least for God's sake, write one question, complete solution in your own handwriting. You will see the difference. Transfer of all assets and liability. Transfer of all assets and liability. Transfer of all assets and liability. Correct? It is always better. Nowadays, trend is to write the narration at the top rather than at the bottom. Correct? Now, look into the assets and liabilities of the demerged entity. First of all, okay, let me write in this manner because we have already seen the entries. As you know, we will have to debit the new company. I'm simply writing new company account debit, whatever is the name of the new company is supposed to pay us 50 lakh. Correct? Figures are in lakhs. I will write somewhere later on. Correct? So 50 lakhs they are supposed to pay us. So I will debit the new company because we are supposed to receive. And then we will take into account which are the liabilities which are moving out because we will have to debit those liabilities. There are two liabilities in the question as far as of division B is concerned. If you remember, one was loan, and amount of loan was I think 600 lakhs. And then there was current liability, and current liability of what we call division B was 800 lakhs. 800 lakhs. And there are two assets. One is property, plant and equipment, that is fixed asset. Write in bracket 1000, that is the gross value. Although it is not necessary, you can straight away write what we call written down value. Written down value is 200. And there is another asset in the form of current asset. So I will write here two current asset, and current asset was 1000. This is the entry which we will have to put up. Now I will total it. Debit side exceeds actually, that is 1450 minus 200. Obviously in this case what we find that there is profit, isn't it or not? If there is profit, how you are going to write? First you write here to capital reserve and write in bracket profit on sale. In the books of demerged entity, correct, if there would have been loss, I told you, you could have debited the loss first to capital reserve, then to revenue reserve. So profit on sale. This will be your balancing figure, and balancing figure you have transferred to capital reserve. Profit will always be transferred to capital reserve, 250. This is the first entry. Now we have to pass the second entry. Second entry depends upon the fact whether consideration is being received by the demerged entity or by the members. Second, consideration. In this case, consideration is received by the member. We are not supposed to, demerged entity is not supposed to receive the consideration, but we have debited the new company. So first of all, we will cancel out our debtors, that is new company. And because we are not receiving anything from new company because that is being received by the members, so obviously it is a loss. Because it is a loss and there is a balance in capital reserve, how much actually I am supposed to receive? I was supposed to receive 50 lakh. Please pay attention. This is a loss to us. I have already told you. This loss can be debited to revenue reserves also. It can be debited to capital nature reserve also, but it is always better to write it off first against the capital reserve because this entire scenario is of capital nature. Transfer of business, isn't it or not? So because in the capital reserve there is a balance of 250, so it is better to transfer this loss to capital reserve. Why it is a loss to us? Because demerged entity is not receiving anything from one of its debtors, you can say, in a simple language. Correct? So that is why we have cancelled out new company account and we are not receiving anything. So it will be treated as a sort of loss to us. Is it clear to you or not? Fine, sir. After this, we are supposed to prepare the balance sheet. So under what we call demerged, under the accounting process of demerged entity, first step was Journal of AB Limited, and then step number 2, balance sheet of demerged entity. Balance sheet of demerged entity. Now, in order to prepare the balance sheet of the demerged entity, nowadays we prepare balance sheet only as per division 2, correct? Division 2, as per division 2, we are going to prepare the balance sheet. And in order to prepare the balance sheet, first of all, you write 1, assets. And under the asset, again, I have seen actually professional student, they commit lots of mistake in preparing the balance sheet. Not only preparation of the balance sheet, but in writing the things in a proper perspective. Under division 1, under division 2, sorry. First of all, division 2 is applicable to companies following the Ind AS. Under Ind AS, we always write as per division 2 assets first. Under the assets, we always write first non-current asset. Write NCA, non-current asset. Under the non-current asset, I am going to write property, plant and equipment. Although in the question it is given fixed asset, I will write in bracket fixed asset. Correct? Now, there were two divisions. Correct? There were two divisions. You can look into the balance sheet. In the column of the total, the third item is being reflected as 250. This is the total of the written down value of property, plant and equipment. Out of 250, you have transferred 200 worth of property, plant and equipment at written down value to the other entity. So you will be left off with property, plant and equipment at written down value 50. Correct? So you will write here amount in lakhs and amount will be 50. Is it clear to you? It is very simple to prepare the balance sheet. Similarly, the next item actually is current asset. Now, as far as current assets are concerned, the current assets of division B has gone out and current assets of A are only remaining. So we will write them 400. Very simple. You can see how easy it is to prepare the balance sheet. Total will become 450. Total is equal to 450. Is it clear to you or not? Absolutely clear, sir. After this, we will move over to the next part, that is as liabilities, equity and liabilities. You write here equity and liability. Under the equity and liability, what you are supposed to write? First of all, write one, equity. Please write equity. If we have written equity, write A, share capital. Always first write share capital. Of course, share capital of the organization will always come here, 50. Is it clear to you? Share capital of the organization will always come in the balance sheet. Coming over to the other equity item. Other equity item. As far as other equity item is concerned, pay attention. Again here, I have seen many people commit lots of mistakes. First of all, look into the other equity of division A. The equity of division A is, I think, equity of division A, I have forgotten, and it is how much? 350, as you can see, correct? So equity of division A is 350. So let me write 350 first of all. 350. 350 is given to us. Is it clear to you? And see here, equity of the other division, that is division B. Now think for a while. Many people actually construe common control in a wrong fashion. Why I am saying so? Pay attention here. It is very important to explain the confusing point early in the stages. Many people think that under common control, because common control means pooling interest method. And pooling interest method means you have to pool. You have to pool means you have to combine. It is known as pooling interest method also. Under pooling interest method, of course, we combine assets and liability. Just correct, think of it in this manner. And similarly, many people think that new company will take over the asset, will take over the liability, and new company will take over the reserves also. New company will take over the reserves also. Many people are under this sort of confusion, but let me clarify it. New entity will take over reserves only if it will have some positive balance. No entity or no man worth his salt will take over any losses of the other entity unnecessarily. Are you getting my point or not? So this time division B is having losses. So their reserves will not be taken over. It is as simple as that. Is it clear to you or not? Indirectly, under the common control, we will take over the asset, we will take over the liability, we can take over the reserves also, provided reserves of that division which is being sold out is showing positive balance. So that is the point which you need to keep in your mind. We haven't transferred the reserves, even though it is a case of common control, simply because the other reserve is reflecting negative balance. So other reserve hasn't been taken over. So we will have to add it. But problem is that other reserve is having the negative balance, as we can see, isn't it or not? Other reserve is having negative balance. So 350 minus 200 is equal to 150. That is already given in the outer column also, isn't it or not? But here you have to be a little bit more careful, because in this question, when you wrote the entry, first of all, there was capital reserve here. That means, first of all, there is a credit balance. So, and capital reserve is a part of other equity. You will add 200 because of, you will add 250, sorry, not 200, because credit balance is 250. So you will add 250. And then, because in the next entry, there was loss, you debited capital reserve. So capital reserve debit balance minus 50. Is it clear to you or not? Ultimately, in the outer column, how much you are going to reflect? 150, 400 minus 50, that is equal to 350. So 350 you are going to reflect in the outer column. I hope this particular point is clear. Is it clear to you? This is the balance given in the balance sheet, 350 minus 200, and this we took from the entries. Is it clear to you? Now, besides that, after other equity, in this particular question, 2, non-current liability. In this question, there is no non-current liability. Was there any non-current liability? Yes, sir. There was non-current liability in the form of loans. But problem is that the loan has been transferred. So now we are left off with no non-current liability. So current liability, and current liability only of division A will come now in the balance sheet. That is 50. So if I will tally 50 plus again, so it will be equal to 450. So not a big task as far as preparation of balance sheet of the demerged entity is concerned. Now under step number 3, which is asked in the question, that is journal of new entity. Journal of new entity. So journal of new entity, that is X limited or Z limited, whatever it is, journal of new entity, I am simply writing. Now, as far as new entity is concerned, new entity has taken over our 2 assets, property, plant and equipment at a written down value of rupees 200. So new entity is going to debit property, plant and equipment. Besides that, new entity took over our current asset, and current asset was worth rupees 1000, I think so, 1000, right? And new entity took over our liabilities, in fact loans. As far as loans were concerned, loans were 600, and new entity took over current liability, and current liability is worth rupees 800. Pay attention here. And new entity is going to deliver consideration. How much? New entity is supposed to pay us consideration. How much consideration? What should I write? Because new entity is giving us 50 lakhs worth of consideration. It is given in the question, and it was also given that new entity will discharge that consideration by issuing share of rupees 10 each at an issue price of 25. So 2 lakh into 25 becomes 50 lakh. This point is very, very confusing. Pay attention and don't write here, because I have to explain something. That is why something I am going to do intentionally wrong, then I will rectify. Suppose here if I write consideration 50. Suppose if I write consideration here 50 rupees. Correct? Suppose if I write consideration which is given in the question as 50. And if I would have then computed the difference, 1450 minus 1200, difference would have been equal to 250. In that case, obviously this is a loss, but I told you in the books of acquirer company under common control, whether difference arises towards debit side or towards credit side, you have to use capital reserve, term capital reserve. No doubt it is a loss. 250. In that case, difference would have been 250. Is it clear to you or not? Is it clear to you? Okay. Technically speaking, this consideration 50 lakh comprises of nominal value. Don't write at this moment, correct? Because I have to explain. This is very confusing point, and so you have to understand it better. Suppose if I compute the nominal value, because purchasing company is issuing 2 lakh shares of rupees 10 each, so nominal value will be equal to 20 lakhs. And security premium will be equal to 2 lakh into 15. They are issuing shares at a premium of 15 per share, that is equal to 30 lakhs. So total 50 lakhs. Is it clear to you? Now suppose in this particular case, suppose I would have written this particular entry, the first entry, if I would have written in this manner, and there is nothing wrong in it, because we are being given purchase consideration 50 lakh, Krishna Gaur has said that 20 lakh, and you are right, I will come to that particular point. But in order to make you understand, I am moving this way around. We will see later on, we cannot write here 50 lakh. But just to tell you, actually, it is very important to understand that why we are writing here 50 lakhs, why we are not writing here 50 lakhs, even though consideration is given 50 lakhs. So first, I have written consideration as it is given in the question. If I am writing here 50 lakhs, then my loss will be equal to 250 lakhs. Is it clear to you? In that case, later on, when I would have prepared the balance sheet, as you know, as far as balance sheet is concerned, under the balance sheet, especially under equity and liability, when we show other equity items, under the other equity item, this capital reserve will find place to the extent of 250. Isn't it or not? This capital reserve will find place to the extent of 250. And besides that, there is a consideration to the extent of 50 lakhs, but this consideration comprises of 30 lakhs worth of premium, and premium would have been existed over here 30 lakhs. Are you getting my point or not? Now this is a loss. 250 is a loss actually, because it is a debit balance, and premium would have been 30 lakhs. So net loss would have been 220. Are you getting my point? Correct. If I would have had written here 50 lakh, in fact I have written here 50 lakh. If I am writing here 50 lakh, still in the other equity I am getting a net negative balance of 220. But we will see that under common control, and this is the third and final facet of common control. Number one, assets and liability will be taken over at book value. And number two, as I told you, no new assets will be recognized, and that is the reason why we are refraining ourselves from writing here goodwill. Correct? Because no new asset should be recognized. That is why I am writing here capital reserve. Is it clear to you? Second point and third point. The third point says that consideration in the books of acquirer company, consideration in the books of purchasing company will be written not at this price, rather at nominal value. At nominal value. That means I should not write here 50 lakh. I should not write here 50 lakh. Oh my sir, this is the point. Yes, this is the point. You should never commit this mistake of writing here consideration in the books of purchasing company. Is it clear to you? At the price, rather at nominal price, not at issue price. So consideration you will be forced to write here at 20 lakh. Now here, if I would have told you simply like this, because standard says that we have to show the consideration at what we call nominal value, many among you would not have understood the repercussion. Now see here, even though if I am writing here 20 lakh, ultimately it is not going to have any effect. Why it is not going to have any effect? See here, I have written here 20 lakh. Now if I am going to compute the capital reserve, what will be the balance in capital reserve? That will be equal to 220. Now in this case, because I have written here consideration 20 lakh, so when I will prepare the balance sheet, under the other equity, I will write minus 220 capital reserve because it is having negative balance. Under both the scenario, you can see in the balance sheet actually, capital reserve would have been 220, negative 220. Is it clear to you? So nothing will change, even though if we are writing here consideration at nominal value. Is it clear to you or not? So this is the point which you have to understand. Is it clear? Is it clear to you or not why we have written it here at nominal value, and why it is not having the what we call any sort of what we call implications in the balance sheet? But never write it at 50 lakh. Under common control, consideration will be reflected at nominal value. And now the next point is with respect to the discharge of consideration. So you will write here consideration. Because you have shown the consideration at 20 lakh, now you will write here consideration 20 lakh, and you will write here 2 share capital. You will write here 2 share capital, that is equal to 20 lakh. Is it clear to you? Is it clear to one and everyone? Yes, sir, it is absolutely clear. Presuming that it is clear to you, because on your behalf I have to answer myself. Now you will have to prepare the balance sheet of the new entity. Balance sheet of new entity. I told you earlier that when you are going to prepare the balance sheet of the new entity, all you have to do and focus upon is upon the entries which you have just written here. So when you will prepare the balance sheet, first of all, you are going to write here non-current asset. Non-current asset. Under the non-current asset, of course, only one item will appear, and that item will be property, plant and equipment. And you have written in the entry property, plant and equipment at 200. So in the outer column, you are going to write here 200. Is it clear to you? And then you will write here current asset. Only one item under current asset, that is current asset itself. So you are going to write 1000. So easy, not tough. So you can straightway write total of the asset side, that is equal to 1200. Now you will write here equity and liability. As far as equity and liability is concerned, equity and liability. Equity and liability. As far as equity and liability are concerned, please pay attention. Now question say that if share premium will be 30 lakh, the capital reserve will be 190. No. In that case, the amount of capital reserve is 250. Krishna God, you are forgetting that particular point. Is it clear to you? If I would write here, please pay attention, instead of 20 lakh, if I am going to write here 50 lakh, please pay attention, my capital reserve would have been 250, not what we call 220. If I am writing here 20, then capital reserve is 220. So that is the point which you need to keep in your mind. Correct? Anyway, now we come over to the equity and liability. Under the equity and liability, that is why I keep on telling, always pay attention towards each and every point. Now, under the equity and liability side, first of all, we always write equity. Correct? We always write equity. Under the equity, we always write first share capital. Now, this is a new company, and this company is issuing share capital of 2 lakh share at nominal value of 10. So, because in the entry we have written 20 lakhs, so I will write here 20 lakhs only. Krishna Gaur, I hope the things is clear. Correct? Now, B, other equity. Under the other equity, in this particular case, if you look into the entry, we have capital reserve negative balance. Correct? So, capital reserve I will write, and capital reserve is having negative balance of 220. I will write it in bracket. Is it clear to you or not? After that, I will write here liabilities. As far as non-current liability is concerned, because this entity has taken over loans, so it will reflect the loans at 600. And then third, current liability, and this entity has taken over current liability worth 800. So total will be equal to 1200. 1200. Is it clear to you? Is it clear to everyone or not? Now please let me know whether it is clear to everyone or not. Till up to this particular stage. So after having done this particular question, please try to attempt 2.2 of your own. This question is absolutely on similar lines. Only thing is that figures are doubled or halved of the previous question. Again, this question has been taken from your module. Correct? So, two divisions here, laptops, mobile division laptop has been making constant profit. So, this division is making profit, but this division is under the losses. This division is being sold. So, apply the same rules, same procedure. Correct? Same procedures. Krishna God, what you are not noticing in this particular fact, what you are not noticing under this particular fact, please pay attention. We are not reflecting share premium at all. Share premium is already getting adjusted in this amount. That is the point. Because here we have shown consideration at nominal value. We are not reflecting at share premium. We haven't shown share premium at all. Point I told you earlier, if I would have written here 50 lakh, then I would have passed the entry consideration account debit 50 lakh to share capital 20 lakh to security premium 30 lakh. In that case, share premium would have appeared in the balance sheet and net equity would have been 250 capital reserve less security premium 30. Still the negative amount would have been 220. So standard says that things to be recorded at nominal value only. That is why we are completely ignoring security premium, but it is not going to have any implication, because ultimately you can see, even if I would have written here security premium account, it would have got adjusted against capital reserve. So here when I am writing 220 capital reserve, that means security premium account is getting adjusted against capital reserve. That is the point which you need to understand. Now, I was talking about this particular point, that next question you should be in a position to do as far as Enterprise Limited, Laptop Limited is concerned. This question is similar to the one which we did. You should be in a position to do this question without any problem. Okay, Krishna, if you got it, that is fine. So next question, as I was talking, use the same way of doing. First, extract the items of asset. Correct? First, extract the items of the asset. Extract the items of the liability. Your first step should be like this. Under the second step, you have to note down the amount of purchase consideration. Under the third step, you need to know whether the purchase consideration is being received by demerged entity or by the members. Now, in this question, I will tell you later on also. I told you it is similar to the last question. Only thing is that here purchase consideration is 25 crores. Again, nominal value is 10 and per share premium is what we call 15. Last time 2 lakh shares were being issued. This time 1 crore equity shares are being issued. Correct? Now, here in this question actually clearly mentioned that purchase consideration is being given to the members, and further this line is also given in this question. One of the members of the Enterprise Limited holds 52% shareholding in the new company. So obviously in this case, what we call, you will have to apply common control method. Is it clear to you? So I've solved the question, but try to refer to solution only and try to do without having a look over the solution. That is the best way to comprehend the things. In the next session when we will meet, we are going to start with 2.3. It's a very heavy question and it's a pretty long question. We'll do that 2.3, and once we shall have done 2.3, honestly speaking, after that you should be in a position to then do question number after that, one more question was there which I will give you, but let me do first of all 2.3, and then after that we'll move over to the next section of this particular part. Yes, one more section I have attached here, common control and acquisition self-attempt. So once we shall have done actually 2.3, after that you will do 3.1 and 3.2 of your own. Even both these questions have been picked up from your module. Is it clear to you? Only thing is that we might have refined the names or the dates. Is it clear to you? That's the only thing. Okay then, so point is, and in order to understand this particular question, let's go through. I hope each one of you have opened your notes. So following is the draft balance sheet of Demerged Limited, and it is having an authorized share capital of 1,000. Although authorized share capital is not going to have any impact in the solution. Now in this case, balance sheet of Demerged Limited is given. Unlike the previous questions wherein the balance sheets of both the divisions were available, but in this question the balance sheet of Demerged Limited is given in its entirety. First item is property, plant and equipment. Just pay attention. It is written gross less depreciation. That means this 600 is net value. This is the net value. So what would be the gross value? Quite obviously the gross value must have been 800. 800 minus 200 is equal to 600. Then we are given financial asset. Investment is not investment. Nowadays there is another category that is known as financial assets, and under financial assets we write investments, and investments are carried at fair value. That means even though it is written in the books That is book value, but this is also the fair value at 1000. It is being reflected. Further, we are given current asset 3000, and this is the total actually. This is total. Total is 4600. Then further, we are given in this particular question equity. Under equity, we are given equity share capital 250, other equity 1350. Besides that, we have got non-current liability in the form of financial liabilities. Under the non-current liability, we have a subheading financial liability, and under financial liability, there are borrowings in the form of unsecured loan that is equal to 1000. Then besides that, we are also having what we call current liabilities. As far as liability side is concerned, only two items are there, correct? And as far as your asset side are concerned, we have already come across, there are three items: property, plant and equipment, investment and current assets. Further, it is given in the question below, capital commitments. It is of course a contingent liability. Capital commitment, that means we might have entered into some agreement with some other entity, and we have given them a commitment of 700 crores. So it is a sort of contingent liability written under the footnote. Further, it is given that the company consists of two divisions. Now, the question unfolds itself. Now we come to know Diverse Limited has got two divisions. Diverse Limited has got two divisions. And now the information which we have is, this is your Diverse Limited. Diverse Limited. And now question says that Diverse Limited has got two divisions. One is known as Establishment Division. In fact, established division. Another one is new project division. So one is established division, another one is new project division. Although in segregated form, assets and liabilities are not given. Establishment division and new project division is given to you in this particular question. Further, it is given that establishment division, whose gross block was 200 crore. Gross block was 200 crore and net block was 30 crores. What we mean by gross block? Gross block always stands for fixed asset. Remember one thing. Gross block always stands for fixed asset or property, plant and equipment, you may say so. So question says that as far as establishment division is concerned, its gross block, that means the property, plant and equipment of this particular block as far as is concerned. So its gross value is actually 200. Its gross value is 200. That is given in the question, correct? Its gross value is 200 and its net value is 30. Its net value is 30. That means the depreciation on gross block must be equal to 170. Then only actually we can say that its net value is 30. So now we have come to know that as far as property, plant and equipment is concerned, out of that, net value 30 belongs to actually establishment division. Is it clear to you? Now, if you are going to have a look over here, total net value is 600. Now, total net value is 600. Total net value is 600. Total value, net value is 600. Out of 600, net value of property, plant and equipment of establishment division happens to be 30. So quite obviously, we may say that net book value of new project division must be equal to 570. It must be equal to 570, isn't it or not? Further, we also know in the question that gross value is 800. Total gross value is 800. We also know. So total gross value is 800. Total gross value is 800, and out of 800, 200 is the gross book value of property, plant and equipment of establishment division. So we can safely conclude that 600 must be gross book value of property, plant and equipment of net project division, new project division. And 600 minus 570, because this is the net value available and this is the gross value. Now we have figured it out. So quite obviously the difference here is 30. So that means the depreciation of this particular division must be equal to 30 and total depreciation is equal to 200. So this is how we have segregated property, plant and equipment between these two divisions. Is it clear to you or not? Right, sir. Further, it is given in the question, current assets are 1,500 crores and working capital is 1,200 crores as far as of establishment division is concerned. Now we know that current asset minus current liability is always equal to working capital. Is always equal to working capital. Now, as far as establishment division is concerned, it is written in the question that current asset is equal to 1,500. And working capital is also given to you as 1,200. Working capital is equal to 1,200. So we can safely conclude that current liability must be equal to 300, isn't it or not? Now further it is given that new project division to which remaining fixed asset, remaining current asset and remaining current liability related. We have already seen that as far as remaining current asset, because information with respect to fixed asset or property, plant and equipment of establishment division was available, we figured out the remaining portion of what we call property, plant and equipment, and we came to know that gross value of what we call remaining property, plant and equipment is 600, depreciation is 3570 is the net book value. Likewise, now first we will have a look over the current asset. Current asset given in the question, as you can see, 3000. Is it clear to you? Total current asset is equal to 3000. This column is of total. Out of total current asset, establishment division is having what we call 1500 worth of current asset. So quite obviously new project division will have, or should I say new project division must be having current asset of 1500. The difference of 3000 and 1500. Now we will look into the current liability. As far as current liabilities are concerned, total current liability given to us is equal to 2000. So I will write here 2000. 2000 is the total current liability. Is it clear to you? And out of 2300 is the current liability of establishment division. So we may say current liability of this particular division must be equal to 1700. Is it clear to you? Right, sir. It is absolutely clear. Now, if I will subtract 2000 from 3000, I may say total working capital is equal to 1000. Total working capital is equal to 1000. And out of that 1200 is the working capital of establishment division. That means working capital of this division must be negative. And you can also verify it because current liability is more than current asset. So quite obviously this division is having negative working capital. But importantly, we have figured out, now in this question we have figured out that as far as property, plant and equipment is concerned, net value of property, plant and equipment of this division is 30, we can say, and we can surmise. And similarly, we can say net book value of this particular division with respect to property, plant and equipment is 570. And as far as current assets are concerned, current asset is equal to 1500, we can say now. And even this division is having current asset equal to 1500. Also, we are able to trace out current liabilities. Current liability is 300 and 1700. This is the scenario at this particular moment. Is it clear to you or not? Right, sir. Further, it is given now in the question. So we have figured out the items of what we call fixed asset, current asset and current liability related to new project division. Now further it is given to us that following a scheme of reconstruction was agreed upon. I have already told you this entire process of demerger, sale of division, split offs can be summarized in one technical term, that is reconstruction. The new company, two new companies, Sunrise Limited and Khajana Limited are to be formed. So this time, this entity, demerged entity, is forming two new companies, that is Sunrise Limited and Khajana Limited. Correct? Further, it is given that authorized share capital of Sunrise Limited is 1000 crore. Although it is irrelevant information as far as solution is concerned, but still you will have to keep a track of it. And authorized share capital of Khajana Limited is 500 crore. Two new companies have been formed. Now, importantly, you are given that Khajana Limited is to take over investment at rupees 800 crores. So investment which is appearing in the balance sheet at 1000. Remember one thing. Regarding investment, no information was available in the question. Regarding in this particular item, no information was available in the question. Correct? Now it is being said that this investment was taken over by Khajana Limited at a valuation of what we call 800. So two new companies have been formed. One is Khajana Limited, another one is Sunrise Limited. And now it is given that Khajana Limited is taking over the investments. And further it is given that investments have been taken over at rupees 800 crores. So I noted down carefully at what value it has been taken over. That is 800, correct? Further, it is given unsecured loans at balance sheet value of 600. Not only investment, Khajana Limited also took over some loans also, and we can see in the balance sheet it is given as far as loans in the form of borrowings or unsecured loan is given. That is equal to actually 1000. Out of 1600 worth of loan have been taken over by this entity. So Khajana Limited is also taking over unsecured loans, correct? Unsecured loans to the extent of 600. Khajana Limited is taking over all these things. Further, it is given that Khajana Limited is to allot equity shares of 10 each at par to the members of Diverse Limited in satisfaction of the amount due under the arrangement. So, in this case, Diverse Limited, in this particular case, Khajana Limited is allotting what we call is to allot equity share. It is simply given that Khajana Limited is going to provide the purchase consideration, although purchase consideration is not given in absolute terms. It is written in the question that Khajana Limited is going to provide, where it is written, it is to allot equity shares of 10 each. How many equity share it is not given to us. So we do not know at this particular moment the amount of purchase consideration, but whatever may be the purchase consideration, it is being given to the members of Diverse Limited. So in this case, of course, purchase consideration is being given by way of equity shares, no doubt about that. And it is being given to the members. Further, it is also important. However, with respect to Khajana Limited, it is not written whether any shareholder is having more than 50% stakes in Khajana Limited or not, because Khajana Limited is a new company. Correct? No information is given. And if you remember, I talked about this particular fact, that if no information is given, presume it to be a case of common control. So in this case, all the transaction with respect to Khajana Limited, because this time two new companies are coming into picture. So our transactions, means the transactions of Diverse Limited with Khajana Limited will fall under the purview of common control. Correct? Further, it is given that book value of loans approximates the fair value. That means whatever value of loan which is given in the balance sheet, that is almost equal to fair value. Is it clear to you? Further, it is given in the question. Now, with respect to information number C, it is given Sunrise Limited is to take over property, plant and equipment. Sunrise Limited is taking over property, plant and equipment and net working capital of new project division. Now we come over to Sunrise Limited. As far as Sunrise Limited is concerned, so far the information is that Sunrise Limited is taking over property, plant and equipment of new project division. Now if you will see that net value is 570 of property, plant and equipment of new project division. Further, it is given and net working capital of the new project division. Now, net working capital means they are taking over current asset and current liability. So, current asset worth 1,500 are also being taken over by Sunrise Limited with respect to this particular entity, and also what we call current liability, 1,700. These three items are being taken over. Along with, this is just to confuse you, along with secured loans, we know that out of 1,000 worth of loans, 600 worth of loan was taken over by Khajana Limited and remaining 400 will be taken over by Sunrise Limited. So it is also taking over unsecured loans worth rupees 400. Correct? So this is how you will have to do the threadbare analysis. And just to confuse you, it is also given that it is taking over the obligation for capital commitment for which Diverse Limited is to continue to stand guarantee at book value. Normally in practical life, if there is any contingent liability, for example, there is contingent liability with respect to capital commitment. If a new company will take over this particular contingent liability, generally that entity which is transferring the assets and liability, which in this case is Diverse Limited. So it is telling to the Sunrise Limited, you don't worry about, you also take over this liability, but we stand as a guarantee that tomorrow if you will have to pay it, we will see to it that we compensate it for you. So no need to worry about that. Correct? This is, however, it is not going to have any implication in the solution. It is to allot, now Sunrise Limited is to allot 1 crore equity shares of 10 each as consideration to Diverse Limited. Sunrise Limited is to allot 1 crore equity shares of 10 each as consideration. Now in this particular question, it is given that Sunrise Limited is allotting 1 crore equity share. 1 crore equity share. 1 crore, I will write simply 1 crore. So 1 crore equity shares are being issued by Sunrise Limited and of rupees 10 each. So we may say that purchase consideration is equal to 10 crores. Correct? And it is given that this issue is to Diverse Limited. This is being given to Diverse Limited. This is being given to Diverse Limited. This is being given to Diverse Limited. Obviously, if it is being given to Diverse Limited, is it clear to you or not? Because this time it is clearly given 1 crore shares of rupees 10 each are being issued to Diverse Limited, and Diverse Limited happens to be the demerged entity. So quite obviously this will become common control. Till up to this particular point, it is appearing that both the situation is with respect to common control. Correct? Let's have a look further. Sunrise Limited made an issue of unsecured convertible debentures of 500 crore carrying interest at 15% per annum. Now Sunrise Limited, the new company, made an issue of what we call some debentures worth 500 crore. That means 15 crore. It is written carrying interest of 15% per annum. That means these debentures are 15% debentures. And these debentures are having a right to get themselves converted into equity shares of 10 each at par on 31st of 2023. Now the balance sheet date is actually 31st of March 2021. After 2-3 years, actually you can get these debentures converted into equity shares. Point is this. But right now, Sunrise Limited is issuing what we call 500 crores worth of debenture. This issue was made to the members of Diverse Limited as a right who grabbed the opportunity and subscribed in full. Now this is the most tricky point of this particular question. See here, for a while, because I told you in the beginning, when I was analyzing the what we call scenario of demerger, I told you that purchasing company or new company can directly give what we call purchase consideration to demerged entity, or it can give the consideration to the members. We talked about these points. In this case, no doubt about that, Sunrise Limited is delivering the consideration to the demerged entity. That is why it is a case of common control without any doubt. Correct? Number one. However, further, in this case, as we have just seen, that new entity is issuing some debentures. But these debentures have been actually acquired by the members. It is given clearly in the question. The issue was made to the members of the Diverse Limited. So for a while, some of us may feel, because I told you, if the consideration is received by the members, generally in that particular case, demerged entity never receives the actual consideration. This is what I told you in the earlier session, isn't it or not? But here you will have to be a little bit more careful. This time debentures have been purchased by members. In spite of that, demerged entity is going to pass the entry. Why, sir? Why? Because this time debentures have been purchased by members. So why demerged and why in the books of demerged entity we are going to do the entry? I will tell you. But what entry demerged entity is going to do? The demerged entity with respect to this will pass a very simple entry. Investment in debentures. Investment in 15% debentures investment in 15% debentures, 500 crores to bank account. This is the entry which this entity would pass. Now the main point is why demerged entity is going to pass this entry. Even though these debentures have been actually subscribed by the members, I tell you, you have to look into the question. Here it is written, this issue was made to the members of Diverse Limited as a right, as you have heard about what we call right share, correct? If you are the existing shareholder of a particular entity, then you have the right to actually subscribe the new share, provided the company is offering some rights issue. This right is coming to members because shares of new company Sunrise Limited are held by Diverse Limited. Because as we just went through the paragraph earlier, or in the preceding paragraph, it was written that consideration was being given to the Diverse Limited. Sunrise Limited is giving the consideration to the Diverse Limited. So Diverse Limited is actually holding the shares of this particular entity, Sunrise Limited. Actually, Diverse Limited is having the right to subscribe these debentures. So that is why the entry with respect to what we call debentures will be done in the books of demerged entity, because they have the right to subscribe these debentures. Is it clear to you or not? Even though it is written in the question that it is being made to the members of the Diverse Limited. So you must understand that why we are passing this entry in the books of demerged entity, which we are going to pass later on. I told you it's a pretty long question, tough question. Further, it is given Diverse Limited is to guarantee all liabilities transferred to the company. Again, it is an irrelevant information because this is always implied. Just a moment ago, I told you, if I am the organization and two new companies are taking over my assets and besides that liabilities also, so I will stand as a sort of guarantee to the transferred entity. Is it clear to you or not? Then, although it is not needed, it is always implied. Further, it is given Diverse Limited is to make a bonus issue of equity share in the ratio of 1 equity share for every equity share. So bonus issue is in the ratio of 1:1. Bonus ratio is in the ratio of 1:1. Now, what is the share capital of this entity Diverse Limited? Total share capital in terms of rupees is equal to 250. And because bonus issue is in the ratio of 1:1, quite obviously our total bonus issue will be equal to 250. So we will have to pass an entry for the bonus issue. This entry will be made in the books of Diverse Limited, no doubt about that. An entry will be reserves and surplus account debit 2, because for the purpose of bonus issue we utilize the reserves, and 2 equity share capital account, and entry will be with respect to 250. Now the question says that none of the shareholder hold more than 50% and none not related to each other. Till up to this particular point, we were under the impression, I was not under that impression, to be very honest with you, but I just want to solve the question from the perspective of a student. Correct? Earlier I told you with respect to ED division, where is ED division? And in between I also told you somewhere it appears that both the cases are of common control. Now the point is that it is clearly clarified in this question that none of the shareholder is having more than 50% stakes in the new entity. So, but point here is that this particular point, whether any shareholder holds more than 50% or not, comes into play only when consideration is given to the members. If consideration is given directly to the Diverse Limited, that becomes a case of common control. So our transaction with Sunrise Limited will fall under common control, but at the same time, as far as Khajana Limited is concerned, so far we were under the impression, because in this case Khajana Limited is delivering the consideration to the members, and so far till up to this particular point we were under the impression, or should I say you were under the impression, that it is a case of common control. But in the last line actually it is written that none of the shareholder, it is very specifically mentioned, so that means you are not going to treat it as a case of common control. You are going to treat it as a normal case of Ind AS 103, that means you will have to apply acquisition method of accounting in the books of acquirer company. Whereas in case of Sunrise Limited, because Sunrise Limited is the acquirer company, so Sunrise Limited definitely will do the accounting as per common control method. It will do the accounting as per acquisition method. Is it clear to you or not? This is the entire question. And in this question further, it is stated past journal entries in the books of Diverse Limited, and of course, prepare the balance sheet of the 3 companies after the scheme of arrangement. 3 companies means you will have to prepare the balance sheet in the books of Diverse Limited. You will have to prepare the balance sheet in the books of Khajana Limited. You will have to do the what we call accounting and prepare the balance sheet in the books of Sunrise Limited. I told you it's a pretty long question. We do not expect such a long question, but still, why to take any sort of risk? Now, many students, when I will say I'm going to solve the question, well, sir, why you are writing? This is the first feeling which arises in the minds of the student the moment actually I say so. But I have already told you, if you really intend to score good marks, you need to be prepared to write a lot, especially in our classes. So, question number 2.3, this is the question I am going to do for you. For better explanation, please, for God's sake, do write. Correct? If you are not going to write, that means you are deceiving yourself. First of all, I am going to write here journal, as I always do, Journal of Diverse Limited. Journal of Diverse Limited. We have to do some accounting in the books of Diverse Limited. So, Diverse Limited. In the books of Diverse Limited is the demerged entity. Remember one thing, correct? Now, in the books of Diverse Limited, first of all, I am going to write here A, transactions with Khajana Limited, because this time we are dealing with 2 entities, transactions with Khajana Limited. Transactions with Khajana Limited. I will simply write K Limited. Or okay, let me write Khajana Limited. Khajana Limited. As far as Khajana Limited is concerned, it was given in the question when I was analyzing the question. I told you that Khajana Limited is taking over our investments, correct, at a valuation of rupees 800. Khajana Limited is taking over investment. Although investment in the balance sheet is appearing at 1000. And further, they are taking over unsecured loan also. And out of 1000 worth of unsecured loan, 600 worth of unsecured loan was taken over by Khajana Limited. Only this information is given to us. Now see here. When I am going to write here entries, my first entry will be, I will debit Khajana Limited obviously, because Khajana Limited is taking over some of my assets and some of my liabilities. The liability which is being taken over by Khajana Limited is with respect to unsecured loans. And we have seen that unsecured loans worth rupees 600 have been taken over. So I'm going to write here 600. I will debit it off obviously. And they are taking over investment. Investment in the balance sheet is 1000 and they are taking over investment at rupees 800. Please let me know at what value should I write here investment. You are Diverse Limited. From your perspective, investment worth 1000 is moving out. So you will write 1000. You will not write actually at what value it is being taken over. Because from your perspective, an item which is appearing in the balance sheet at 1000 is moving out. So quite obviously you are going to credit investment by 1000. Is it clear to you? Is it clear to you or not? Now, in this particular case, from your perspective, net asset is equal to 600 minus 1000 are moving out. Correct? Net assets worth 400 is moving out. So you will presume, because purchase consideration is not given, so it means you will ask Khajana Limited to pay us 400 because you have taken over net assets worth rupees 400. Is it clear to you? This time purchase consideration is not given. So that is how you have found out the amount of purchase consideration. Quite obviously your net asset worth 400 are moving out. So you will ask the Khajana Limited to pay you 400. So it means Khajana Limited is supposed to pay you 400 rupees. Is it clear to you till up to this particular point? Is it clear to everybody? Okay, now we move over to the next part. In the next part, of course, next part deals with consideration. And we have already seen that Khajana Limited is paying the consideration directly to Diverse Limited. So we are going to pass the entry in this particular case, isn't it or not? Are we going to pass the entry or not? Yes, sir, we are supposed to pass the entry. In case of Khajana Limited, I am talking about who is receiving the consideration. Diverse Limited is receiving the consideration, or members are receiving the consideration? Members are receiving the consideration. That means Khajana Limited is paying the consideration to the members and not to the Diverse Limited. Please take care of this. Anyway, Khajana Limited is making the payment for purchase consideration. It will make the payment, no doubt about that. I am going to write first of all here by Khajana Limited. Khajana Limited. And Khajana Limited is supposed to pay us 400. This is what we have written in our books. But problem is that consideration is not received by us. Consideration is not received by us. Consideration is being received by members. So that means it is a sort of loss to us. I told you if there is a loss to you, it is better to set off the loss against the capital reserve, but problem is that you are not having any capital reserve in your balance sheet. We have already analyzed the balance sheet in a threadbare manner. We found that no capital reserve was there. So I will simply write here reserves and surplus, or other equity you can write. Reserves and surplus or other equity. Correct? So this loss, because of the fact that consideration was not given to you, rather given to the members, correct? So this is a sort of loss for you, and you are going to debit your what we call revenue reserves. Is it clear to you or not? These are your dealings with respect to Khajana Limited, because we have to pass the entry in the books of General Limited. So Diverse Limited is also having dealings in this case with transactions with Sunrise Limited. So under point number B, I will write transactions with Sunrise Limited. Transactions with Sunrise Limited. Correct? This is what we are going to write. With Sunrise Limited. Transactions with Sunrise Limited. Transaction with Sunrise Limited. As far as Sunrise Limited is concerned, it was clearly given in the question that Sunrise Limited is basically taking over your new project division. And we analyzed the question that it was taking over our property, plant and equipment, beside that current asset and current liability. And besides that, it also took over unsecured loans worth rupees 400 out of 1000. Correct? So, first of all, my first entry with respect to this entity will be, I will first of all debit Sunrise Limited. And it was given in the question that Sunrise Limited is supposed to pay us 10 crores worth of consideration, for which it will issue 1 crore shares of rupees 10 each, 10 crores. All figures are in crores. Correct? And Sunrise Limited is taking over, as I told you, your two liabilities related to what we call new project division. In fact, one liability with respect to new project division is current liability, and current liability was rupees 1,700 if you remember. So I will write here 1,700. Besides that, it is also taking over the remaining part of the unsecured loan. Correct? Now, total unsecured loan was 1,000, out of which 600 worth of unsecured loan was taken over by Khajana Limited. So I will write here unsecured loan. Unsecured loan of 400. Unsecured loan of 400. So I will debit it also 400. Correct? Two liabilities have been taken over. Besides that, two assets are moving out. Property, plant and equipment. Property, plant and equipment at written down value related to new project division we found out was equal to 570. 600 minus 30 depreciation, net book value 570. And then it also took over current asset. Current assets of new project division is equal to 1,500. Correct? Now after this, I am going to compare it. If I am going to compare it, the total is 2,110, and out of that, if I am going to subtract the figure, I am going to get a balancing figure somewhere here. And this balancing figure will be termed as capital reserve, because this is profit. Profit will always be transferred to capital reserve. So I am simply writing capital reserve. Of course, it is profit, and capital reserve will be equal to 40. Correct? This is the entry which you are going to pass. Very interesting question. I told you. No, and it is a time consuming question also. But anyway, point number B is related to consideration. And as far as Sunrise Limited is concerned, consideration is being received by the Diverse Limited. Isn't it or not? So this time we are receiving the consideration, and we are receiving the consideration in the form of the shares. So I am going to write here, first of all, equity shares in Sunrise Limited. Equity shares in Sunrise Limited. Equity shares in Sunrise Limited debit is equal to 10 to Sunrise Limited. That is equal to 10. 10 crore worth of shares have been received by Sunrise Limited. Is it clear to you or not? Clear? Is it clear to you or not? Equity share in Sunrise Limited account debit to Sunrise Limited. Just wait. Just hold on for a while, actually. Just give me 5 minutes of time. Just give me 5. Actually, there is a courier guy and I'm supposed to receive a big parcel. So just wait. Mummy, next class. अभी रैंक दोबारा पे डाल वो डाल देगा तो थोड़ी हो जाए काम तो सारे कर फास्ट काम कर क्या कर रहे हैं दे दे क्या हो गया Oh, really sorry for this sudden interruption. So I was talking about equity shares in Sunrise Limited account debit to Sunrise Limited, and remember one thing, this time the consideration is being received by Diverse Limited from Sunrise Limited. Is it clear to you? There was some more information in the question with respect to Sunrise, with respect to transactions of Diverse Limited with Sunrise Limited, for example, regarding what we call investments, isn't it? I told you the entry will be passed in the books of Diverse Limited, even though the debentures are being issued to what we call members, correct? And the entry will be investment in debentures, investment in debentures of Sunrise Limited, account debit. Debentures were 500 crore, 15% debentures. Even this entry you can also write investment, because when you are getting the equity shares of Sunrise Limited, indirectly it means you are making the investment. It is as simple as that. You can also write it investment in equity shares of Sunrise Limited, investment in debentures of Sunrise Limited account debit to bank account, because you are purchasing the debentures this time. That is 500. Is it clear to you? Further, there was one more information, if you remember, was related, that is with respect to bonus issue. And I told you the entry regarding the same, D. Reserves in surplus account debit or other equity. Bonus issue was in the ratio of 1:1, if you remember, to share capital, equity share capital. And it is equal to 250, 250. 250, 250. So these are our transaction with Khazana Limited and Sunrise Limited. Now, as far as part B is concerned, this was part A. And now we will prepare the balance sheet, in fact, balance sheet of Diverse Limited. Balance sheet of Diverse Limited. As far as balance sheet of Diverse Limited is concerned, correct? Diverse Limited. In order to prepare the balance sheet, first of all, I am going to write the assets. Under the assets, I am going to write, under the asset, I am going to write non-current asset. Under the non-current asset, you write property, plant and equipment. Property, plant and equipment, correct? Property, plant and equipment at net value you should write. Out of two division, establishment division and new project division, if you remember, correct? If you remember, 30 was the net book value of property, plant and equipment of establishment division, and establishment division is not taken over. So as far as Diverse Limited is concerned, property, plant and equipment will appear at rupees 30. Is it clear to you? Is it clear? Because 570 worth of property, plant and equipment related to a new project division has been taken over. So you are left off with this only. Then you write here investments. See here, as far as investments are concerned, in the balance sheet which was furnished to us, over there investment were appearing at 1,000. However, this 1,000 worth of investments were taken over by Khazana Limited. So investments have become zero. But we made investments of 500 crores. Diverse Limited has made investment, I told you just a moment ago, in what we call debentures. So investment in debenture. This is investment in debentures. Investments in debentures. It will appear at 500. Further, you have also made investments in Sunrise Limited's shares also. I told you, when you are getting the equity shares of Sunrise Limited, it is nothing but investment by a demerged entity in the what we call Sunrise Limited. So, your investment will also move up by 10. That means in the new balance sheet, investment will appear at 510. Is it clear to you or not? Now I will write current assets. As far as current assets are concerned, if you remember, total current asset is equal to 1,500. Total current asset is equal to 3,000, sorry. Total current asset were 3,000. Out of 3,000, okay, let me write it in this manner so that you shouldn't get confused. Total current assets were 3,000. Out of 3,000, establishment division's current asset 1,500 have been taken over. So current asset of, 1,500 worth of current assets of new project division have been taken over. So 1,500 remaining current asset relates to establishment division. Is it clear to you? Now please pay attention. Out of this current asset, I will also subtract 500. Now you may wonder actually why I am subtracting 500. Actually, I am subtracting 500 because we passed an entry, investment in debenture account debit to bank account. Because that is to bank. We have written an entry to bank, isn't it or not? And in the question, cash is not given, so I will subtract it from what we call this current asset. So that is the reason why I am subtracting 500, so 1,000. So now I will tally it, and it will be equal to 1,540. 1,540. So as far as balance sheet of Diverse Limited asset side is concerned, that is equal to this much. Now we come over to equity and liability. Equity and liability. As far as equity and liability is concerned, please pay attention. First of all, I am going to write here equity. Under equity, we write a share capital. Under the share capital, because in the balance sheet share capital is given of Diverse Limited 250 lakhs, and we passed an entry reserve in surplus account debit to share capital for bonus issue. On account of that, my share capital has gone up to now 500. Is it clear to you or not? Right, sir. Further, we have to write in fact other equity. As far as other equity is concerned, we saw in the balance sheet that other equity was given to us, I think equal to 1,350. I have forgotten, I will have to look at the question. That is the biggest problem. That is the biggest problem. 13, fortunately, question is lying here itself. Right, 1350, as you can see, I think right, 1350. 1350 is the amount. Sometime I tend to skip the figure. Actually, most of the time figures are memorized to me. So 1,350 is the other equity. First of all, let me write here other equity, 1350. Out of 1350, you must understand that Diverse Limited, when we pass the entries in the books of Diverse Limited, here we debited reserves and surplus account by 400 because we did not receive the consideration which was due from Khajana Limited. It was received by members. So on account of this, I will subtract 400 from the other equity. However, with respect to Sunrise Limited, there was capital reserve. I think it was 40. Right, capital reserve was 40. So I am going to add 40. And for the purpose of bonus issue, we have utilized 250 worth of reserves and surplus. So ultimately, in the outer column, I am going to write 740. Is it clear to you? Then after this, I am going to write here non-current liability. Under the non-current liability, there was subheading financial liability. Under financial liability, we had unsecured loan. But unsecured loan were 1,000, but 600 worth of unsecured loan taken over by Khajana Limited and 400 worth were taken over by Sunrise Limited. So ultimately, we will find that unsecured loan have become zero. Besides that, in the question, what we had actually current liability. As far as current liability is concerned, correct, current liability. Current liability, again, it seems the figure is lost to me. So I will have to look into the question once again to recap what was the figure of current liability. This is the problem only. Sometimes because such a long question is there, sometimes you tend to forget the amounts. Just wait. Something was written when we were analyzing the question. So current liability of establishment division is 300 only. So this is the remaining current liability. So I will write current liability at 300 only. So in the balance sheet, after the unsecured loan, you will write current liability equal to 300. Is it clear to you? This is how you are supposed to prepare the balance sheet. And 1540 should be the total. This is how you are going to prepare the balance sheet of Diverse Limited. Is it clear to you or not? After this, the next step is, because we are supposed to prepare the balance sheet of Khajana Limited and also of Sunrise Limited. So now I prepare the balance sheet of, let us say, Sunrise Limited. Balance sheet of Sunrise Limited. I told you it's a pretty long question. Sunrise Limited. As far as balance sheet of Sunrise Limited is concerned, balance sheet of Sunrise Limited I am talking about now. Now you presume you are the Sunrise Limited. And in the books of Sunrise Limited, we have to adopt common control method. Common control method. Why common control? Because consideration was discharged directly to the Diverse Limited. Common control. Isn't it or not? So, presume yourself to be the Sunrise Limited. You are almost taking over new project division, and from there you got property, plant and equipment, current asset and current liability. Besides that, you also took over what we call loan. So first of all, let me write it in this manner: property, plant and equipment. Property, plant and equipment. Account debit. 570 worth of property, plant and equipment of new project division was taken over by us. Besides that, we took over current asset to the extent of 1500 of new project division. We took one liability also, that is current liability worth 1700 of new project division. And also we took over unsecured loan to the extent of 400. Unsecured loan to the extent of 400. Clear? And we are supposed to pay a consideration of 10 crores. Consideration of 10 crores. So in this question, we are having balancing figure towards the debit side. And if you remember, under common control, I also told in the last session that don't write here goodwill. Although we have a habit of writing goodwill when balancing figure appears towards the debit side, correct? So it is better because no new asset should be recognized under common control. That is the reason it is better to write here capital reserve 40. Although negative capital reserve is nothing but goodwill. So this is the first entry. After the first entry, you are going to now discharge the consideration. When you are going to discharge the consideration, your entry will be consideration account debit 10 crores. And you are discharging the consideration through equity share capital. You are going to write here to equity share capital. And equity share capital will be equal to 10. Is it clear? Right, sir. Further, in this case, because Sunrise, you are the Sunrise Limited and you have issued some debentures, quite obviously you are going to write the next entry bank account debit to 15% debenture account. 15% debenture account. 15% debenture account. That is equal to 500. This is the entry you are going to write. Is it clear to you or not? Now we are going to prepare the balance sheet of this particular entity. Correct? After having written the entries, now we are going to, in fact, I have written here balance sheet, journal and balance sheet I should write. Balance sheet. First let me prepare journal and then balance sheet. Journal and balance sheet of Sunrise Limited. Now we shall prepare the balance sheet. I told you earlier also, in order to prepare the balance sheet in the new entity, you will have to focus only over the entries which you have written, and besides that, you will have to simply take care of the formats. Assets. One, non-current asset. Under the non-current asset, we have taken over property, plant and equipment. So I am simply going to write property, plant and equipment 570. Correct? Only one property, plant and equipment. Then I am going to write here to current asset. Under the current asset, we have taken over current asset worth 1,500. So I will write here 1,500. But we also received some cash also. 500 worth of cash is also received because of issuance of the debenture. Correct? So 2,000 will be the total. Is it clear to you or not? So 2,570 will be the total of the asset side. Is it clear? Right, sir. Now we come over to the second point. Equity and liability. Equity and liability. As far as equity and liability are concerned, under here, what we are going to do, first of all, I am going to write equity. Under the equity, I will write a share capital. Now, what will be the share capital of this entity? Because this is a new entity, so you will have to look into the balance sheet. We have issued equity share capital to the extent of 10 lakhs, so that is why I am going to write here 10 lakhs. As simple as that. Then I will write other equity item. As far as other equity is concerned, again I will look into the balance sheet, and this time there is a debit balance in the capital reserve. So I am going to write capital reserve negative balance 40. Don't write here negative balance. Correct? Simply write in bracket 40. Now, after this, we will have to write second, non-current liability. Because we took over unsecured loan, we presume that it is of non-current nature, and we are writing it here, and that is equal to 400. Besides that, current liability. As far as current liability is concerned, we took over current liability, I think, to the extent of what was the amount of current liability? 1,700, I think. 1,700. So I will write 1,700. So total will be equal to 2,570. After subtracting 40, we will get 2,570. Now I will prepare the balance sheet of Khajana Limited. Journal of Khajana Limited and balance sheet. Journal and balance sheet of Khajana Limited. In order to prepare the balance sheet, first of all, we need to prepare the journal. Just think of your transactions with Khajana Limited first of all to pass the entries. If you remember, as far as dealings with Khajana Limited concerned, Khajana Limited took over investment. It was given in the question. They took over unsecured loan also. Correct? This is the point. Now, in case of what we call Khajana Limited, we have to be careful. We have to be careful because here we have to apply acquisition method. Acquisition method. Because Khajana Limited discharged the consideration to the members, and none of the members is having more than 50% stakes in Khajana Limited. So proper Ind AS 103 will come into play, and Ind AS 103 states that acquirer company will record all the items at fair value. Now, important point is that mistake which could creep in is with respect to what we call investment. For example, we know that Khajana Limited is taking over investment, and it was clearly given in the question that investment was taken over at rupees 800. But because we are applying acquisition method, which states that assets must be recorded at fair value, so that is the reason I am going to write here 1000 rupees. Is it clear to you or not? Why I am writing here 1000? I hope it is clearer to everyone. Is it clear? Even though we are taking over the investment at 800, but problem is that we are applying acquisition method, which means that assets taken over and liabilities taken over must be at fair value. So investment. Further, to unsecured loan account. You took over unsecured loan also. As far as unsecured loan is concerned, that is equal to 600. And you are supposed to give consideration of 400. Consideration. So no loss or profit in this case, but you are supposed to pay 400. Second entry with respect to payment of consideration. Consideration account debit. We are supposed to make a payment of 400. I write 400. And entire payment is by way of share capital. So I will write here 2 share capital. Correct? In the outer column I am going to write 400. Is it clear to you? Then I prepare the balance sheet. Now we are in a position to prepare the balance sheet. As far as balance sheet is concerned, first of all, as usual, I am going to write the assets. Under the asset, I am going to write non-current asset. Under the non-current asset, I am going to write property, plant and equipment. Unfortunately, this entity is not taking over any property, plant and equipment. However, it is taking over investments. So you will record the investments. It took over and we have to record it at 1000 fair value, that is. Besides, the total will be equal to 1000. No current assets have been taken over. Now, equity and liability. Equity and liability. As far as equity and liability is concerned, first of all, I am going to write here equity and equity, and under it I am going to write share capital. Again, I will have to look into the balance sheet. Again, I will have to look into the entries. We have given share capital of 400. So quite obviously, I am going to write here 400. Isn't it? Then we will write here other equity. No other equity item is there. No capital reserve is there. Then I am going to write here second, non-current liability. That is unsecured loan worth rupees 600 we have taken over, and we haven't taken over any current liability. So total will be equal to 1000. Very interesting question. I hope each one of you would agree. Isn't it or not? Very interesting question. Isn't it or not? Right, sir. Very interesting question. We definitely enjoy doing it. Thanks a lot. So, after having completed such a mammoth question, gigantic one, now you can see it is given in a solved manner also. Correct? Now let's have a look over these two questions. Although it is self-attempt, I have kept this unit as a self-attempt one. 3.1 taken from module X, Y Limited has two division, X Limited, Y Limited. The draft information of X and Y Limited is given and figures are in rupees. The information which is given to you is that property, plant and equipment, as far as this division is concerned, it is having plant at a cost of 800 and this one is 400. Depreciation is this much, but we are more concerned with the written down value. So far, information is related to only one item. Then current asset is given very clearly 500 and 400. As far as asset sides are concerned, we have noticed very carefully two items, property, plant and equipment and current asset. Besides that, current liability is given 200 and 300, correct? 200 and 300 current liability. And then we have got borrowings in this case, that is nil and 200. Is it clear to you? Further, we are given in the question that equity share capital is 400, other equity item is 400 and 200, total is 600. So this is the information which is available in the question. Further, now it is given that Y division is sold to a new company. So Y division Y is being sold in this particular case, and it is sold to a new entity, that is Z Limited, and the consideration will be 250 lakh, and which will be issued by the new entity by issuing shares having a face value of 10. Question simply, actually in this particular question, if you can see very carefully, it is only given that Y division is sold to Z Limited and consideration of 250 lakh was settled by issue of equity shares of Z Limited. Number one. Number two, here it is given, presumed purchase consideration is received by members of XYZ Limited. In spite of that, we are going to consider it as case of common control. Why we are going to consider it as a case of common control? Because consideration definitely is being received by the members, but no information is given whether any shareholder is having stakes in the new entity or not. Is it clear to you or not? So first of all, as far as entries are concerned, first of all, pay attention. In this case, you think of what Y Limited, because division Y Limited is being transferred. I told you it is having only one item, property, plant and equipment 300, and besides that current assets. Sorry, two item it is having. So first entry which you are going to write in the books of demerged entity, the demerged entity will become XY Limited. So your assets which are moving out, you are going to credit it to property, plant and equipment 300. You are going to write two current asset, that is equal to 400. Besides that, in this particular question, as far as liabilities were concerned, one is in the form of what we call borrowings and another one is in the form of what we call your current liability. So you are going to debit the current liability and the borrowings. Is it clear? And then you will write the what we call amount of consideration which you are supposed to receive from Z Limited, which is given in the question, that is 250 lakhs you are supposed to receive. By comparing these things, you are getting balancing figure towards credit side. So obviously the profit will be transferred to capital reserve. You straight away write to capital reserve. Is it clear to you? You can easily manage this question of your own. Now coming over to the consideration point. Because consideration you are supposed to receive from Z Limited, that is 250, but unfortunately this consideration is not received by you. It is received by members. So this is a loss to you. No doubt about that, it is a loss to you. And this loss will be debited too, depending upon the fact whether you have got capital reserve or not. Because in this case, in the first entry, you had 250 worth of capital reserve. So it is better that this loss of 250 should be debited to capital reserve. Sorry, in the first entry, we had capital reserve only 50. We had capital reserve of only 50. And we are debiting the loss to 250. In fact, you should write in this manner in this particular case. This entry is not written correctly, so you better write it in this manner. Other equity account debit, capital reserve account debit to Z company. We are supposed to receive 250 of consideration because it is a sort of loss, but in the capital reserve we are having only 50. So I will debit the loss of 250. Out of 250 I am going to debit to capital reserve 50 and balance of the loss will be debited to other equity item. Is it clear to you? You better write this entry. So this is how you should move along. Now you will have to prepare the balance sheet. If we are going to prepare the balance sheet, obviously whatever items which are left, we are going to simply write. For example, in this particular case, we had two divisions, X division, Y division. Now 300 worth of property, plant and machinery has gone out. We are left off with only 200 worth of plant and machinery. So only this machinery will appear in the balance sheet. Correct? Similarly, as far as current assets are concerned, current asset were 400 worth of current asset have gone out. So we are left off with only 500 worth of current asset. So I will write current asset, that is 500. So total will be equal to 700. Only two assets were there. We have written both the assets. Coming over to what we call equity and liability side. First of all, I will write the equity share capital fine 400. Now see here, as far as surplus is concerned, total balance is 400 and 200. Is it clear to you? 400 and 200. So first of all, I am going to write here under the other equity where I have written, this is the balance sheet. You write in this manner, 400 plus 200. First of all, you write 400 plus 200. Is it clear to you? The items which are appearing in the balance sheet. 400 plus 200. You have added it. Total is equal to 600. From 600, because in the entry which we just wrote a moment ago, 200 was debited. So I will subtract 200. I will subtract 200. So ultimately, my net other equity will be equal to 400 in the balance sheet. Is it clear to you or not? And in this question, there is no capital reserve balance because whatever capital reserve was there, 50, that got offset by debit to capital reserve 50. Is it clear to you? This is how you are going to write. So 400 will appear in the outer column, but in this manner. This is the way to reflect. Current liabilities only 200 is remaining. So this is your balance sheet. Now coming over to Journal of Z Limited. As far as Z Limited is concerned, Z Limited will record all the asset which it has taken over. It has taken over property, plant and equipment, 300 worth, current assets, 400 worth. Besides that, it has taken over what we call current liability and borrowings. It will pay consideration of 250. Balancing figure is capital reserve. Don't write here goodwill. Correct? This is a case of common control. No new asset should be recognized. Now, as far as consideration is concerned, we will discharge 250 worth of consideration by paying the share capital. Now, accordingly, on the basis of these two entries, we will have to prepare the balance sheet. In these two entries, we have written property, plant and equipment 300. In the entry, we have written also current asset total is 700. And in the entry, we are issuing 250 worth of share capital. So share capital will be 250. In the entry, we have incurred a loss, correct, by debiting the capital reserve. So capital reserve will have a debit balance that is negative 50. And we have taken over borrowings of 200 and current liability of 300. So total will be equal to 700. This is how you are supposed to do this particular question. Is it clear to you or not? Coming over to 3.2. Even this question can be managed by yourself. In this case, Max and Mini Limited has two divisions. Try to understand in this question. Name of the company is Max Mini Limited. Max Mini Limited is your demerged entity. Max Mini Limited is your demerged entity. And this entity is having two divisions by the name of Maxi Limited and Mini Limited. Maxi Limited and Mini Limited. This entity has got two divisions, Maxi Limited and Mini Limited. Is it clear to you? Right, sir. And my tea in the meantime is almost has become like a cold drink. Correct? Like a cold drink it has become. So, as far as scenario in the balance sheet is concerned, this is one division Maxi, this is another division Mini. Total is also given to you. In this case, you are being given property, plant and equipment, of course, as usual, 600, then depreciation is also given, but more concerned with what we call written down value. Total written down value 300, out of which Mini division share is this much, Maxi division share is equal to this much. Further, we are being given net current asset. Current asset 400, 300, and in the outer column it is written 700, whereas current liabilities are 100, 100. They have subtracted current liabilities from the current asset and shown what we call net current asset. You are not concerned with net current asset. You simply presume that current assets are given and current liabilities are given. Two items is still in the question. One is, as far as the asset side is concerned, property, plant and equipment at written down value 100 and 200. And likewise, current asset 400 and 300. This is how you have to analyze the question. As far as current liability is concerned, you are being given loan funds but loan funds are related to only this division, that is mini division, correct? And then just to confuse you, it is given that this loan has been secured on fixed asset. It is not going to have any impact. As far as capital is concerned, that is actually 50. As far as reserve and surplus or other equity is concerned, that is equal to 650. And then total is also given to you. This is the information in the question. Correct? So as far as liability side is concerned, we may say that as far as liability side is concerned, there are two liabilities of this division, that is mini division. Correct? Mini division. One is current liability, that is current liability is equal to 100, and what we call borrowings are also there. Borrowings, where is borrowings? There were some borrowings in the question, isn't it or not? Right, loan funds. Loan funds were there. Loan funds to the extent of 100. Two liabilities and two assets. As far as assets are concerned, we have already seen property, plant and equipment is given. Written down value is 200. You will write here 200, and besides that we are being given current asset. You will write current asset to the extent of 300. So this is how you have segregated them into items. You have simplified the question now. Further, it is given, it is decided to form a new company mini limited. A new company mini limited is formed. So a new company is formed by the name of mini limited. Mini limited is the name of the new entity, mini limited, correct? Now it is given, it will take over the assets and liability of mini division. That means mini limited will take over mini division. New entity mini limited will take over mini division. Is it clear to you or not? Further, it is given in the question, accordingly, mini limited was incorporated to take over the balance sheet figure, at balance sheet figure, the assets and liabilities of that division. Fine. Mini limited is to allot 5 crore equity shares of 10 each to the company, to the members of Maxi Mini Limited in settlement of the consideration. So purchase consideration is actually 5 crores. Purchase consideration is 5 crores. Sorry, 5 crore equity shares of 10 each. So purchase consideration will become your 50 crores. And it is being given to the members. The members of Maxi Mini Limited are therefore to become the members of Mini Limited as well without having to make any further investment. Quite obviously. Because when Mini Limited will offer the share, to the members of Maxi Mini Limited of demerged entity, when it will offer the share of members limited, obviously these members will not have to pay anything. Is it clear to you? Because this entity has already received this division, and in lieu of that it is offering the shares. So this line is just to confuse you. Now it is given, you are asked to pass the journal entries in relation to the above in the books of Maxi Mini Limited. So we are supposed to pass the entries, we are supposed to prepare the balance sheet. Is it clear to you? I think you can easily do this question. Now in this particular question, we have already segregated the items. Isn't it or not? We have segregated the items. Now, could you do this question of your own? Be honest and tell me. I think you should be in a position to do this particular question. We have already done question number 3.1, and I think 3.2 you should be in a position to do. Isn't it or not? Right, sir. We should be in a position to do. Okay, if you are in a position to do, then let me actually ask you, because if I am going to unfold the solution before you, then you will be able to tell me the answer quite easily. Okay, you tell me what will be the first entry in the books of Maxi Mini Limited. Suppose if I am going to ask you, Maxi Mini Limited is demerged entity. Maxi Mini Limited. Now you let me know, as I am figuring out, I'm trying to find out whether you are in a position to read. I know that some of you are working student and you are not having enough time to do the homework questions. So I am doing homework on your behalf. Correct? How cool and fine person I am. Isn't it or not? On your behalf, I am doing the homework. So please let me know what will be the first entry, how you are going to prepare the journal. We have already segregated the question. One of your division known as mini division is being sold to what we call mini limited. Mini limited. Obviously, you are going to debit the mini limited first of all. And from mini limited, how much purchase consideration you are supposed to receive, sir? We are supposed to receive 50 crores worth of consideration, obviously. Now think of the two liabilities which you are actually transferring to this entity. One was loan funds, as we talked about. Loan funds in the balance sheet is equal to 100 crores. So you will write here 100 crores. Besides that, in the question, there is current liability, and current liability is only to the extent of 100. So these two liabilities you are transferring. Besides that, you are transferring what we call sum of your asset. One among them was property, plant and equipment having a written down value of 200. So you will write 200. Besides that, you are transferring current asset. Current asset worth 300 transferred by your company. Obviously, in this case, you can see there is a loss actually, because 500 minus 250 is equal to 250. So there is a loss. Obviously, you are going to debit the loss. Now the point is that I have told you several times, because you are not having any capital reserve, you simply debit your reserve and surplus. This loss will be debited to reserve and surplus because in the balance sheet we have been given reserve and surplus, and the loss will be equal to 250. Is it clear to you or not? Right, sir. This is the entry which you are supposed to write. After having written this particular entry, next entry is with respect to consideration. Now coming over to the consideration, as far as consideration is concerned, this is going to be the second entry in the books of Max Mini Limited. Obviously, you are going to credit the Mini Limited because Mini Limited will have to discharge the obligation. That is 200, that is 50 only, 50 lakhs or 50 crores, whatever it is. But problem is that consideration is received by the members. You are not receiving the consideration. So again, you are going to debit your reserve and surplus account. That is equal to 50 because it is a loss. Now, you will have to prepare the balance sheet. You will have to prepare the balance sheet of what we call demerged entity. Balance sheet of demerged entity. Demerged entity means Max Mini Limited. Now you will prepare the balance sheet of demerged entity, isn't it or not? Yes, sir, we are supposed to. In the balance sheet, you are going to write the assets. Under the asset, you are going to write the non-current asset. Only one item of non-current asset is given in the balance sheet, and that is property, plant and equipment. Think of the division not taken over. The division which is not taken over, mini division is taken over. Maxi division is not taken over. And written down value of maxi division, you simply write here for 100. Then we have in this case current asset. I will write here 2. Current asset. Similarly, current asset of mini division taken over, current asset of maxi division is still with the demerged entity. So you will write the current asset of the division not taken over, 400. So you can easily and in a straight manner prepare the balance sheet, 500. Correct? Then you are going to write here equity and liability. As far as equity and liability is concerned, under the equity and liability, you are going to write first of all one equity. Under the equity, you will write a share capital. Obviously, the share capital, first of all, we are going to write, and share capital of the organization in the balance sheet is given as 50, as we saw earlier. Then I am going to write here other equity items, or simply reserve and surplus you can write. Other equity item is 650 given in the balance sheet. And out of that, there is a loss of 250, so I will subtract 250. Again, there is a loss of 50. Again, I am going to subtract 50. So I will be left up with 350. So 350 will appear in the outer column. Correct? In this question, there is no non-current liability. Actually, non-current liability was there, but it was related to mini division loan funds, and it has been taken over. So now, no non-current liability. Current liability, 100 of the division is still with the organization. So total will be equal to 500. Is it clear to you or not? So easy. Easily you can do this question of your own. Now you have to prepare the journal of mini limited. Now if I am going to prepare the journal of mini limited, as far as mini limited is concerned, because it is taking over two assets, so it is going to record property, plant and equipment of mini division. It has taken over 200. Current asset also it took over worth 300. Are you getting my point or not? 300 worth of current assets have also been taken over. Besides that, this entity has also taken over current liability. Current liability was 100. It also took over loan funds, LF, also 100. And it will discharge the consideration to the extent of 50. In this case, there is a gain. Gain you will write to capital reserve 250. This is your balancing figure. Further now, only thing remaining is discharge of consideration. 250 worth of consideration this entity is supposed to discharge. So 250 to share capital. So on the basis of these two entries, we will have to prepare the balance sheet of mini limited. I will prepare the balance sheet of mini limited quickly. Asset side. As far as assets are concerned, correct, one I am going to write non-current asset. Under the non-current asset, I am going to write property, plant and equipment. That is equal to 200, so I will write here 200. Second, I will write current asset. Current asset is 300, so total will be equal to 500. Then we will write the liability, equity and liability. As far as equity and liabilities are concerned, one, we will write equity. Under the equity, we will write a share capital. Now, what will be the share capital? Because this is a new entity and this entity has issued share capital of 250. So I'm going to write here 250. Correct. Then I will write other equity. As far as other equity is concerned, in this case, capital reserve has taken place. So capital reserve, and it is a credit balance. Capital reserve is 250. Sorry, I have written here 250. I am extremely sorry. This is the point actually I was thinking of. Because purchase consideration actually is 50 and I have written here 250. Purchase consideration is 50 only. Extremely sorry. So first let me actually clarify this one. Share capital actually is 50 and not 250. I will write here 50. And then capital reserve is 250. Capital reserve I will write 250. Besides that, we have taken over loan funds. So 2, non-current liability in the form of loan funds. Loan funds is equal to 100, so I will write here 100. And then I am going to write current liability. Current liability is equal to 100. So total will be equal to 300 plus 200, 500 only. So this is how you are supposed to prepare the balance sheet of this particular entity. Is it clear to you or not? Right, sir, absolutely. We have understood each and everything. You have understood each and everything. That is fine. Now, actually it is not needed at your level. Just to make you understand a little bit extra, I will not consume your much of time. Don't worry about that. I'm going to ask you a very simple question. Correct? Suppose if I am going to ask you, although it is not needed, just for your knowledge sake. Suppose net assets, if I am going to ask you of Maxi Mini Limited. Maxi Mini Limited. Maxi Mini Limited before demerger. That means before it sold off its division. Before demerger. Suppose if I am going to ask you the amount of net assets before what we call it sold the division, that means before demerger. How will you tell me the net assets of this division? You will simply look into the column of the total and you figure out the asset, correct, in order to find out the net assets, correct? For example, in order to find out the net assets, you will simply look into the total column, trace out the asset, and from there on subtract the liability. Since we have already done so, we know that total asset, one was in the form of property, plant and equipment, and another was in the form of what we call current asset. So total asset is equal to 1000. And as far as liability are concerned, there are two liabilities, 200 plus 100, that is equal to 300. Correct? So net assets will be equal to 700. Remember one thing, net asset can also be found out in this manner. Net asset is also equal to equity. And equity stands for share capital plus other equity, that is reserve and surplus. Now share capital given in the question as 50, other equity in the total column is given as 650. So we can say that net asset is equal to 700. So either way you can find out the net asset. I am simply asking you the net assets of this entity, demerged entity, before what we call demerger is equal to 700. Is it clear to you? Suppose I want to know the intrinsic value of share. What is intrinsic value of share? Intrinsic value, intrinsic, inside value. And what is intrinsic value actually? That you will learn when we will do valuation of share. But at this moment, intrinsic value of share is found out by dividing the net assets by number of equity shares. By number of equity shares. For example, in this case, net asset is equal to 700 and number of equity share is 5. Correct? 5 crore. 700 crore divided by 5 crore. If we will divide it by net assets, we get intrinsic value per share. Intrinsic value per share signifies that in case if this company gets liquidated, how well company can actually pay to the shareholder. Because one share is of 100 each, so we may say that if you are holding a share of 100, you need not require to worry even if the company goes into liquidation, because you are in safe hands. In the sense, intrinsic value of the share is 140. To back one share of 100, there are assets worth rupees 140. So intrinsic value of share basically is used by the investor to know the health of their investment. Is it clear to you or not? Is it clear? Fine. Okay then. Now we come over to, I'm asking this question because although it is not asked, but in case if it is asked, you should be in a position. Suppose the question asks you also compute intrinsic value before what we call demerger. So you can give the answer in this manner. Similarly, suppose if I ask you intrinsic value post-merger. After the demerger, sorry, I have written post-merger, actually it should be demerger. Post-demerger. Post-demerger, after the demerger, suppose if I want you to compute the intrinsic value. Now just try to understand. Max Mini Limited. And now there is also Mini Limited. Now there are two entities. One Max Mini Limited, although it is having only one division. And there is also another company, Mini Limited. We will compute their net assets. If you will compute their net assets, which you can do so very easily, their net assets will be equal to 400 and its net assets will be equal to 300. Its net assets will be equal to 300. Mini Limited's net assets will be equal to 300. Actually, just to make the point a little bit clear, you can see here, Mini Limited's asset is equal to 200 plus 300, 500, and there are two liabilities. So net asset is equal to 300. It is as simple as that. Similarly, you can compute the what we call net assets of Max Mini Limited. That means what you will look into the balance sheet which you have drawn out after the what we call demerger. You have already drawn out the balance sheet, isn't it or not? So you have already drawn out the balance sheet of demerged entity after the demerger. So look over there, simply take into account the net asset. So you will find net asset is equal to 400 and 300. Now I will divide it by the number of share. Number of share will be 5 crore. 5 crores. Now if I divide it by that, we get intrinsic value 6, 400 divided by 5 is equal to 80, I think. So it is equal to 80. Intrinsic value of 80 and 60. What we find that still the intrinsic value is coming to 140. That means shareholders are not losing out on account of this entire process. This is the significance of computing the intrinsic value of share post demerger and before the demerger. Suppose if post merger by combining these intrinsic value would have been 130, then I would have said that shareholders have lost out a bit because of this entire process. But generally in practical life, just for the knowledge sake actually I'm talking about, whenever a company goes for the scheme of demerger, splits off, it goes it in such a manner so that there is no loss to the existing shareholders. Is it clear to you? This is what actually I just wanted to make you understand. As a professional student, you need to have this idea. But from the examination point of view, you will never be asked all these things. Don't worry. So you have to solve this question only up to this particular stage. So in this particular session, as you can see flashing on your screens, we are going to start yet another topic, section 4. Of course, we have finished section 3, which was quite formidable, and section 2 also, because it dealt with common control, and you can always expect a long question from common control. I hope by now everything is absolutely clear to each one of you, and good evening to one and all once again, and at the same time those who have connected with us through SAS, a lovely good evening to everyone. So now we are going to start this particular section without much ado, and we come directly to the business end. So you have seen the section. I will require the space, I will create the space, and now we are going to write a lot. Yes, we are going to write a lot, even though it is freezing cold here in Delhi today. And since last 3-4 days, actually, it is very cold out here. So we start today's this particular session, and I told you as far as this particular session is concerned, correct, it deals with books of acquiring company. But when we will have to prepare the books of acquiring company, that is also a major question. If you remember in the initial stages, I did talk about this particular fact that we can acquire the control of the other entity either through majority stakes or by way of agreement. But generally under such a situation, the existence of the other entity continues. Other entity doesn't come to an end. Existence of the other entity doesn't come to an end. Rather, it remains what we call under control of the acquirer. However, under rare circumstances, we can also get hold of the other enterprise by simply taking over their all the what we call assets and liability. And if we remember, under such a circumstance, I talked about this particular fact that the existence of the other entity will come to an end. So when the existence of the other entity will come to an end, in that case, how the accounting will be done in the books of the acquiring company, that you need to know. And for the same, we are going to actually see this particular section. So first of all, let me actually write the heading of this particular section, section 4. And as I have already told you, this particular section deals with books of acquiring company. So kindly write and be honest. Don't think that everything is written in the notes, so you should refrain from what we call writing. Books of acquiring company. Books of acquiring company. Correct. Just a moment ago, I told you this particular concept we would require only when the situation will be like this. When acquirer acquires acquiring company, when acquirer acquires acquiring company by purchasing its net assets. So when we are going to take all the assets and liabilities, quite obviously in this case, the existence of the other entity will come to an end. When acquirer acquires acquiring company by purchasing its net assets and existence and existence of acquiring company comes to an end. So under such circumstances, you need to know actually how the acquiring company would actually prepare its accounts. So in order to know that, I will take you a little bit what we call back. If you remember actually in your earlier phases of education, you have done a chapter by the name of partnership, or at some or other point of time, you might have done dissolution, should I say so. Dissolution of partnership, you remember. Even the dissolution of partnership, even under the dissolution of partnership, the business comes to an end. And over there, do you remember actually what account you used to prepare? Please let me know actually if you remember, some of you. Which accounts you used to prepare? If you remember, and if you are going to put up a little bit of what we call stress upon what we call your mind, you will come to know and you will recapitulate that you used to prepare realization account. Then you used to prepare partners capital account because partners are the owners of the business. And besides that, you used to prepare the cash account. I hope I'm right, isn't it or not? So these accounts you used to prepare, and you know how you used to prepare. So same analogy now you can derive with respect to what we call acquiring company. Now you will have to look from the perspective of the acquiring company, because the business of the acquiring company has come to an end. So here also you are going to actually prepare those accounts which I just mentioned, but with little bit of difference. Realization account you are going to prepare. Over there, in partnership, you used to prepare actually partners capital account, they are owners. But in case of a company, as you know, the owners happens to be the shareholders. So you are going to prepare the shareholders account. Cash account also you will prepare. But only difference is that this time the business is coming to an end because somebody is purchasing our business. Whereas in case of partnership, this was not the scenario, isn't it or not? So that is the reason here, besides these three accounts which I just mentioned, we will have to prepare purchasing company account also. Now kindly write along with me. So as far as accounting is concerned, in this particular case, now we come over directly to the accounting portion. Accounting. As far as accounting is concerned, a moment ago I told you, acquiring company shall open. Please take the pain of writing, shall open following accounts. So in the books of acquiring company, we are going to open these accounts which I just mentioned. One, realization account. We are going to open realization account, correct? Realization account. Besides that, we are going to open shareholders account or owners account, as you can say so. Shareholders are owners. Shareholders account. Then we are supposed to prepare cash bank account. And besides these three accounts, we will have to prepare one more account, that is acquirer company account. Acquirer company account or purchasing company account, you may call it acquirer company account. Now the next question is how we are going to prepare these accounts. The point is this. In order to prepare these accounts, first of all, under the first step, what we are supposed to do, first step. See here, please, and don't skip a point. Lots of questions are being asked from this particular area that I will tell you later on. Correct? First, your basics should be absolutely clear, and conceptuality should be very, very strong. Now, under the first step, because we are the company whose business has come to an end, we have got now liquidated. Everything we have to visualize from the perspective of the acquiring company, as I just told you. Now, under the first step, what we are going to do, we are going to close all our assets. So, your first step will deal with closure of asset side. That is closure of asset side. So, I will write here closure of asset side. Closure of asset side. Closure of asset side. Closure of asset side. So first of all, we are going to close the asset side. In order to close the asset side, I am going to prepare a diagram. First of all, we need to know the meaning of asset side. Entire asset side can be divided into two major parts. Entire asset side can be divided into two major parts. See, every item which is present towards the asset side cannot be classified as an asset. For example, often you might have seen actually that on the asset side we come across items like discount on issue of shares, discount on debentures, preliminary expenses, underwriting commission. So even though these items appear on the asset side, but we cannot actually categorize them as asset because as per the accounting framework, correct? What is the definition of an asset? Definition of an asset as per the accounting framework is it is a resource which is controlled by an enterprise and it is capable of fetching you returns for a prolonged period of time. That is how we classify the assets. So technically on the asset sides, first of all, for simplicity's sake, I am going to divide it into two parts. Entire asset side can be divided into two parts, correct? On the asset side, there will be some items which will be classified as assets. Now, I just told you the meaning of assets, correct? And besides that, there might be some items which are appearing on the asset side, but technically they are not in real sense assets. We will call them valueless asset. Although it is not a legal jargon, this is just for simplification. I am writing valueless items, correct? Valueless item. I gave you the example of valueless item just a moment ago. For example, as far as valueless items are concerned, examples are like preliminary expenses. Preliminary expenses, if we want to write preliminary expenses, underwriting commission, in short form I have written U/C, discount on issue of shares and debentures, discount on shares and debentures. Any suspense account, any miscellaneous expenditure item. So all these items are basically classified as valueless item. Technically, they are not assets. Is it clear to you or not? So on the asset side, first of all, you need to know, being a professional student especially, that basically asset side comprises of two things. One, assets which in real sense are assets, and another one is valueless asset. They appear on the asset side simply because they have debit balance, otherwise they have got no value. Is it clear to you or not? Once you know all these things, now second point is that then as far as assets are concerned, even assets can be divided into two parts. Even assets can be divided into two parts. Even assets can be divided into two parts. One, I will say, for simplicity's sake, cash or bank. Cash or bank. Cash bank. And other assets or assets other than cash, correct? Assets other than cash. 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 Is it clear to you or not? Right, sir, it is clear to us. So if it is clear to us, I told you under the first step, you are going to close your asset side. That means you have to transfer every item of assets towards some other account. In fact, one among what we call the accounts which I just mentioned earlier. So as far as valueless items are concerned, quite obviously, when new company will take over your business, do you think the new company or the other company will ever take over your valueless item? No one will take over your valueless item. If I am purchasing the business of somebody, I will refrain myself from taking over their valueless assets. So that is why valueless assets are never ever taken by the new entity. You must understand first of all this thing in the initial stages itself. So valueless asset, who will then bear the valueless asset because the existence of the entity has come to an end? As you know, owners are responsible. When owners have the right to take away the part of the profit it is their responsibility also to bear the losses. Actually, they are a sort of losses. So that is why all the valueless asset will be transferred to the debit side of the shareholder. So these item will be transferred, T oblique F I have written, transferred to the debit side of, to the debit side of, to the debit side of shareholders account. All these items you are going to transfer to the debit side of shareholders account. SH stands for shareholders account. Is it clear to you or not? Besides that, now we come over to all these items. As far as cash, no doubt about that, that purchasing company is taking over your assets. That with purchasing company is taking over your cash and bank and other assets. But as per the agreement, sometime purchasing company may not take over your cash. Is it clear to you? So you have to be careful only with respect to cash. Only with respect to cash you have to be careful. If cash has been taken over, if cash has been taken over, I am simply writing if taken over, T oblique O. T oblique O means if it has been taken over by the purchasing entity, then you are going to transfer it to the debit side of realization account. Debit side of realization account. Debit side of realization account. In that case, I am going to transfer this item to the debit side of realization account. Is it clear to you or not? If cash has been taken over, then I am going to transfer it to the debit side of realization account. In short form, I have written REL. If not taken over, if cash hasn't been taken over, NTO, not taken over, in that case, I am going to simply transfer it to the debit side of cash account. So regarding cash only, you will have to exercise the caution. Debit side of cash account. Is it clear to you or not? If cash is not taken over, in that case only you are going to take it to the debit side of the what we call cash account. You will simply write balance brought down. If cash has been taken over, you are going to transfer it to the credit side of the realization account. As far as all other assets are concerned, all the other assets, whether property, plant and equipment, land and building, correct, tangible asset, intangible asset, stock, debtors, whatever other assets are there, all the other assets will be transferred to the debit side, shall be transferred to the debit side, transferred to the debit side of realization account. Transferred to the debit side of realization account. Debit side of realization account, whether taken over or not. That is very important. All other items of assets, whether taken over or not, you are going to transfer them to the debit side of realization account. Is it clear to you or not? Transfer to the debit side of realization account, whether taken over or not, whether taken over or not. Irrespective of the fact whether other items have been taken over or not, you are going to transfer them to the debit side of realization account. Is it clear to you? That is how you are going to actually close your asset side. Once your asset side is closed, obviously now you're under the second step, you are going to move over to the liability side. Second step. Now you will close your liability side. This should be your second step. Closure of liability side. Closure of liability side. Now you are going to close your liability side. Correct? Liability side. Now you are going to close your liability side. As far as closure of liability side is concerned, again, the liability side can be actually segregated into three broad categories. As a professional student, you need to know all these things. Then only you will be able to understand and comprehend the things, and it will hold you in a good state, not only for this particular chapter, but later on when you are going to do amalgamation, absorption, internal reconstruction. Even over there, you'll find it, all these points are coming up to you very handy, correct? So now, obviously, as far as liability side is concerned, we can divide the entire liability side into three major categories. One is share capital, no doubt about that. Another one is Another one is reserves, and finally liabilities. Correct? What I told, entire liability side can be segregated or can be what we call divided into three parts. One is capital, another one is reserves, and finally liabilities. Now, as far as share capital is concerned, it is very simple because we are preparing the shareholders account in this particular case. As far as shareholders are concerned, you are going to take the balance of the share capital to the credit side of the shareholder. So it will be transferred to the credit side of shareholders account. So closure of share capital is not going to pose any sort of what we call problem. Simply we are going to take the share capital to the credit side of shareholders account. Coming over to the reserve, and you need to have a very sound knowledge of reserves. Correct? I keep on telling all these things. Then only you will be able to solve the question in a proper manner. If we will look into the last 4 attempts, every year question is there, correct, where you requires this sort of knowledge. Now I will tell you later on why, but first let me actually here explain the things. As far as reserves are concerned, we can divide the reserves into 3 broad categories. One is free reserve. One is free reserves. Under the free reserves, generally we include under the free reserves will include like general reserve, correct, like reserve fund. I'm using the short form, don't worry about that, you are already acquainted with all these things. Even retained earnings, RE, profit and loss account balance, P, profit and loss account, PL. For example, security premium. Now some of you may say, sir, security premium is a capital nature reserve. Absolutely, no doubt about that. I'm not telling that it is not a capital nature reserve. I'm telling it is a free reserve. Remember one thing, the existence of this company has come to an end. So all these reserves have become free now. If there will be any balance, let us say in workmen compensation fund account, it will also be treated as free reserve. Is it clear to you or not? Even if there is any balance in insurance fund, it will also be treated as free reserve. Remember one thing, is it clear to you or not? If such balances appear on the what we call liability side, then you will treat them as free reserve. Now what will be the treatment of the free reserve? All the free reserves will be taken to the credit side of shareholders account. Now let me caution you, purchasing company can take over your assets in real sense, which are assets, correct, and liabilities only. Purchasing company cannot take over, or should I say purchasing company will not take over your share capital, your reserves, or for that instance your valueless item. Purchasing company will take over only your assets and liability. Remember one thing and never let it escape out of your memory. So as far as security premium is concerned, free reserves are concerned, it will be transferred, as I told you, to the credit side of shareholders account. Transferred to the credit side of shareholders account. Credit side of shareholders account. Is it clear to you? All these items will be transferred to the credit side of shareholders account. As simple as that. Now, as far as reserves are concerned, I told you reserves can be segregated into 3 broad categories. The second category will be known, in fact, second category is known as statutory reserve. STATUTORY, statutory reserves. Now, what are statutory reserves? Statutory reserves are those reserves which an entity is forced to make. For example, if an entity is operating in a notified zone, say economic zone, say special economic zone, or what we call notified area, like industrial park, correct, or software park. So these are basically notified zones. If an entity operates in a notified zone, sometimes there are some pressure and foundations, correct, by the law upon such entities to transfer every year a part of their profit to these reserves, and these reserves are known as statutory reserves. So statutory reserves are basically, you can say, made by an entity simply out of force, correct? Out of not willingness, but out of some force. They are compelled, they are bounded. Is it clear? So generally under the statutory reserves, we include items like, you must have heard about these items like foreign project reserve account, correct? Foreign project reserve account. Foreign project reserve account. Foreign project reserve account. Foreign project reserve account is also known as export profit surplus. It is also known as export profit surplus. Export profit surplus. Also known as export profit surplus. Besides that, development reserve. Development reserve. Development reserve. Development reserve, many among us do not know, is also known as investment allowance reserve. Is also known as investment allowance reserve. Investment allowance reserve. So investment allowance reserve and development reserve are one and same thing. I've already told you, if you are an entity operating in a specified zone, in a notified zone, obviously you will definitely get some freebies from the government in the form of what we call tax exemption and so and so. But besides that, you will be under some sort of pressure to create every year a part of your profit and transfer the same to foreign project reserve account, development reserve account, investment allowance reserve account. And in tax, you generally study T-board reserve account. T-board reserve account is also a statutory reserve account, correct? Anyway, now what will be the treatment? The treatment is that again you are going to transfer these reserves to the credit side of shareholders account. Credit side of shareholders account. Credit side of shareholders account. So even these type of reserves will be transferred to the credit side of shareholders account. So far under the liability side, what we have seen that share capital, free reserves and statutory reserves are transferred to the credit side of shareholders account. Very easy and very simple. Now we come over to the next part. The next part of reserve is, I told you reserves are divided into three types of part. Under the third category, I will include specific reserves. What are specific reserves? Specific reserves. Specific reserves. Name itself is signifying what exactly the specific reserves are. Correct? Name itself is telling what exactly the specific reserves are. Specific reserves is specific, particular. That means such reserves are created particularly for a particular purpose. And generally specific reserves are nothing but these are known as provisions. The provisions are called as specific reserves. Many among us do not know these minor things. For example, suppose if I would say provision for doubtful debts. Now provision for doubtful debts, we call it provision, but it is a specific reserve in the sense that it is created specifically for a particular asset. So provision for depreciation. Provision for depreciation. Similarly, provision for doubtful debts. Isn't it or not? Provision for doubtful debts. All these are specific reserves. Provision for doubtful debts. Sometimes you create a stock reserve. A stock reserve is generally created by the entities to meet any decline in the value of the stock. It is also what we call a specific reserve. Sometimes investment reserve is created to meet decline in value of investment. It is also a specific reserve. Investment reserve. So these are basically specific reserves. You can call them provisions, no problem. So point here is that what will be the treatment? The treatment is that, for example, if I have created provision for depreciation, obviously I must have created it against what we call some particular asset, and that asset I must have transferred to the debit side of the realization account. Because their corresponding assets are always transferred to the debit side of realization account, that is the reason actually why all the specific reserves will be taken to the credit side of realization account. Is it clear to you? So we are going to transfer all the specific reserve to the credit side of realization account. Credit side of realization account. Credit side of realization account. Is it clear to you? Absolutely clear? Okay. Presume that if everything is clear to you, then I will shift the focus towards the next item in the balance sheet. If you remember, I told you your entire what we call liability side can be divided into share capital, reserves and liability. Now you know the treatment at how to close the share capital by simply transferring it to the credit side of the shareholders account. You also know the treatment of what we call free reserves. Again, you will take it to the credit side of share capital. Statutory reserve, credit side of share capital. Only thing is that a specific reserve will be taken to the credit side of the realization account. Now coming over to the liabilities. What we mean by liability? In fact, all the remaining item in the balance sheet will fall under the category of liability. No doubt about that. All the remaining item. But suppose as a professional student, I am going to ask you what we mean by liability. How will you deliver me the answer? Correct, these are small things, but as a professional student, you should be in the know of all these things. For example, whenever you do the accounting, you must understand that you are facing actually three type of situation. You are dealing with three parties. One, first party, then second party, then third party. Sir, what is this first party? The entity is known as or organization is known as the first party. Is it clear to you? Entity is known as the first party. The owners are known as second party. And combinedly, both these parties are known as internal party. Combinedly, both these parties are known as internal parties. Is it clear to you or not? And obviously, the parties other than the first and second one will be known as third party. Is it clear to you or not? Parties other than the first and second one will be known as third parties. So, if an organization owes anything to the third party, that is known as liability. Is it clear to you or not? If I told you, it is very simple. If organization owes anything to the third party, then it is known as liability. It is as simple as that. So, I do not want to explain all these things in detail, but the point is that I cannot stop myself. So, I hope now you got the meaning of liability quite well. In fact, all the remaining item, at this level, I need not require to prepare a list of liability. You know that trade creditor, bills payable, sundry creditor, debentures, correct? All these are part of liability. So, whatever remaining items are there, that means liability items are there, you are simply going to transfer them to the credit side of realization account. Credit side of realization account. You are simply going to transfer them to the credit side of realization account. That is how you are going to close your liability side. So under the first step, in the books of inquiry, we are trying to find out how the accounting is done. The first step is that we have to close all our assets. Under the second step, we have seen that we have to close our liabilities, and how the liability side is closed down. Now I hope everything is clear to you. Now we move over to the third step. What is the third step? Quite obviously, because everything we are visualizing from the perspective of the acquiring company, whose business is coming to an end, whose existence has come to an end. So we are visualizing everything from that particular angle. Now under the third step. Under the third step, we are going to talk about what we call purchase consideration. Why we shall talk about purchase consideration? It is as simple as that, because all our assets and liabilities have been taken over by some other entity, acquirer entity. And we are not going to transfer our assets and liability to the acquirer entity free of cost. So, obviously, acquirer entity is going to deliver some what we call consideration for the same. So now, as an acquiring company, if we are going to receive the purchase consideration from the acquirer company, how we are going to deal with that? That is the issue actually which we are addressing now. So in this particular case, you need to understand that in practical life, generally, first of all, let us say A2 is the acquirer entity. I will write acquirer. This is the acquirer entity. Okay, I will simply call it A, and let us say B is the acquiring entity. B is the acquiring entity. Now this entity is taking over this entity. Obviously, this entity is going to pay us some purchase consideration. But in practical life, purchase consideration is not immediately paid. First of all, there will be some agreement. Lots of meetings will be taken. Lots of meeting will take place between the shareholders of both the entities, directors, managing directors, all correct. All the key management personnel will come to an end, finalize the draft, correct, how the business will be taken over. That means lots of time lots of time gets consumed. So what my point is that, first of all, always there is an agreement that we are going to take over your business, and for that we are going to pay you some price. The date on which everything is settled, means where agreement has taken place that we are going to take over your business and we are going to give you this sort of what we call purchase consideration. On that date, the acquiring company is going to pass the entry. And what will be the entry? It is as simple as that. You haven't received the purchase consideration, but you are supposed to receive the purchase consideration because now the other entity is legally bounded to pay you. Is it clear to you? So your entry will be acquirer company. In the books of acquiring company, we are going to debit the acquirer company. Acquirer company. Why we are debiting the acquirer company? Because acquirer company is a sort of our debtor now. We are supposed to receive something from them. And whatever we are going to receive from them, that is a sort of gain to us. So acquirer company account debit to realization account. So this will be the entry which we are going to pass, and this entry is known as basically purchase consideration due. And after some time, we will receive the amount of purchase consideration. Now, purchase consideration, as you know, can be received in any mode, by way of cash, by way of shares, by way of debentures, by way of preference shares, etc. So, in whatever form we are going to receive the purchase consideration, I am going to debit the same. For example, if some portion of the purchase consideration is being received by way of cash, I am going to debit the cash account. If some portion is being received by way of shares, then I am going to write shares in acquirer company account debit. Shares in acquirer company account debit. Likewise, if some portion is being received in debenture, I will write debentures in acquirer company account debit. Presuming that in this case, purchase consideration is being received in what we call two modes, that is cash and shares. So I will write the entry cash account debit, shares in acquirer company account debit to acquirer company, because we are receiving the consideration from the acquirer company. So I shall write here to acquirer company. To acquirer company. This is how I'm going to write the entry. Is it clear to you or not? So as far as purchase consideration part is concerned, that is also over. So we have closed our asset, our liabilities, we have incorporated the purchase consideration. Now next 2 points are quite vital. Under the fourth step, what I am supposed to do now? Under the fourth step. Fourth step deals with assets. Assets not taken over. Assets not taken over and sold. Assets not taken over and sold. I have already told you earlier, under the first step, that besides cash, whatever assets which would be appearing, correct? All those assets will be transferred to the debit side, irrespective of the fact whether those assets have been taken over or not. We have already talked about this, correct? Suppose there is an item in the form of plant and machinery and that is not being taken over. In spite of that, I must have transferred it to the debit side of realization account. And later on, let us say question states that plant and machinery is sold for so and so item. Then I will have to pass the entry. That means if a particular asset hasn't been taken over, and it is also given in the question that it has been sold, then we are going to pass the entry. The entry will be similar to the one which you have passed so many times in the past. Your entry will be cash account debit to realization account. We will not write to plant and machinery account. We will write to realization account. Correct? Why we will write to realization account? Because plant and machinery is already closed down by transferring to what we call realization account, debit side of realization account. So that is why we will write the entry cash account debit to realization account. Is it clear to you or not? Yes, sir, it is clear to us. If it is clear to us, then similarly, another important point is fifth point. There may be a situation that some liabilities are there which might not have been taken over. Isn't it or not? If that is the case, then how we are going to deal up with that? Liabilities not taken over. Liabilities not taken over. So if there are some liabilities which haven't been taken over, correct? Obviously, then it is your duty, it is the duty of the acquiring company to pay off such liability, and our entry will be realization account debit to cash account. Our entry will be realization account debit to cash account. You might be wondering, sir, why we are not writing that name of that particular liability. The reason is that that liability is already closed. We have already transferred such liability to the credit side of realization account. All the liability, whether taken over or not, are transferred to the credit side of realization account. Is it clear to you? So that is the reason actually when you will pay, your entry will be realization account debit to cash account. Clear? Now after this, after the fifth step, the sixth step is related to expenses. To expenses. When acquirer company will sell its business and acquirer company will purchase the business, there might be what we call some expenses known as cost of liquidation expenses, correct? So, what will be the treatment of those expenses? What will be the treatment of those expenses? For example, if the question states that expenses have been borne by acquiring company, expenses have been borne by acquiring company. Expenses amounted to 10,000, 50,000 and borne by acquiring company. If acquiring company will bear the expenses borne by acquiring company, correct? Suppose if it is written that expenses have been borne by acquiring company, quite obviously acquiring company will have to pass the entry. And what entry the acquiring company in this particular case is going to pass? Very simple entry, realization account debit to cash account. It is as simple as that. Realization account debit to cash account. This is the entry the acquiring company is going to pass. However, sometime it may be written in the question that expenses have been borne by acquirer company. Expenses borne by acquirer company. Expenses borne by acquirer company. Expenses borne by acquirer company. If it is written in this manner, expenses borne by acquirer company, then what will be the treatment? If expenses have been borne by acquirer company, then in that particular case, acquirer company will treat such expenses, acquirer company will treat such expenses as acquisition cost, correct? It will treat these expenses as cost of acquiring the business. However, the entry will be profit and loss account debit. That means such expenses will be debited to profit and loss account. Profit and loss account debit to cash account. In simple words, if acquirer company will bear the expenses, acquirer company will expense those expenses. Expense those expenses means it will treat such expenses as expenses of revenue nature. Is it clear to you or not? So these are the things which you may have to face to what we call do the accounting in the books of acquiring company. But last and final step, let me finish it up well. So everything is done now, and under the seventh step, what I am going to do, first of all, I am going to tally the realization account. I am going to tally the realization account. Correct? Whatever result I will get over there, whether loss or profit, whatever result I am going to get over there, I will transfer it to the owner's shareholders account. Is it clear to you or not? Then under step number B, I am going to tally cash and bank account. Cash bank account. I am going to tally cash bank account. Whatever balance will be there, whatever balance will be there in cash or bank account, that balance will be transferred to the shareholders account. That balance will be transferred to the shareholders account. Is it clear to you? Now finally, we will come over to the shareholders account. And we will see that shareholder account is getting automatically tallied, must get automatically tallied. And this will be verification of your solution. Must be automatically tallied. Automatically tallied. Automatically tallied. Now you might be wondering, sir, actually we prepared 4 accounts. We have talked about only 3 accounts. Yes, we are also preparing purchasing company's account. But the moment we are going to receive the purchase consideration, purchasing company account will automatically get tallied. Is it clear to you or not? And we try to understand this question with the help of what we call some practical. So this is how you are going to do the accounting in the books of acquiring company. And this scenario will come when purchasing company will take over all the assets and liability. Just to make you understand it better, we pick up first question 4.1 to begin the what we call discussion. Correct? Under 4.1, as you can see, it is written, following is the balance sheet of Stop Limited. Name itself is the Stop Limited. And this balance sheet is on this particular date. In the balance sheet, what you are being given, you need to be aware of that. In the balance sheet of Stop Limited, we have share capital. Besides that, reserve and surplus is also there, profit and loss account, general reserve. There is no security premium. Just to make you aware of this particular fact that security premium can also fall under this category. But anyway, 2 items are appearing, profit and loss account and general reserve. Let me know quickly actually where I am going to transfer share capital. I am going to transfer share capital to the credit side of share capital account. I am going to transfer profit and loss account and general reserve to the credit side of shareholders account when I am going to later on close the liability side. Now we move over to the other item, non-current liability. Under the non-current liability, we have got only one item, 12% debenture. Of course, it is a liability. Creditors are also given in the question. There are no bills payable actually. It is just simply printed. Only 2 liabilities are there. It is very important to note down the liabilities of the what we call acquiring company. Correct? Then as far as asset side are concerned, land and building is given, plant and machinery is given, and you can see here you are being given preliminary expenses. Sorry, goodwill you are also being given. You are also being given preliminary expenses. Is it clear to you or not? Besides that, there are items like inventories, that is stock. You are also given trade receivable. You are also given cash and bank. So these are the items which are featuring in your what we call balance sheet. Is it clear to you or not? Now you let me know the treatment of what we call preliminary expenses, where you are going to post the preliminary expenses. Preliminary expenses will be taken to the debit side of the shareholders account because it is a valueless item. This is what exactly we talked about earlier. Is it clear to you or not? Now we start the discussion over this particular question. Start Limited acquired the business of Stop Limited. So here it is clearly written that Start Limited is acquiring the business of what we call Stop Limited. So we have taken over the business of the Stop Limited, and in the bracket it is written accepting cash at bank. That means this time cash and bank is not taken over. Cash and bank is not taken over. So we will not take the cash and bank account to the debit side of realization account. This is the point which we need to take care of. Cash and bank will be transferred to cash and bank account. That means we will simply write the balance brought down. But besides cash, whatever other assets are there, whether taken over or not, will be transferred to the debit side of realization account. Then we have 12% debentures in this case. So question says that in this particular case, purchasing company is not taking over cash at bank, and purchasing company is also not taking over one liability out of 2 liability. There are 2 liability, creditors and debentures. And if it is written that one liability is not being taken over, quite obviously it means all other liabilities are being taken over. So quite obviously we come to the conclusion and we can infer that creditors have been taken over. And further it is given for rupees 16,80,000. So we have taken over the liabilities, all the assets and liability And this for rupees 16 lakh 80,000 means this is the amount of consideration. For rupees 16 lakh 80,000 means the purchasing company is going to pay 16 lakh 80,000. Further, it is given payable rupees 15 lakh in the form of 1 lakh equity shares of 10 each at a premium of rupees 5 per share. Now, purchasing company will deliver the purchase consideration, and for discharging the purchase consideration, purchasing company is going to offer 1 lakh equity shares of 10 each at 5. That means 1 lakh shares will be issued at the rate of 15 and balance amount will be given in cash. Correct? Further, it is given that Stop Limited redeemed its debenture at a premium of 10%. I just told you, if a particular liability is not taken over, in this case, debentures haven't been taken over. So quite obviously, it is the duty of the acquiring company to pay off that liability. So acquiring company has paid that particular liability, that is debentures, but at a premium of 10%. Further, it is written that acquisition cost amounted to rupees 10,000 and borne by Start Limited. So acquisition cost or cost of expenses amounted to rupees 10,000 but borne by purchasing company. When expenses will be borne by purchasing company, acquiring company is not going to write any entry. The entry will be written in the books of what we call acquirer. Now you are required to close the books of Stop Limited and pass the entries in the books of Start Limited. So this is how we are supposed to do the question. We quickly take a note of the what we call items which are appearing in the balance sheet so that time and again I need not require to look at. So I will do the question for you because this is the first question. Now most of you definitely are not going to write. I'm very sure about this. And that is the mistake most of you actually commit. You think that solution is done. It is better actually. Sir has become old though, and we are very young. So there is need for us to actually write. I know most of you are under this sort of impression. Anyway, first of all, I am going to write books of acquiring company. So books of acquiring company. Even though it is extremely, I have already told you, freezing cold out here. And for you, I am taking the pain of writing. You must also actually, correct, follow all these things. I would love that. Books of acquiring company. Whenever henceforth, after all this discussion, whenever you are going to prepare the acquiring companies in books of acquiring company, quite obviously you are supposed to prepare all those 4 accounts. My advice is that always prepare first acquirer company's account. This is my advice, although it is not a necessity. Acquirer company's account or purchasing company's account. Correct? So acquirer company's account you have prepared and it won't need much space. Then you prepare your realization account. It is always better to prepare it in this particular order. That will help you. Realization account. Then I am going to prepare the realization account. Realization account because I have to make you understand. So I am preparing it a bit longer than the required parameters. Correct? Realization account. Besides realization account, also I am going to prepare shareholders account. Shareholders account. But before that, I will prepare cash account. This is my cash account. And now I will prepare shareholders account. These are the accounts which we may require to prepare in the books of acquiring company, shareholders account. Correct? I will look into the question. When you will look into the question, you will find that because question nowadays we have, just wait. In the question actually we are given liability items first. So no problem, we can start with the liability also. There is no harm in it. First of all, share capital is given. I've already told you the share capital will be transferred to the shareholders account. But here don't commit this mistake by simply writing by balance. Because you are closing the share capital account. Share capital account is appearing in the balance sheet. On the liability side, it is having a credit balance. Isn't it or not? So your entry will be share capital account debit to shareholder account. So that is why share capital will get closed. So better to write actually share capital. So I will write here share capital. And the amount of share capital is 10 lakh. Right, 10 lakh. Besides that, we saw actually in the balance sheet, under reserve and surplus, some items were appearing. And I told you, all the free reserves will be transferred to the credit side of realization account. So whatever profit or loss account balance you are having, you will transfer it to the credit side of shareholders account. Whatever general reserve is existing in the balance sheet, you are going to transfer to the credit side of shareholders account. Now, besides that, there are two liabilities which are given to us. As far as rule for liability is concerned, I have already told you all the liability will be posted to the credit side of realization account, whether taken over or not. This line, these wordings, please mind these wordings carefully. Correct? Whether taken over or not. Irrespective of the fact whether liabilities have been taken over or not, we are going to transfer them, post them to the credit side of realization account. So that is the reason in this particular case, 12% debentures which are appearing in the balance sheet, I am going to take them to the credit side of realization account, and I am going to write here 1,50,000. Correct? Even though debentures haven't been taken over, yet I have transferred them to the credit side of realization account. Is it clear to you? Likewise, there was another liability in the question in the form of creditors. So I am going to write here creditors. Now, amount of creditors given in the question is 2 lakh. So I am going to transfer 2 lakh to the credit side of realization account. So with that, we have closed the entire what we call liability side. Is it clear to you? Now we come over to the asset side. As far as asset side is concerned, under the asset side, here I am going to write, first of all, whatever items which are appearing in the balance sheet on the asset side, all those items will be transferred. All the assets, in fact, will be transferred to the debit side of realization account, but we have to exercise caution only with respect to one item of asset, that is cash. Is it clear to you? If cash is taken over, we will still transfer it to realization account. If not taken over, then to cash account. So on such count, we start preparing the realization account. First of all, I write here land and building. Now land and building given is 3 lakh. So it will be posted to the debit side of realization account. Is it clear to you? In fact, all assets have been taken over. Even though assets have been taken over or not, like liabilities, they will be posted to the debit side of realization account. Correct? After the land and building, we have plant and machinery in this particular question. Plant and machinery, I think, is equal to 6,70,000. 6,70,000. Then in the balance sheet, there is goodwill. Now, goodwill is an intangible asset. Correct? Goodwill is an intangible asset. However, under Ind AS, we generally keep goodwill as a separate line item from other intangible asset. But no doubt, goodwill is also an intangible asset. Goodwill, patent, copyright, trademark, licenses. Correct? So, even goodwill will be posted here. Amount of goodwill is actually 50,000. So I will write goodwill 50,000. All the assets will be posted to the debit side of realization account, whether taken over or not. Correct? All the assets. However, there is another item in this question, preliminary expenses. Now, preliminary expenses, as we know, is a valueless item. I told you preliminary expense, underwriting commission, discount on issue of share, miscellaneous expenditure. These are valueless items. So preliminary expenses will be posted to the debit side of shareholders account, and I am going to write here 10,000. Is it clear? After that, there is list of what we call some current asset, and current assets will be posted also to the debit side. For example, inventories or stock, which is given in the question at 4,50,000. So I will post it at 4,50,000. Besides that, we are being given debtors. So I am going to write debtors. Amount of debtors or trade receivable is given as 2,50,000. So I will write here 2,50,000. Now we come over to cash account. Because in this particular question, it is very specifically mentioned that cash hasn't been taken over. So that is the reason cash account, I am going to write here balance brought down. If cash is not taken over, then only you are going to write cash balance as balance brought down. That means we are not going to transfer it to the debit side of realization account. And in the question, I think the cash balance was 30,000. Is it clear to you or not? Right, sir, absolutely. Once you have posted and once you are done up with your these steps of closing down assets and closing down liabilities, under the next step, what you are supposed to do, as I told you, you will take care of the purchase consideration. In this case, I have already told you purchase consideration actually given to you as 16,80,000, I think, right? 16,80,000 was purchase consideration. 16,80,000. It is the amount of purchase consideration, and it was given in the question that purchasing company is going to deliver purchase consideration by issuing shares, and purchasing company will discharge the purchase consideration. In order to discharge the purchase consideration, purchasing company will offer 1 lakh shares of rupees 10 each, but at the rate of 15. That means 1 lakh into 15. That means out of 16,80,000, 15 lakh worth of payment is by way of shares. By way of shares. And balance amount, it is very specifically mentioned in the question that balance amount will be paid by way of cash. So what will be the amount which we are going to receive in cash? That will be equal to 1,80,000. Isn't it or not? So my first entry, as I told you, first entry will be, there is no need to write the entry, but you must understand. Your first entry will be, I told you, first of all, we pass the entry, due entry, the acquirer company account debit to realization. Acquirer company account debit to realization. As per this particular entry, realization account will get credited, and on the credit side of the realization account, I am going to write by acquirer company account. You can write the name of that company also, by acquirer company account. And in bracket, I have mentioned purchase consideration due. And acquirer by acquirer companies. Purchase consideration amount is 16,80,000. First, I will write here. The moment I am going to write here purchase consideration, the moment I am going to write here by acquirer company, it must click to me that I am also preparing acquirer company's account, and I will cross it to the debit side of acquirer company's account. Over there, I am going to write to realization account. That is equal to 16,80,000. Now we are going to receive 16,80,000 from acquirer company, and the entry will be cash account debit 1,80,000, because we are receiving 1,80,000 in cash, and shares in acquirer company 15 lakh. 15 lakh worth of amount we are receiving by way of shares. So next entry will be cash account debit, shares account debit to acquirer company, That means you will receive from the acquirer company, you will write towards the credit side of acquirer company by cash 1,80,000. So you have written here 1,80,000. You will receive 1,80,000. Then you are going to write shares in acquirer company account, shares in acquirer company account, shares in acquirer company account, shares in acquirer company account 15 lakh. The moment you are going to receive the amount of purchase consideration, this particular account will stand closed. Is it clear to you? So this account is closed. But important point is that you have received cash. Obviously, you are going to post it to the debit side of cash account, and over there you are going to write to acquirer company account, How much? The amount will be equal to 1,80,000, because 1,80,000 you receive. So portion of purchase consideration received in cash, first of all, will be posted to the cash account, because you are preparing cash account. And whatever portion besides cash is there of the purchase consideration, whatever portion is there, correct? I told you the portion received in cash will be posted to the cash account. And all other mode of payment of purchase consideration, whether in shares, whether in debentures, whether in preference shares. Suppose if in this case you would have received cash, debentures, shares, etc. So cash would have been posted to cash account, and all the other modes will be posted to the shareholders account directly. So for example, in this case, now we have received the shares, and shares will be posted directly to the what we call shareholders account. And I will write here two shares in acquirer company account, two shares in acquirer company account, two shares in acquirer company account. And we are receiving shares in this case equal to 5 lakh. 1 lakh shares of how much actually we are receiving in this particular case? I have forgotten. What was the amount of purchase consideration? 1 lakh shares into 15 lakhs. So 15 lakh worth of payment will find place on the debit side of shareholder account. Portion of purchase consideration received in cash will be posted to the cash account and all other forms will be posted to the debit side of shareholders account. Is it clear to you or not? So now, till up to this particular point, everything is clear. I told you in the fourth step, watch out for any asset not taken over and sold. Although in this question, there is no other asset which is not taken over. Only cash is not taken over. Besides cash, no other asset is there which hasn't been taken over. So now you will look over to the liability. Out of these two liability, is there any liability which hasn't been taken over? Yes, sir. Debentures have been taken. Debentures haven't been taken over. So quite obviously, you will pay off now debentures. And in order to pay the debentures, you are going to write here to cash. You are going to write here to cash. You will pay the debenture. Amount of debenture actually is 1,50,000. How much? It is 1,50,000. And it is given in the question that acquiring company is paying the debenture at 10% premium. So that means debentures have been paid at 1,65,000. So you write here 1,65,000. The moment you are going to write here 165, immediately post it to the credit side of cash account also, and over there you are going to write here by realization 1,65,000. Is it clear to you or not? Now, last point is expense, but problem is that expenses have been borne by acquirer company and not by the acquiring company. So now we are going to simply tally the realization account. If I am going to tally the realization account, I will find actually that my credit side is higher. And I always keep on telling you also to kindly do the calculations of your own, because sometimes when we speak simultaneously and write simultaneously and do lots of discussions, sometimes we might commit some mistake with respect to calculation also. However, there is profit of 1,55,000. My calculation is not that fast, to be very honest with you, but everything is now, to be very honest, memorized. Net answers are 99% are retained by me. So this is that profit. Now the point is that I told you whatever result will be there in the realization account, because credit side is more, it will be considered as profit. And that result will be posted to the owner's account, shareholders account. So I will write here profit transferred to shareholders account. Profit transferred to shareholders account. We will transfer this profit to shareholders account. So immediately I am going to write it towards the credit side of shareholders account now. Realization account or realization profit 1,55,000. So 1,55,000 I have transferred. Now, after what we call finishing up realization account, we should tally the cash account. Earlier I told you that whatever balance will be there in the cash account, you are going to take that balance. In fact, you are going to transfer the balance to the shareholders account. After all, this balance belongs to the owner now. So whatever balance is there, 2,10,000 minus 1,65,000. What will be the balance? I will write here by shareholders account. So that means whatever balance is there, I am going to pay that balance to the shareholders account. So 2,10,000 minus 165, in my opinion, it will be equal to 45. So now cash account is also tallied, and we will transfer this cash balance to the debit side of shareholders account. I will write here to cash. And I told you a moment ago, now your shareholders account must get automatically tallied. Let's see. This is your 15,55,000, 10, 13, 14 and 1,55,000. So 15,55,000, 15,55,000. It is absolutely tallied. Is it clear to you or not? That is how the accounting is done in the books of acquiring entity. Now, in this question also, they may ask you to pass the entries in the books of the acquirer. So in the books of the acquirer, what entry I am going to pass? Books of acquirer. Books of acquirer. Books of acquirer. Now in the books of acquirer, I am going to pass the entry. I am the acquirer. Now remember one thing, Ind AS 103 will come into play. I have taken the control over this particular enterprise. Acquisition method of accounting will come into play. And under this, first of all, I will take into account which are the assets which I have taken over. As an acquirer entity, I will consider all the assets taken over. Now, if I will look into the question, we find that we are taking over the goodwill of the other enterprise. So, goodwill account debit 50,000. Correct? We are taking over all the assets almost, barring what we call cash. Land and building account. Generally, the rule says that all the assets and liability must be recorded at fair value. So we are presuming that whatever value which are appearing in the balance sheet are equal to fair value. Is it clear to you? So land and building was given in the question at rupees 3 lakh. So I am going to write here 3 lakh. And similarly, then plant and machinery. We have picked up all the items except cash. Plant and machinery balance was 6,70,000 if I am not wrong. And then we have stock. The stock was 4,50,000. And then debtors is equal to 2,50,000. Debtors is equal to 2,50,000. Correct? These are the assets which we have taken over. I have already told you in the books of acquirer entity, we are going to record all the assets, correct, which we have taken over. Besides that, the liability. Now, the point here is that we have taken over only one liability out of two, that is creditors. So, liability which have been taken over, I am going to write here creditors. Now, creditors equal to 2,10,000. 2,10,000. Is it clear to you? Then, if I have written here assets on the debit side and on the credit side I have written what we call creditors, it means so far I have written net assets. What is the net amount of assets I am receiving? Correct? This is what I have noted down. Now I will write here to consideration. When we write here to consideration, what does it mean? That means now we are comparing the amount of net asset with the consideration which we have paid. Is it clear to you or not? And the consideration amount is 16,80,000. So I am going to write here 16,80,000. Obviously, now you will take the difference. If the difference will come over to the debit side, it will be treated as goodwill. If the difference will come over to the credit side, it will be treated as capital reserve as per Ind AS 103. Now, in this particular case, I will tell you the difference straight away. I do not want to waste the time. This difference is coming over to the debit side. And difference is almost equal to, but please do the check also. It is always better to do the checks by yourself. Correct? 1,70,000. 1,70,000. Now, you might wonder, sir, we have written goodwill twice. Yes, you are right, absolutely. So, better here to write goodwill on business combination. BC. Goodwill on business combination. Correct? So that you can segregate this goodwill. So, this is how you will have to pass the entry in the books of the acquirer company. And then under the second entry, you are going to discharge the consideration. The consideration which you are supposed to discharge is 16,80,000. Now you let me know what will be the entry. Consideration account debit. 16,80,000 you are supposed to discharge. And as a acquirer company, you know that you are paying off cash 1,80,000. So obviously you are going to write here 1,80,000. And besides that, you are also what we call issuing shares. But because you are the issuer, you are the issuing company, so you will mention share capital here at nominal value. That means separately at nominal value and premium. So 1 lakh shares of 10 each, that is 10 lakh. And besides that, you will write here 2 security premium. 1 lakh shares into 5. 1 lakh shares into 5. See, don't confuse it with common control. Under common control, we have to mention only the nominal value over here and here also. It is not a case of common control. It is a simple case of Ind AS 103. Is it clear to you or not? And then, there were some expenses in the question. It was also given. And I told you if there will be some expenses borne by what we call acquirer entity, as per Ind AS 103, those expenses will not be treated as capital nature expenses. Rather, it will be treated as what we call cost of acquisition, and it will be expensed, and the entry will be profit and loss account debit. Profit and loss account debit to cash account. So this is how you are going to do the accounting or journal entries in the books of what we call this entity, acquirer entity. Is it clear to you or not? Is it clear? Absolutely clear. Well, leaving the last session, we talked about this particular fact that when we are going to actually start and commence today's proceedings, we are going to actually talk about how the accounting pattern would unfold or what procedural methodology we shall have to adopt when purchase consideration is not given. Correct? This was the point when we left the last session. So point here is that in this particular session, obviously we are going to discuss these aspects when purchase consideration is not given. Now please pay attention over here. If purchase consideration is not given, there are three methods available to compute the purchase consideration. Please listen to me very carefully, and it is very important to mind the language, mind the wordings, and keep it in your mind. First of all, I am telling you that whenever purchase consideration is not given, it is of paramount importance to understand that there are three methods to compute the purchase consideration. But now what I am saying, mind it. It is not our discretion. It is not our choice that we can pick up any method according to our whims and what we call wills so that we can easily what we call solve the question. No, nothing like that. Although there are three methods available, we will have to take care of the fact in the light of the what we call directions of the question that which method we have to adopt and apply to compute the purchase consideration. Is it clear to you? So I told you that there are three methods. So when PC is not available, when purchase consideration is not available, when PC is not available, or when purchase consideration is not given, then we have the luxury of three methods, correct? Through three methods we can compute purchase consideration. In order to compute the purchase consideration, there are three methods which have been prescribed, and one among them is known as net assets method. One is known as net assets method of computation of purchase consideration. I am simply writing net assets method. Correct? Then there is another method which is nothing but just variation of net assets method. This method, second method, is known as intrinsic value of share method. Intrinsic value of share method, IVS method. And later on when we are going to discuss IVS method, I will tell you also that it is nothing but it is just a variation of extended variation of net assets method. And besides that, we have yet another method to compute the purchase consideration that is known as net payment method. Net payment method, I am simply writing NP, net payment method. So three methods have been given. And I just told you a moment ago, in the light of the question, we shall have to discern, we shall have to find out actually which method we shall have to apply to actually solve the question. Obviously, first of all, we are going to take into account net assets method, and I will let you know actually through this particular question how the purchase consideration is computed under net assets method. Just have a look over this one. 5.1 is the question which we are picking up. Top Limited decided to sell its business to Bottom Limited. Indirectly, it means Bottom Limited is taking over the business of Top Limited. Is it clear to you or not? Now, we look into the balance sheet and we find in the balance sheet as usual there is share capital, equity share capital, which will be posted to the equity share capital account in the books of acquiring company. Besides, there are reserves and surplus. Under the reserves and surplus, we have only reserves 90,000. Again, it will be posted to the credit side of shareholders account. Then as far as liabilities are concerned, one is actually debenture. Another liability we have got creditors. There are two liabilities in this particular question. While doing the accounting, especially in the books of acquiring company, you have to be very careful that how many liabilities are there. Now coming over to the asset side, tangible fixed asset, property, plant and equipment is given to you. Then plant and machinery is also given to you. Besides that, you have the goodwill even in this particular question. And then we have stock and we have got cash. So these are the assets which are given in the question. Is it clear to you? Now below it is given that Bottom Limited took over all the assets and liabilities. So purchasing company Bottom Limited is taking over all the assets and liabilities, but now here it is written except cash. Except cash. So now we have concluded that cash hasn't been taken over. Further, it is written that at their book values. That means all the, so far, this particular line actually forces us to conclude that all the assets which have been taken over at book value, isn't it or not? However, cash is not taken over. But now the question further says that, however, goodwill was valued or goodwill was taken over at 1 lakh. So now it is given that goodwill which was appearing in the balance sheet was taken over at 1 lakh. Goodwill has been taken over at 1 lakh. And now the question further says that property also has been taken over at 1,80,000. 1,80,000. So company has taken over all the assets. Purchasing company has taken over all the assets except cash. All the assets have been taken over, but now we can say that stock has been taken over at book value of 3,50,000 because nothing is given below regarding stock. However, goodwill has been taken over at 1 lakh. Property, plant and equipment have been taken over at 2,10,000. Likewise, property has been taken over at 1,80,000 because information below is given with respect to goodwill, that goodwill has been taken over at 1 lakh and property has been taken over at 1,80,000. Further, it is given in the question, Bottom Limited agreed to pay 90,000 in cash. So Bottom Limited this time has agreed to pay 90,000 in cash. It is given to you that Bottom Limited shall pay you 90,000 rupees and 90,000 it shall pay you in cash. And balance. Now just have a look over this word balance. And balance in the form of equity shares of 100 each. So whatever balance of the total purchase consideration will be. In this particular question, you have noticed that total purchase consideration is not given. However, you are being given that purchasing company is going to give you 90,000 in cash, and further it is written that balance will be provided by issue of equity shares of rupees 100 each. That means whatever balance is there, that will be what we call through equity share. But problem is that we cannot find out the balance amount unless and until we shall have the amount of purchase consideration. I told you just a moment ago, there are 3 methods of computing purchase consideration. In this question, we shall have to apply the net assets method to compute the purchase consideration. Why we shall have to apply the purchase consideration? Now just pay attention. Whenever question will say that so much of payment is being made by way of this sort of form, that in this case it is being given in cash, 90,000 in cash, and balance. And balance. So whenever this particular word will be there, and balance, immediately you come to the conclusion that you will have to apply the net assets methods of computing the purchase consideration. If purchase consideration is not given, please pay attention. If purchase consideration is not given, and question says that some portion of the purchase consideration is by way of shares, and balance in cash. So here also the word balance is coming into play. You will have to apply the purchase consideration. In this question, some portion of the purchase consideration is being what we call paid by way of cash and balance by way of equity share. Important point is word balance. I hope you got the idea and got the clue, in fact, when we have to apply the net assets method. Is it clear to you or not? Is it clear? Fine then. Further, it is given in the question that expenses of liquidation amounted to 15,000. Expenses of liquidation are 15,000. Nothing is mentioned who is bearing the expense. If the question remains silent with respect to who is the company which is bearing the what we call expenses, in that case always presume expenses are being borne by the vendor company, acquiring company. Acquiring company is the company which is selling the business or which is being taken over, correct? It is also known as vendor company. Now question says that show ledger account in the books of Top Limited and pass entries in the books of purchasing company also. So this is the question. So important point which we need to understand is that in this particular question, we shall have to find out the amount of purchase consideration. Then we will prepare the ledger account in the books of the acquiring company. And then finally, we will have to pass the entries in the books of acquirer company also. Is it clear to you? In order to understand this particular question quite well, let's first of all start with computation of purchase consideration. This is the first step to solve the question. Computation of purchase consideration. Computation of purchase consideration. So first of all, I am going to compute the purchase consideration. In order to compute the purchase consideration, I told you, as far as net assets method is concerned, first of all, I will look into the fact that which are the assets which have been taken over. So that means first of all, I am going to take into account assets taken over. Assets taken over. Which are the assets which have been taken over? Assets taken over. Further, I will look, in fact, I will also consider their revised value in case if it is given. That means all the assets which have been taken over, if their revised value is given, I will consider the revised value. Otherwise, I will simply take the book value. Asset taken over at revised value, if any. At revised value, if any. Is it clear to you? This is how I am going to compute the purchase consideration. First of all, I will take into account which are the assets which have been taken over. In this particular question, we have already gone through. In this case, it was given that as far as property was concerned, property is being taken over at 1,80,000. So at what value it is being taken over, that value I am going to write over here. Is it clear to you? However, as far as plant and machinery is concerned, its book value was 2,10,000 and no revised value was given. So we shall presume that plant and machinery has been taken over at 2,10,000. Besides, in this question, there is stock also. Now, stock is actually equal to 3,50,000. No further information is given with respect to stock. I will write the book value. Correct? Besides that, in this particular question, there is cash also, but cash is not taken over. I will not consider cash. However, there is goodwill. And below it is given that goodwill has been valued at 1 lakh rupees or goodwill has been taken over at 1 lakh. So all the assets which have been taken over, first of all, you are going to take them into account. Then you are going to total them 8,40,000. 8,40,000. So we may say that purchasing company has taken over all the assets at 8,40,000. Correct? Now, I will subtract less liabilities taken over. Liabilities taken over. Liabilities taken over. In this particular question, it is clearly mentioned that purchasing company is taking over all the assets and liabilities except cash. That means both the liabilities, there are two liabilities in the question. So both the liabilities shall be presumed to be taken over. There are 7.5% debenture in the question. So 7.5% debenture, 1 lakh. In case if their revised value would have been given, I would have considered the same. Further, we are being given creditors. We saw in the balance sheet there are two liability. One is debenture, another one is creditors, and amount of creditor is equal to 1,50,000. I will write 1,50,000. So as far as liabilities are concerned, we may say that liabilities have been taken over at 2,50,000. So quite obviously this will become, now we will take into account the difference, and this difference will become the amount of purchase consideration. So this is how we are going to track out purchase consideration in case purchase consideration is not given in the questions. Correct? So if purchase consideration is not given in the question, to net assets methods, this is how we are going to derive the purchase consideration. Net assets method shall be used when the question would say that some portion of the purchase consideration is being discharged through so and so form and balance in so and so form. Is it clear to you? Once you have computed the purchase consideration, then this is your first step. Then under the second step, you also take into account the mode of payment. Mode of payment. Mode of payment means in what mode this purchase consideration shall be discharged by the purchasing company. Mode of payment. So I will write here now mode of payment. As far as mode of payment is concerned, mode of payment, we have already seen that purchasing company has agreed to provide 90,000 rupees in cash, and it was written in the question balance by way of equity shares. So what will be the balance? Balance will be 5 lakh. So equity shares 5 lakh. So 5,90,000 will be our purchase consideration, and this is how this purchase consideration shall be discharged. Is it clear to you or not? Up to this particular point, you should not confront any sort of problem. Because these are initial stages, now I will prepare the ledger in the books of equity. Ledgers in the books of equity. In order to prepare the ledger accounts in the books of acquiry, if you remember last time in the last session we talked about this particular fact. First of all, I will have to prepare, in fact it is always better to prepare acquirer company account. So I will prepare acquirer company account 1. Besides that, I will prepare the realization account, correct, realization account. And besides realization account, I will also prepare cash account and then shareholders account, correct, shareholders account. So these are the accounts which I have prepared. Shareholders account. I will also prepare cash bank account. And then realization. And then acquirer company account. Correct. As usual, first of all, we will look into the balance sheet. Obviously, the liability side is given first, and over there, you remember, first item was share capital. So first of all, I am going to transfer the share capital worth rupees 5 lakh to the shareholders account. So I will write here 5 lakh. The second item, if you remember, was reserves. So as far as reserves are concerned, even reserves are also transferred to the credit side of shareholders account. So I shall write here 90,000. Reserves. Besides reserves, there were debentures and creditors, 2 liabilities, and in the last session we talked about this particular fact that all the liabilities are transferred to the credit side of realization account irrespective of the fact whether taken over or not. However, in this particular question, both the liabilities have been taken over. So I shall write here 7.5% debentures. 7.5% debentures given in the question 1 lakh. And then I will write creditors. As far as creditors are concerned, creditor is equal to 1,50,000. Is it clear to you? So that means now our liability side is closed. Likewise, we can now close the asset side. Towards the asset side, we come across the first item as property. Now here, one point which you need to take into your mind and keep in your mind. Whenever we are going to transfer any balance sheet item in the realization account, that will always be at what we call balance sheet value, that is book value. Is it clear to you? Don't write here property 1,80,000. Is it clear to you or not? If you are going to close any item of the balance sheet, that must be closed at book value. Second point is plant and machinery. Now plant and machinery in the balance sheet given to us at 2,10,000. I'm going to write here 2,10,000. In the balance sheet, then we have goodwill. Even goodwill will be posted here, but at 60,000. Don't write here revised value. Is it clear to you or not? And then we have stock in this particular case. Amount of stock is 3,50,000. So I'm going to write here 3,50,000. Besides that, we also have cash, but cash hasn't been taken over. Only caution which we require is with respect to cash, whether cash has been taken over or not. If cash would have been taken over, I would have simply written here cash, that's all. However, in this particular question, cash is not taken over, so that is why I will simply write cash balance in the cash account, balance brought down 70,000. So with that, our assets and liability side have been closed. Now actually we have to consider the purchase consideration. Now the entry for the purchase consideration will be, I told you even the last class, your acquirer company account debit to realization account. This is the due entry. Acquirer company account debit to realization account. So on the credit side of the realization account, you are going to write by acquiry company. Sorry, by acquirer company. I told acquirer company. In bracket, you can write purchase consideration. Amount of purchase consideration is 5,90,000. So you are going to write here 5,90,000. Immediately now cross it to the debit side of acquirer company account. On the debit side of acquirer company, you will write obviously 5,90,000. Now you are going to pass the entry for the mode of payment which you are going to receive from the acquirer company. You are receiving cash worth rupees 90,000 if you remember. cash worth rupees 90,000, and besides that you are receiving shares in acquirer company, shares in acquirer company, shares in acquirer company. That is equal to 5 lakh. The moment you are going to receive the mode of payment, this particular account will get closed. Even in the last session, we talked about this particular fact that if you are receiving cash, then cash will be posted to the debit side of the cash account. On the debit side of the cash account, I will write acquirer company. And we have received cash of rupees 90,000. So I will write here 90,000. And even in the last session, we stressed upon this particular fact that if we are receiving purchase consideration in a mode other than cash, then whatever mode it might be, you are going to transfer it to the debit side of shareholders account. So on the debit side of the shareholders account, I will write shares in acquirer company account, shares in acquirer company account, shares in acquirer company account. Shares in acquirer company, we have received 5 lakh worth of shares. Now we have received the purchase consideration also. Next point to pay attention to is just to have a look over the fact whether is there any asset which hasn't been taken over and which has been sold. In this particular case, all these assets which you have posted here have been taken over. Correct? Likewise, then you will look into the fact, is there any liability which hasn't been taken over? In this case, both the liabilities have been taken over. You need not require to pay off any liability. Then last thing is expenses. In this case, there are realization expenses, and realization expenses are being borne by actually when what we call acquiring company. So on the debit side of realization account, because our entry will be realization account debit to cash account. So that is the reason I am going to write here to cash, realization account debit to cash. This time acquiring company is bearing the expenses. So I shall write here 15,000, correct? 15,000 worth of expenses will be written over here. Then I will transfer this amount to the credit side of the cash account. Obviously, I am going to write here by realization. 15,000. 15,000. So now I am in a position to tally out this particular account. When I will tally it out, I will find that there is a profit of 55,000. So I will write here 55,000. So profit will be transferred to shareholders account. Profit transfer to shareholders account. So profit has been transferred to shareholders account, 55,000. And on the credit side of shareholders account, I am going to write now realization profit. Realization profit. And profit is equal to 55,000. This is how I am going to close the realization account. Then as far as cash bank account is concerned, I told you whatever balance will be there, you are going to post it to the shareholders account. If you remember in the last session, we talked about this. So by shareholders account, 160 minus 15 will be equal to 1,45,000. So 1,45,000 worth of cash you are going to pay to the shareholders. On the debit side of the shareholders, you are going to write here to cash 1,45,000. 1,45,000. So total will be 6,45,000. Shareholder account must get tally of its own. Is it clear to you or not? Now, how many steps we have done? Now under the fourth step, books of acquirer. Books of acquirers. As far as acquirer is concerned, now acquirer will pass the entry for the assets and liabilities which it has taken over. In this particular case, our first entry will be with respect to all those assets which we have taken over. Obviously, here we are going to take into account the revised value. Correct? Now, in this particular case, as far as property is concerned, we have already seen that property was being taken over. In fact, was taken over at 1,80,000. So I will write here 1,80,000. Correct? Then besides that, we have taken over plant and machinery. I will write here to plant and machinery account, and plant and machinery has been taken over at 2,10,000. Correct? 2,10,000. Besides that, we have taken over goodwill also, and goodwill was worth rupees 1 lakh. We took over goodwill at 1 lakh. Then we also took over stock. The stock was taken over at book value 3 lakh 50. Ind AS 103 states that all the assets and liability must be recorded at fair value. Even though we are writing the book value, we are presuming that the book value is equal to fair value, it means. Now we shall write all those liability which we have taken over. Two 7.5% debentures. 7.5% debentures were worth rupees 1 lakh. So I will write here 1 lakh. Then I will write here two creditors. Creditors were 1,50,000. Logically, it means the purchasing company so far has written net assets only. Correct? Assets minus liability is nothing but net assets. So now when I am writing here to consideration, it means I am comparing the net assets with the amount which I am paying to the acquiring company. To consideration. Consideration. Consideration, it will be equal to 5,90,000. Some of you might be wondering, sir, why we are not writing NCI? Because there is no NCI. When you are taking over all the assets and liability of the other entity, no question of any NCI. Is it clear to you? Now, generally, some balance actually arises, but this time there is no balance. Is it clear to you? This time there is no balance, correct? So, now the next entry which you are going to pass is with respect to discharge or purchase consideration. Now consideration account debit. Consideration account debit, that is equal to 5,90,000. Consideration account debit 5,90,000. To cash I will write now, to cash 90,000. And I will write here to equity share capital. Equity share capital. 5 lakh worth of share capital. In fact, one share is of 100 each. We can also show it in this manner, 5,000 into 100. Expenses have been borne by acquiring company. We are not going to pass any entry for the same. Is it clear to you or not? Is it clear? Right, sir. It is absolutely clear to us. After this, now we come over to the next section, and next section is quite vital. Next section is quite vital because in this particular section, now we will learn computation of purchase consideration through intrinsic value of method. Intrinsic value of method. What is intrinsic value of method? I will let you know in a short while. In a short while. Don't worry about it. I will give you a detailed what we call explanation regarding the same and how intrinsic value, when actually we are supposed to use the intrinsic value of method. The point is also this. When purchase consideration is not given, correct, I told you there are three methods available. Generally, we apply net assets method when there is written in the question that some balance portion is payable in so and so form. So generally, in that particular situation, we apply net assets method to compute the purchase consideration. However, in case of intrinsic value method, you need not require to stretch your mind because it will be very clearly given in the question that we have to use intrinsic value method. Good thing about this particular method is this. How we are going to use the intrinsic value method, what we are supposed to do under it, we are going to actually give you. And remember, in examination, lots of questions are being asked from this particular topic. From this particular topic, almost every year, there was a question. So that should work all the more as a what we call motivating factor that why you should pay a little bit extra attention as far as this particular topic is concerned. 6.1 now we are moving over to. First, I will read the question. I will explain each and every point. In fact, I have framed this particular question just to elaborate the things, correct? The following are the balance sheet of K Limited and J Limited. In this particular question, as you can see, this time, and this is the first question which we are confronting, wherein balance sheets of both the companies are given. So far or hitherto, whatever question which we have done over there, the balance sheet of only one company, acquiring company, was given. But now in this question, we shall see later on that balance sheet of acquirer and acquiree is given to us, correct? So this is the balance sheet given to us, and below it is written that Board of Directors of K Limited approved to take over J Limited on the aforementioned date. In this case, it is written that Board of Directors of K Limited approved to take over J Limited. So that means in this particular case, we may say that K Limited is the purchasing company or the acquirer company, and J Limited is the acquiring company or the company which is selling the business, also known as vendor company. Is it clear to you? Further, it is given, actually question simply states that find out the ratio of exchange of share on the basis of book value. Find out the ratio of exchange of share on the basis of book value. Try to understand. Whenever in the question it will be written that we have to value the share on the basis of net assets or on the basis of book value, immediately you come to the conclusion that this question relates to intrinsic value of shares method. Is it clear to you or not? So in this particular question, I will have to compute the intrinsic value of shares. Is it clear? Here below written that Board of Director of K Limited approved to take over J Limited. And generally, when the question is of intrinsic value of share method, under such a situation, again we need not require to stretch our mind unnecessarily, because generally it will be presumed that all the assets and liabilities have been taken over. Correct? So now on such what we call considerations, we start little bit of what we call doing analysis of the balance sheet. Quite obviously, in this particular case, J Limited is the entity which is the acquiring entity. So we look into the items of this entity first. Here it is written equity share capital. Of course, equity share capital of purchasing company is 4 lakh. And equity share capital of this entity is 180 and 5 lakh and 1 lakh is general reserve. Then there is profit and loss account also 3 lakh 80,000. Then there are 3 liabilities: debenture, creditors and bills payable. Purchasing company is having debenture worth rupees 350, creditors worth rupees 2 lakh, besides that bills payable worth rupees 50,000. As far as this particular entity is concerned, there are no debentures. However, there are 2 liabilities: creditors and bills payable. Creditors and bills payable. And then we are being given fixed asset are 7 lakh and 3 lakh. Besides, there are investment 5 lakh, but this entity is not having any investment. Current asset is equal to 6 lakh and 2 lakh, and of course total is given. That's all. And we have to find out only the ratio of exchange. But still I am going to make a full-fledged analysis of this particular question. Just pay attention. Question looks small, but solution is little bit what we call little bit longer. So as far as intrinsic value is concerned, now we are actually discussing the intrinsic value concept. Correct? What exactly the intrinsic value is, why we compute it, all these questions will be answered to you within a flick of second. Just pay attention first of all. Under the intrinsic value of method, first of all, what you are supposed to do, you are supposed to compute the intrinsic value of share of both the entity. What we mean by intrinsic value, I will explain. You will have to show a little bit of little bit of patience in this particular case. Correct? So I will write here one acquirer company. You can also write the name also. Acquirer company, that is J Limited. Sorry, J Limited or K Limited. K Limited is the acquirer company. Acquirer entity. An acquiring entity is J Limited. First of all, you will have to compute the intrinsic value of both the companies. And how the intrinsic value will be computed? First of all, you are going to compute the net assets. First of all, you are going to compute the net asset, as I told you even in the earlier session. Correct? You are going to compute the net asset in the same manner which we adopted earlier. So in order to compute the net assets, first of all, I will look into the balance sheet, look over the what we call lower part, and over there we are being given fixed asset or property, plant and equipment, whatever you may like to write. Only 3 items are given as far as asset sides are concerned. Now, fixed assets of acquired company given to us is equal to 7 lakh. So I will write here 7 lakh. If any revised value would have been given, I would have written that. Correct? At the same time, acquiring company, 3 lakh. Then we are being given that there are some investment also. So I will write here investments. I told you earlier that intrinsic value of shares method of computation of purchase consideration is nothing but just an extended form of net assets method. Correct? Now, as far as this entity is concerned, its investment was given to us as 5 lakh. So I'm going to write here 5 lakh. However, there were no investment as far as this particular entity is concerned. Then we are having current assets, and current asset is equal to 6 lakhs. And as far as this entity is concerned, the current asset is equal to 2 lakh. Current asset is equal to 2 lakh. Only 3 items of assets are given. Now I am going to total it up. If I am going to total it up, it comes to 18 lakhs, 12 plus 6, and it comes to 5 lakh. Correct? So assets we have computed. So in order to compute the net assets, all I have to do is to subtract the liabilities. As far as liabilities are concerned, we saw in the question there are 3 liabilities. One debentures, one is debentures. Besides that, we are having creditors, and we are also having bills payable in this particular question. Debentures were worth rupees 3,50,000 if you remember. However, as far as acquiring entity is concerned, there are no debentures in the books of acquiring company. Then coming over to the creditors given to us is equal to 2 lakh. I will write here 2 lakh. This company is having creditors equal to 1 lakh, I think so. So I am going to write here 1 lakh. Correct? And then, as far as bills payable are concerned, this entity is having bills payable worth rupees 50,000. This entity is having bills payable worth rupees 40,000. By subtracting 350 plus 2 lakh plus 50, 6 lakh from 18 lakh, obviously now I am going to get 12 lakhs. 18 lakh minus 6 lakh is equal to 12 lakh. Isn't it or not? Similarly, if I am going to subtract 1,40,000 from 5 lakh, I am going to get 3,60,000. So I will write here 3,60,000. Your first target should be to compute the net asset. Remember one thing, we are trying to find out the intrinsic value. In order to find out the intrinsic value, first of all, I will have to find out the net assets. So assets minus liability is known as net assets without an iota of doubt. You have found out the net assets. And it is also known as assets for shareholders. Net assets means assets for shareholders. By subtracting the liability from the assets, whatever is left, that always belongs to shareholders. So it is also known as assets for shareholders. In this question, if there would have been any preference share capital, I would have subtracted the same also. So preference share capital, however, in this particular question is not given. If it would have been given, I would have subtracted it. By subtracting preference share capital from the assets available for shareholders, now obviously I am left up with assets available for equity shares. Assets available for equity shares. I am left up with assets available for equity shareholders. So assets available for equity shareholder is equal to 12 lakh and equal to 3,60,000 as far as these entities are concerned. So your basic target, whenever you are going to compute the intrinsic value of share, first of all is to actually arrive at assets available for equity shareholder, and it is not a very hell of a task. Only thing is that first of all you need to find out the net assets, subtract any preference share capital if it is given in the question, so you can easily get assets available for equity share. Now all you have to do is to divide it by the number of equity shares. By the number of equity shares. By the number of equity shares. Now see here, in the balance sheet share capital of purchasing company or acquired company K Limited is 4 lakh. And one share is of 10 each. So we may safely conclude that number of shares, number of equity shares is equal to 40,000. While as far as acquiring company J Limited is concerned, its total share capital is 1,80,000. One share is of 10 each. So number of share is equal to 18,000. By dividing the assets available for equity share by dividing the assets available for equity shares by the number of equity shareholder, we are getting something, and this value is known as intrinsic value of share. Correct? In this case, it is equal to 20. Now I am going to explain you a little bit about what we call intrinsic value of share. Just imagine for a while, suppose I have invested very huge amount in this particular company, or let us say what we call acquirer company. As a shareholder, if I have invested very huge amount actually in this particular company, quite obviously I would be a little bit concerned about what we call my investment, because huge block of shares I have purchased. So in order to know the health of my investment, I would go for computation of intrinsic value of share. First of all, what we mean by intrinsic value? Intrinsic means inside value. Inside value. Why it is known as intrinsic value of share? Because never ever intrinsic value of share is publicized. Is it clear to you? Intrinsic value of share is never ever publicized. It is never released. So that is why it is known as internal value of share or intrinsic value of share. By computing the intrinsic value of share, how I will come to know regarding the health of my investment? For example, in this particular case, we know that face value of the share is 10. Face value of the share is 10. And intrinsic value is 30. Intrinsic value is 30. It means suppose today, if this company gets liquidated, even in that particular case, I need not require to worry about my investment. Simply because of the fact that this company has got enough asset to back one share of rupees 10 each. One share of rupees 10 each is backed by 30 rupees worth of asset. So the financial position of the company is very strong. So in case if intrinsic value of share happens to be more than the face value or nominal value of the share, always presume that health of the company is very good, very sound. You need not require to worry. So in practical life, generally those investors who are very heavy investors, who have invested very huge amount in the company, generally they go for computation of intrinsic value of share. So through intrinsic value of share, they can easily conclude regarding the safety of their investment. And accordingly, then they take the decisions. Is it clear to you? So in this case, we have computed the intrinsic value of share of both the companies, number one. And honestly speaking, the financial position of both the companies is sound because their intrinsic value exceeds their respective, as I said, nominal value of shares. Is it clear to you or not? So now, and remember one thing, you will have to pay extra attention because tomorrow when you will become professional, you will have to face lots of situations with respect to mergers, absorptions, day in, day out, lots of situations actually take place. Correct? And generally in practical life, when a company takes over the business of the other entity, the purchase consideration is decided by the intrinsic value of share of both the company. This is the most practical actually thing which you are studying here. Is it clear to you? So we have computed the intrinsic value of share, number one. So generally under the questions of intrinsic value of share, your first step will be computation of intrinsic value of share. So we have computed the intrinsic value of share. After having computed the intrinsic value of share, your next question should be, so what is the amount of purchase consideration? You ask yourself, amount of purchase consideration. As a acquirer company, you are supposed to pay to the acquiring company. So what is the amount of purchase consideration? You have already computed that. See here, your purchase consideration will be equal to net assets. You have already computed. Assets minus liability, 3,60,000 is nothing but the purchase consideration. This is the amount which you are supposed to deliver to the purchasing company, is to the acquiring company. Is it clear to you? So we have found out the purchase consideration already, 3,60,000, that is net assets. Purchase consideration, no doubt, is 3,60,000. Is it clear to you or not? Sir, then why this question is of intrinsic value of share if we are saying that purchase consideration is still 3,60,000? I will tell you in a short while. Correct? Just pay attention. First of all, your purchase consideration will be equal to 3,60,000. Now the next question is, how many share purchasing company will issue to discharge the purchase consideration? number of shares to be issued, number of shares to be issued by purchasing company or acquirer company to discharge purchase consideration. For that, what you are supposed to do, you will simply look into the amount of consideration, which we have already, 3,60,000, and then I am going to divide it by the intrinsic value of share of acquirer company, intrinsic value of share of acquirer company or purchasing company. To know how many number of shares I will issue to discharge the purchase consideration. Pay attention here. In this particular case, purchase consideration is equal to 3,60,000, isn't it or not? And what is the intrinsic value which you just computed? Intrinsic value was 30. By dividing it by 30, I will come to know how many shares I am going to issue. Obviously, it comes to 12,000. That means purchasing company will issue 12,000 shares of rupees 10 each at the rate of 30. Because intrinsic value of our share is quite high, we are not going to issue 36,000 shares. That is 3,60,000 divided by the face value. In fact, we are going to issue 12,000 shares. It means that is 12,000 shares of rupees 10 each at the rate of 30. That means 12,000 shares are being issued at a premium of 20 because of rupees 10 each are being issued at the rate of 30. Is it clear to you? Now the fourth point is you have found out what is the amount of purchase consideration and how you are going to discharge. You are going to discharge the entire purchase consideration by issue of 12,000 shares of 10 each at the rate of 30. But the question was asking you compute the ratio of exchange. How to compute the ratio of exchange? Ratio of exchange. How to compute the ratio of exchange? How we are going to compute the ratio of exchange in this particular case? How to compute the ratio of exchange? First of all, you have to think in this manner. One is acquirer company, that is K Limited. Another is acquiree company. Correct? How many shares acquirer company is giving to the... First of all, you let me know whatever purchase consideration which is given by the acquirer company to the acquiree company, to whom it is given in the acquiree company. I am the purchasing company, you are the acquiree company. If I am delivering 12,000 shares, to whom I am going to give the share? To the owners. Quite obviously, purchase consideration will be received by the owners. Correct? And owners are the shareholders. That means purchasing company, acquired company is issuing 12,000 shares. But in acquiree company, there are how many number of shares? 18,000 shares are there. That means there are 18,000 shares in acquiree company, and for that acquirer company is offering only 12,000 shares. Oh my God. Anyway, we are supposed to compute the ratio of exchange. For that purpose, we are going to look at how many shares are going to be issued by the acquirer company to the number of shareholders in the what we call acquiree company. So total number of shares in the acquiree company is 18 and we are issuing actually 12,000 shares. Is it clear to you? So in this case, if I am going to compute the ratio, it will be equal to 2:3. 2:3. Now here, please pay attention. What does it mean? It means for every 3 shares. It means, try to understand, there is no point in solving the question, getting the answers, that's all, unless and until you are going to comprehend the things. It means for every 3 shares, suppose if you are the shareholder of the acquiring company, and if you are having 3 shares, the purchasing company is going to give you only 2 shares. Purchasing company is only going to give you 2 shares. In practical life, when a particular entity takes over the other entity, how it is decided? Because the number of shareholders and number of shares may be different. So how it is arrived at that how many shares purchasing company will deliver to the shareholders? That is always on the basis of intrinsic value of share. So in this particular case, purchasing company is going to issue 2 shares for every 3 shares. I still hope that some of you are still having some sort of doubt. I'm not saying no doubt. Now see here, I will explain it further. Suppose you are the shareholder of the acquiring company and you are having 3 shares. Intrinsic value of acquiring company is 20, which we computed. That means value of your share is equal to 60. While the intrinsic value of our company is 30 and value of 2 shares is equal to 60. Our 2 shares are sufficient for your 3 shares. So that is why we are going to issue you only 2 shares. Is it clear to you or not? So that is how in practical life, it is a very practical concept. I have already told you in practical life, day in, day out, we actually watch out. There are so many mergers, demergers, acquisitions, takeovers are taking place. And how it is decided over there, that purchasing company will issue how many shares for the existing shareholders of the company which is being taken over or being acquired. So that is by way of what we call computation of intrinsic value of share, and through that we decide upon, arrive over what we call ratio of exchange. Correct? So this is the point which you need to understand in this particular question. Is it clear to you? Now, a question has asked us only this much, compute the ratio of exchange, but still I am going to solve it further. Further, let me write. Step number 5. So after the ratio of exchange, now I will prepare the ledger account also, just for the sake of better understanding. I know sometimes it becomes a little bit boring, but little bit of more efforts obviously at this particular level are required. So books of acquiring company. In the books of acquiring company, pay attention. I'm going to prepare acquirer company account, realization account, correct? This time I am not preparing cash account. Why I am not preparing cash account, I will let you know in a short while. But first, I have prepared so far only shareholders account, equity shareholders account. I am going to prepare realization account, and I am going to prepare acquirer company's account. Acquirer is K Limited. Acquirer company account. Correct? In this particular question, first of all, share capital of acquiring company is given in the question as 1,80,000. So I will write 1,80,000 in the equity shareholder account. That is equal to 1,80,000. Correct? After that, in the question, there was general reserve also and profit and loss account also. So general reserve in this case is 1 lakh. Profit and loss account is also given in the question, and that was 80,000. After that, there are 3 liabilities. However, acquiring company is having only 2 liabilities, no debentures. So creditors, we are going to transfer to the credit side of realization account 1 lakh. Bills payable, obviously we are going to transfer here 40,000. So our liability side is closed. Now we move over to the asset side. There are only 3 items. In fact, 2 items of asset as far as acquiring company is concerned. Fixed asset or property, plant and equipment is equal to 3 lakh. Then we have got in this case current asset which is equal to 2 lakh. No investments were there. Now we shall look into the purchase consideration. On the credit side of the realization account, I will write here by acquirer company account, and purchase consideration due. Purchase consideration, you remember, 3,60,000. Now we will cross it to the acquirer company's account. I will write here to realization account that is equal to 3,60,000, and we will receive the purchase consideration. This time entire purchase consideration is being discharged by way of shares. So I will write here by shares in acquirer company account, that is equal to 3,60,000. No doubt this account now will get closed. And because we are not receiving any cash, so no question of posting it, we are receiving only shares. So shares will be posted to the debit side of equity shareholders account. Shares in acquirer company account. Shares in acquirer company account. Shares in acquirer company account is equal to 3,60,000. Correct? Now, no further information is given in the question. In this question, no information because all the assets have been taken over. All the liabilities have been taken over. We need not require to discharge any liability. Similarly, there is no information with respect to expenses. So obviously now I'm going to close it down. As you can see, this account is already getting closed. Honestly speaking, whenever you will be given question based upon intrinsic value of share, never ever the questioner would ask you accounting in the books of acquiring company. Never ever. Because there is hardly anything to do. That is what exactly I wanted to prove. But at the same time, don't make it a rule that there will never be any loss or profit in case of what we call intrinsic value of shares question. No, nothing like that. It coincidentally, in this case, both the sides are getting tallied off its own. So that is why no loss or profit. Because in this question, we did not prepare cash account. We did not prepare cash account simply because of the fact, in this particular case, cash is not given, number one. Number two, even what we call through purchase consideration, we are not receiving any cash. So that is the reason why I did not prepare what we call cash account. Now we are going to tally equity shareholder account. It is getting tallied off its own. You can see so easily. Is it clear to you? So never ever they are going to ask you any what we call accounting in the books of acquiring company if the question is of what we call intrinsic value of shares. Is it clear to you? Now under the fifth step, what I am going to do, books of, this is step number 6 in fact. Books of acquirer company. Generally, whenever question is asked from intrinsic value of shares method, you will be asked to compute the purchase consideration and prepare the balance sheet in the books of acquirer company. Prepare the balance sheet in the books of the acquirer company. Generally, whenever you are going to receive the question from intrinsic value method. Is it clear to you or not? So, books of acquirer company. In the books of acquirer company, first of all, I am going to write the entry. We have taken over fixed asset. We have taken over fixed asset. We just saw that fixed asset were worth rupees 3 lakh. Fixed asset of acquiring company were taken over at 3 lakh. Besides that, acquiring company was having current asset and we took them also. Current assets were worth rupees 2 lakh. There are two liabilities also, if you remember, isn't it or not, of acquiring company. One was creditors. Creditors was 1 lakh. And besides that, there was bills payable to the extent of 40,000. And I will write here two consideration. Consideration we computed. Consideration was 3,60,000. This time again there is no balance, correct? Neither goodwill nor any capital reserve. Now we come over to the second point. We will discharge the consideration. In order to discharge the consideration, you are going to write 3,60,000 first of all. 3,60,000. And then you are going to write here to share capital. Remember, you are the entity which is issuing the share. Obviously, you will have to reflect the nominal value and security premium separately. Now, 12,000 into 10, that will be equal to 1,20,000. That will be equal to 1,20,000. Besides that, you are going to write here 2 security premium account. Correct? 2 security premium account. Now, what will be the amount of security premium? That is equal to 12,000 into 20. 12,000 into 20, that is equal to 2,40,000. That is equal to 2,40,000. Is it clear to you or not? Is it clear? Now, you may be asked to prepare the balance sheet also. How you are going to prepare the balance sheet? This is the point, because generally when the question will be of intrinsic value of share, they are going to ask you calculation of purchase consideration, number 1, then generalization in the books of acquirer company, and also preparation of the balance sheet in the books of the acquirer company. So in this case, we are going to now prepare the balance sheet. How to prepare the balance sheet? That is another important point. Is it clear to you or not? How to prepare the balance sheet? In this particular question, if you remember, in order to prepare the balance sheet, first of all, I need to have what we call complete balance sheet in front of me. Complete balance sheet in front of me of the acquiring entity. Of the acquiring entity and acquirer entity both. Is it clear to you? First of all, let me prepare the format. Assets. Under the assets, I am going to write non-current assets, first of all. Under the non-current asset, what I am going to write here? I am going to write here, first of all, because in this question we are being given fixed asset, so I will write the fixed asset, correct? I will write the fixed assets of the acquirer company and acquiring company. Is it clear to you? For example, if I will have to look into the balance sheet, I will find that fixed assets, I will have to look into the balance sheet in this particular question. Now, where is the question? Now, you can see fixed asset is equal to 7 lakh and 3 lakh. So, all I have to do is to simply add it. Fixed asset 7 lakh plus 3 lakhs is equal to 10 lakh. That is equal to 10 lakh. Actually, rule is you are going to take the value of the fixed asset as per the balance sheet of the acquirer entity. At what value you are going to write the fixed asset, that depends upon the fact, the amount which you have written in the entry. Because in this question we have taken over fixed asset at 3 lakh only. If we would have taken it at 4 lakh, I would have added here 4 lakh. Is it clear to you or not? Is it clear? Similarly, now we will look at current asset. Let's have a look over the current asset. As far as current assets are concerned, current asset, before current asset there is investment also. Anyway, 6 lakh and 2 lakhs are the current asset. 6 lakh and 2 lakh are the current asset, and before that we are having investment, and amount of investment is equal to 5 lakh. Amount of investment is equal to 5 lakh. Just wait. Generally, after the fixed asset, investment should be written. So I will write investments. Now, investment of acquirer entity is only there. So I will write the investment at 5 lakh. Now I will write the current assets. As far as current assets are concerned, pay attention. Current asset, you will see here 6 lakh plus 2 lakh. So first of all, I will write the amount of 6 lakh which is appearing in the column of acquirer company as per the balance sheet. At what value current asset I should add? I will look into the entry. Actually, in the entry I have written 2 lakh only. So I will simply write here 2 lakh, 8 lakhs. Is it clear to you? Now, we will move over to the liability side, equity and liability. Equity and liability. Under the equity and liability, first of all, I am going to write the share capital. Now just pay attention. In the share capital, First of all, you will write the share capital of the acquirer entity. You are not going to add this share capital. Reason, because this share capital is already closed in the books of the acquiring entity. You haven't taken over the share capital. Is it clear to you? So first of all, you are going to write the share capital of the acquirer entity. Once you have written it, now you must also look at the entries which you have passed. For example, in the books of acquirer entity, these two what we call entries you have passed. And in the entries, you have written share capital 1,20,000 because you issued some shares. So obviously, your share capital will increase by 1,20,000. Is it clear to you? So you are going to write here 8,20,000. Then I am going to write here other equity. Other equity means reserves and surplus. Now I will look into the balance sheet again. In the balance sheet, I find that just wait. I will have to see what this item is. In the balance sheet, what was the amount? Oh, this is the balance sheet actually. I was looking at the wrong end. The balance sheet is actually 4 lakh. I'm extremely sorry. I was looking at the valuation of shares. Just wait. Sometimes there is internet lagging. No, this creates problem. Share capital actually is 4 lakh, not 7 lakhs. So 5,20,000 I am going to write. I will total it up. Don't worry about that. Now that we are talking about other equity. As far as other equity is concerned, reserves of the acquirer company is 5 lakh. And remember, these reserves you haven't taken over because these reserves have already been posted to the shareholders account. Is it clear to you? You will simply write 5 lakh and 3 lakh. So general reserve is 5 lakh. Under the other equity, you will write general reserve as 5 lakh. Correct? General reserve as 5 lakh. This is the problem. First, let me actually correct it. It should be 5,20,000. And then I will write general reserve. General reserve amount I have forgotten now. It is 5 lakh. And then there is profit and loss account also. When you flip through the pages, no, that is the only problem. Just wait for a while. I want to actually show you the balance sheet also. So 5 lakh and profit and loss account is 3 lakh. Profit and loss account is 3 lakh. So I will write here profit and loss account. Is it clear to you? You are not going to add the items. You are not going to add what we call profit or loss account of acquiring company or general reserve of acquiring company because those items have already been shifted to the equity shareholders account and closed. Now when you will write the other equity, you will have to keep in mind that security premium also figures here. For example, when you pass the entries, you have written security premium of 2,40,000. So 2,40,000 worth of security premium will also find place over here. Is it clear to you or not? Clear? Now, after that, I will write here 2. Now I am going to write here non-current liability. Under the non-current liability in this question, there are debentures. Correct? Now, debentures are of acquirer entity only. In this particular case, debentures of acquirer entity were given in the question. That is 3,50,000. Debentures are 3,50,000. I'm writing it here. And then we have creditors 2 lakh. And then we have bills payable. These are the 3 liabilities of acquirer entity. So that I need not require to flip again. So debentures I will write 3,50,000 because debentures are only of acquirer entity. Besides the debentures, now I am going to write the amount of creditors. We just saw that creditors of acquirer entity is given in the question. Creditors were 2 lakh. So I will write the creditors. But problem is that we have also taken over the creditors of acquiring entity. At what value we have taken, that can be reflected through this particular entity. At 1 lakh you have taken over the creditors. So you will simply write here 1 lakh. So your total will be equal to 3 lakh. Is it clear to you? Likewise, bills payable. First you write the bills payable of the acquirer entity. Now bills payable of the acquirer entity which we wrote were 50,000. So I will write here 50,000. And now I will simply look at what value we took over the bills payable of the acquiring entity. Bills payable were taken over at 40,000. Is it clear to you? So I will write here 40,000. So total will be equal to 90,000. Is it clear to you or not? But, just wait. Actually, these are current liabilities. Now the next thing is that what which you are supposed to do, always make a check of the entries which you have written over here. Always make a check of the entries which you have written, correct? For example, you will have to write here, you will see here that whether fixed assets have been adjusted, current assets have been adjusted or not, creditors have been adjusted, bills payable have been adjusted, then consideration is already cancelled out, share capital you have written, security premium you have written. Once you have made a thorough check, then only you will have to move further. Is it clear to you or not? Correct? So after this particular point, now we shall move over to the next question. And this is pretty strong question. This is pretty strong question and not an easy question. This question is a little bit tough to handle. So 6.2, as I was about to say, and I told you in the beginning itself, as far as intrinsic value or shares method is concerned, lots of questions are being asked on this particular topic. Just pay attention. This is one among them, and it's a pretty tough one. In this question, it is given that F1 Limited agreed to take over F2 Limited on 1/10/2020. Now there is an entity F1 Limited. It is taking over F2 Limited, and the summarized balance sheet of F1 and F2 as at 31st/3/2020 is given to you. Now if you look into the balance sheet, you will find that there is equity share capital of F1 and F2. Remember F1 is taking over F2. As far as reserve and surplus or other equity items are concerned, we have 2 reserves and profit and loss account. Besides that, we have got 1 liability only, creditors. Then total is given. Then property, plant and equipment is equal to 15,50,000 and 12,60,000. Then we are being given current asset, and current asset, lots of current assets are there, 2,35,500 stock and 3,81,500 again, and then debtors, and then bank, and then we have preliminary expenses. Although preliminary expenses are given over here, as we know, preliminary expenses are valueless items. Now you are given some additional information in this particular question. Question says that for the 6 months period from 1st of April 2020. Remember here, in this particular question, balance sheet of the 2 companies is given on 1/10/2020. 1/10/2020. And below it is given that for the 6 months period, that means from 1st April till the date on which the entity was acquired, that means from the beginning of the current year. This entity was not acquired in the beginning of the year. It is acquired on 1st of October 2020. So from the beginning of the year till what we call 1st of April 2020, it is given F1 Limited and F2 Limited made profits of 5,40,000 and 3,60,000 respectively, after writing off depreciation 10% per annum on the fixed asset. We made a profit of 540 and 3,60,000 after writing off depreciation of 10%. What repercussion it would have, I will let you know in a short while. Both the companies paid on 1st of August 2020 equity dividend of 10%. Both the companies paid equity dividend, and just to add salt to the injury, They have also given that dividend tax at 15% was paid by each of them on such payment. So whatever dividend which was paid by these two companies, besides that these two companies also paid dividend tax at the rate of 15%. Now it is given that goodwill of F2 Limited was valued at 1,68,900. In the question, we have already gone through goodwill is not given in the balance sheet. However, when F1 Limited acquired F2 Limited, it valued the goodwill of F2 Limited at 1,68,900 on the date of takeover. Stock of F2 Limited was subject to an abnormal item of 8,500 to be fully written off. Stock of F2 Limited. Now, stock of F2 Limited, question states that it contains an abnormal item of 8,500. So, from the value of the stock, I will subtract 8,500. Whatever remaining stock will be there, question says will be appreciated by 20% for the purpose of the taken over. That means in order to compute the value of the stock from 3,81,500, first of all, I am going to subtract the abnormal item 8,500. Whatever remaining item will be there, I will add 20% to it and then we will take it over at that particular value. Further, it is given F1 Limited would issue F2 Limited shareholders fully paid equity shares of 10 each on the basis of the comparative intrinsic value of the shares on the date of the takeover, and you are required to. As we can see that this question related to intrinsic value computation, correct, number one. And what we are supposed to do? We are supposed to find out the consideration to be transferred to F1. Secondly, to be transferred by F1, calculate the number of shares to be issued by F1 to F2 Limited, and then ascertain the closing bank balance which will appear in the balance sheet. This time balance sheet is not asked, rather we are being asked actually what is the closing balance. So this is the question, correct? Interesting question, long question, but not a tough one. If you want to note, you can. Otherwise you can simply look over here, correct? That is suffice. And then you can look into the solution. This time I'm not insisting that you should write only. Just in order to make you understand better, 6.2 is the question which I'm picking up. Under the 6.2 question, first of all, what I did, in fact, first step. Under the first step, I write here increase in profit because it was given in the question that profits of these two entities have increased. Increase in profit. And remember one thing, increase in profit always means increase in cash. Is it clear to you or not? Do you know why? In your earlier level, in the very first class, when you entered for the commerce journey, your madam told that assets in accounts is always equal to liability plus capital. Suppose at this moment asset is equal to 5 lakh, liability is equal to 0 and capital is equal to 5 lakh. Suppose I ask you a very innocuous question, rent received, let us say 10. How will you treat it in the accounting equation? Because you have received rent, obviously your assets will increase, number one, and your capital will also increase, isn't it or not? That means you are considering this rent as a sort of profit. That is why you are adding it to the capital. So increase in profit always directly or indirectly means increase in cash. Anyway, first of all, let's come over here. I prepared two column F1 and F2. Correct? It's almost a 16-mark question. First of all, I write here net profits which were given to us in the question. If you remember, 5,40,000 was given and 3,60,000 was also given to us. 5,40,000 and 3,60,000. Clear? Besides the net profit, it was given that these net profits were after the depreciation. After the depreciation. First, let me add the depreciation. Why we are adding the depreciation? We know that depreciation is a non-cash item, isn't it or not? So, if I will add the depreciation, it will give me my cash profit. As you know, under cash flow statement, you used to do in your earlier phases of education to find out cash from operational activity, you used to add depreciation. Similar logic you will have to apply here. Now, depreciation, how I am going to compute? First of all, I will take into account F1. The value of the F1 given in the balance sheet is 15,50,000. and depreciation rate is given 10%, and into 6 by 12. For 6 months depreciation I will apply. Correct? So 6 months depreciation will be equal to 77,500. So 77,500. What will be the depreciation of F2? As far as F2 is concerned, in the balance sheet, you can see their value is 12,60,000 and into 10% and into 6 by 12. So that will deliver you the depreciation of this particular entity also. Depreciation of this particular entity will be equal to 63,000. Is it clear to you? Now I am going to add it. It will tell me the increase in cash. Correct? 6,17,500 and 4,23,000. 4,23,000. Increase in profit always means increase in cash. Remember one. Is it clear to you? Under the second step, what I am going to do, second step, see here. Now I will write here cash balance. Cash balance. Correct? Under the cash balance, again F1, F2 of course. Now balance as per balance sheet is given to us. Cash balance as on 1/4/2020. In the beginning of the year, as per balance sheet, cash balance is 3,40,000 and 1,80,000. And now we know that because profit has increased during these 6 months from 1/4/2020 till what we call 1st of October 2020, profits have increased by this much. I will add this increase in profit. Increase in profit means increase in cash. Is it clear to you? Increase in profits I am going to now add. Increase in profits is equal to 6,17,500 and 4,23,000. So this will tell me the balance of cash on the date of takeover. So that will be equal to 9,57,500, 9,57,500 and 6,03,000. Now we have got balance of cash also. Is it clear to you? Now we are in a position. But before 9,57,000 in this question, there is also some information with respect to payment of dividend. Correct? So let me also adjust that so as to find out cash balance, proper cash balance, 6,03,000. Because in this question, it was also given in the question that both the companies have paid some dividend. When the company will pay the dividend, what will happen? Cash will also get reduced. So less payment of dividend. Less payment of dividend. Now I will write here payment of dividend. Not only payment of dividend, but payment of dividend and dividend tax also. Dividend tax also. Correct? For that, I will have to look into the share capital of the respective company. When I will look into the share capital of the respective company, as far as F1 Limited is concerned, 20 lakh into 10%. So dividend they have paid equal to 2 lakh. I will subtract 2 lakh. Correct? And they have also paid dividend tax. Dividend tax is paid on the amount of dividend. So amount of dividend happens to be 2 lakh. So 2 lakh into 15%, they must have paid a dividend tax of rupees 30,000. So as far as F1 Limited is concerned, it must have paid a dividend of 2 lakh and dividend tax of what we call 30,000. Now as far as F2 Limited is concerned, its share capital given in the balance sheet is equal to 15 lakh. Now 15 lakh into 15%, dividend is 10%. I will compute 10% dividend. 10% dividend is equal to 1,50,000. Now dividend tax will be equal to 1,50,000. Dividend tax is always computed on the amount of dividend. Dividend tax is equal to 15%. So 15% of 1,50,000 will be equal to 22,500. So now you are going to subtract these two items from 9,57,500 and 6,03,000 to get what we call balance of cash on the date of acquisition. So that will be equal to 7,27,500 and will be equal to 4,30,500. Now we have the cash balance on the date of acquisition. Because balance sheet is given to us as on 1/4/2020, takeover has been done on 1/10/2020, so quite obviously some change during these 6 months have taken place and accordingly value will have to be adjusted. Now under step number 3, I will write intrinsic value of share. Now we will compute the intrinsic value of share. F1, F2. Interesting question. So first of all, you will write here cash balance. Now cash bank balance you have just computed. That is equal to 7,27,500 and that is equal to 4,30,500. Correct? Besides that, in the question we are being given property, plant and equipment or fixed asset, now less depreciation. Because we have computed the amount of depreciation, so you simply subtract it from their respective value. After subtracting from their respective value, you will get 14 lakh something, 14,72,500. Correct? The value which is appearing in the balance sheet, from that you simply subtract the 6 months depreciation. Similarly, here also 11,97,000 will be the value. That is value appearing on 1/4/2010 less 6 months depreciation. Then we will come across debtors. As far as debtors, there is no change. So I will simply write the balance sheet value 3,49,500 and 2,31,000. Is it clear to you? Then besides debtors, we are also having in this question stock. As far as stock is concerned, 5,35,500 worth of stock is given of F1. However, the stock of acquiring company, I told you, first of all, from the value of the stock which is appearing in the balance sheet, subtract 8,500, an abnormal item was there. After subtracting 8,500, whatever value you are getting, now add 20% to it. At this value, you are going to take over the stock. That value will be equal to 4,47,600. Is it clear to you or not? 4,47,600. That value will be equal to 4,47,600. Further in the question, it was also given that when F1 Limited acquired F2 Limited, it valued its goodwill at 1,68,900. Is it clear to you? So, on the date of acquisition, this is the situation of the asset. Now we will subtract the liabilities. There is only one liabilities, fortunately. The liability is in the form of creditors, 85,000 and 75,000. When I will subtract this value from the total of the asset, we must get net assets equal to, because I know the answers as far as net answers are concerned. So net asset must be, you must make a thorough check also, I keep on telling. 30 lakhs should be your net assets and 24 lakhs should be your net assets of this entity. Because in this particular question, net assets means assets available for shareholders. No preference share capital is given. Had it been given, I would have subtracted it. That means now we get assets for shareholders, assets for equity shareholders. Assets for equity shareholders, 30 lakh, 24 lakh. 30 lakh, 24 lakh. Is it clear to you? 34 lakh, 30 lakh and 24 lakh. All you have to do is to now divide it by number of equity share. The number of equity share. Number of equity shares. As far as number of equity shares are concerned, we have already seen that one share is of 10 each. So 20 lakh divided by 10. Number of share will be equal to 2 lakh. 15 lakh divided by 10 will be equal to 1,50,000. By dividing it, we will get the intrinsic value of share. So one part of the question we have already solved. 15 will be the intrinsic value. and then 16 will be the intrinsic value in this particular case. After having computed the intrinsic value, your next step will be amount of consideration. In fact, now we are trying to find out number of shares to be discharged, to be issued. How many shares will be issued by F1 Limited? Number of shares to be issued by F1 Limited. For that, we require consideration. We have already computed the consideration. Consideration is nothing but net assets of F2 Limited. Correct? So I will write the amount of consideration as 24 lakh. And I will divide it by intrinsic value of share of F1 Limited. Intrinsic value of F1 Limited is 15. Is it clear to you? This is how I will come to know how many shares we are going to issue. So we are going to issue 1,60,000 shares. Of course, of rupees 10 each at the rate of 15. Is it clear to you or not? This is interesting question. This is how you are supposed to do this particular question. Is it clear to you or not? Is it clear? Now suppose if I ask you what is the cash balance. In order to know the cash balance, you simply, in fact you have already computed cash balance. Here it was, right. Cash balance is 7,27,500 and 4,30,500 on the date of the acquisition. This is how you are supposed to do this particular question.